From neutral on buyers' shares, suggesting that maybe they could be upside as a result of the legal wranglings that maybe are coming to some kind of closure when it comes to Bayer and its US exposure. So watching Wise, Wizz Air and Bayer as well, Anna.
Okay, so those are some of the individual names in focus this morning. Of course, that big focus, yes, on that Wise decision. We'll see if that has any impact on the way that the shares trade as we get closer to the open. Here we are, the start of European equity trading for this Thursday morning. The FTSE 100 out the gates and pretty flat this morning. The IBEX just a touch weaker. You didn't get a sense from looking at the futures picture that this would be a day that had big moves in store, and indeed we don't see those. The stock 600 then is almost entirely flat this morning. As I was mentioning earlier, we're looking at some big set piece events, the ECB meeting later on today, the non-farm payrolls data out tomorrow. We also have the possibility of learning more about the trade agenda between Europe and the United States today. Could we get positive headlines coming out of that White House meeting between Friedrich Merz and Donald Trump, or will we get negative headlines and suggestions about where those conversations are going? So no doubt trade tariff news flow will be something that we'll be watching for as well today. That gives the markets a moment, Tom, to settle down, and they've settled down into not much action, it would seem. Yesterday, technology stocks were on the rise. I wonder what the sector picture looks like this morning.
Top of the list so far, top of the list in terms of the sector breakdown. Basic resources up 0.5%. Autos also posting some modest gains of 0.3%. The DAX print has not come through yet, but across the benchmark, FTSE 100 here in the UK, currently flat. The CAC current over in France, just up 0.1%. We wait, of course, for the DAX to open. On the downside on your sectors so far, media down 0.3%, utilities, travel and leisure. So we look at Wizz, of course, within the mix there, down 0.3% on travel and leisure. Again, tech amongst the gainers today on the sector story, something that Anna was highlighting in terms of the moves yesterday to the downside for tech. Today, tech up 0.3%, basic resources up 0.7 so far, Anna.
Okay, so those are some of the some of the sectors. I mean, it's not a hugely compelling story this morning, is it? We're not seeing a huge amount of well, there's not a huge amount of news flow to drive these individual names and to drive these sectors. We're watching the Wise share price. That is on the rise this morning as it announces its move. Let's broaden the conversation, shall we?
A Wise decision?
Yes, that sounds good.
Okay, gaining so far, as you say, 4% on Wise. We'll get that detail on that story as well later in this show. Let's get a broader take on these markets then and bring in Caroline Raab, cross-asset strategist at Deutsche Bank Research. Caroline, thank you for joining us. What is the next catalyst for these markets?
Yeah, we'll have a lot of catalysts coming up today, actually. We'll have the ECB meeting later today. We expect a 25 basis point cut from the ECB, as broader markets also expect. We will have Friedrich Merz in the US today meeting Donald Trump. So also the trade topic will probably come up. Negotiations are going quite well so far. So we expect to reach a deal between the US and the EU in the coming months. But there will probably still be some ups and downs on the trade negotiations.
Yes, we have. We've heard some more positive noises, haven't we, Caroline, from the most recent meeting between Maroš Šefčovič and his US counterpart. We're hearing some more positive mood music. That sounds quite different from just weeks ago. Do you think it is trade that still has the potential to deliver headlines, or do we see kind of diminishing response function to those trade headlines by markets?
Yes, we clearly do see a diminishing response function. I mean, we've seen that over the past weekend when there was a short period when Trump announced that European tariffs should be doubled. We've also seen not much of a reaction on the doubled aluminum and steel tariffs. But now we do see from both sides confirming, both the EU, both the US, that trade talks are going pretty well. So we remain quite optimistic that a deal can be reached, but we wouldn't expect that, while these ups and downs along the way occur, that market reactions will be as big as we've seen on Liberation Day, for example, when markets were still more cautious and more nervous around trade, clearly.
Caroline, with your cross-asset hat on, what is the euro strength story doing to the corporate earnings outlook for European corporates?
Yeah, I wouldn't call it that much of a euro strength story, but rather a US dollar weakness story. And I mean, we've seen that again yesterday with weaker US data rolling in. We've seen another decline in the US dollar with the weaker ISM print, the weaker job data print yesterday. And then, of course, a stronger euro is not great for European earnings. Our estimate is that any 10% move in the US dollar lowers European earnings by 2 to 3%. But we've seen that this year already, right? We've seen the dollar weaken by 10%. And we've also seen European earnings revisions down by 5% since Liberation Day. So I would expect that a lot of that is already reflected. But of course, any further strengthening of the euro would probably, result in further downward revisions in European earnings.
Caroline, thinking about the European stocks environment, do you see pressure on European companies to consider listing in the United States? We talk a lot about that here in London, and we've had news around Wise, the fintech business, that they are going to be doing that, moving their primary listing. But away from that particular stock, is this a broad theme that even over in Germany is discussed as well?
I mean, that is a theme that has come up in the past years. We've seen stocks delist from the German market and only have their primary listing in the US. I don't think that's a broad trend. I mean, it probably also has a bit of a sector bias, for example, in biotech, in pharma. But I don't think that's a broad trend. And you also have to consider that for European stocks, European companies, the market is much more competitive, of course, in the US to reach or to get to an index listing, for example. So also considering this year's equity move and the increasingly positive sentiment on European markets, and also US investors now starting to invest more into European equities, I don't think that's a trend that will persist over a long time. So I don't think that's a broader trend.
Okay, interesting. In terms of that upside that we've seen with that focus on Germany for the moment, the upside that we've seen for the DAX, the broader DAX, up what 20% year to date. The MDAX, is there a catch-up story with the MDAX, the mid cap, more domestically focused German stocks? Is that an opportunity that investors can engage with at this point?
Yeah, so the MDAX is our favorite index within Europe, actually. And as you've said, the DAX has already rallied quite substantially, right? It's one of the best indices this year, more than 20% up. And valuations in the DAX have also become, a bit expensive now. So we see less relative upside for the DAX and more for the MDAX, which is still trading quite a bit below its long-term average PE. And then also on the domestic focus, so the MDAX has a bit more than 30% exposure, so revenue exposure, to Germany, while in the DAX, the revenue exposure is less than 20%. So if investors really want to play the German, growth story, the German fiscal package, then the MDAX clearly would be the place to be. And we expect 7% more upside in the MDAX this year.
Yes, and away from the MDAX, back to the larger cap stocks, Caroline. Of course, the performance of German markets over the first quarter very much influenced by what the auto sector was able to deliver. Is the talk at Deutsche Bank at all around that sector turning a corner, drawing a line in the sand, being able to move on to better times, or we just need resolution on trade before we can get there?
Yes, of course, the auto sector is one of the sectors that is more punished by tariffs and has also moved most in terms of the tariff headlines. And then also, if we look at earnings, actually, auto earnings were among the weakest in Q1. They also dragged down the entire DAX earnings quite substantially. And there is not really an expectation that earnings growth will come back within autos that soon. So overall, we don't focus on the auto sector right now. We see strength in the broader sector of the DAX, but not so much in the auto sector. So we focus on classic manufacturing sectors, basic resources, chemicals, construction, but we would remain a bit more cautious on auto still.
Carolyn, thank you very much. Carolyn Raab, cross-asset strategist at Deutsche Bank Research. Thank you so much for joining us. Let's have a quick look at the core six, some large in-focus stocks across Europe right now. Novo Nordisk, LVMH, most of that list, in fact, moving higher, not by a huge amount, but Novo Nordisk not doing too badly. A day for pharmaceuticals, perhaps. Nestle is in retreat, just down by 0.3%. So that's the picture on the core six. Away from the core six, though, we should reflect on the weakness in Wizz Air this morning, Tom. And I know that we spoke to Joseph Ferrari, the CEO, a little bit earlier on, and he was talking to us about, well, they've withdrawn their guidance, which is clearly something that's going to put downward pressure on your stock. So in today's move, more than 20% downside, so the stock being hammered, to your point, more than wiping out the year-to-date gains. Up until today, you'd see gains about 16%. Over 12 months, you've seen losses of 30%. That has now, of course, been almost more than doubled on the moves to date. So to your point, yes, look, the CEO was talking about the fact that actually they're seeing a pretty solid summer season, but they do not have that clarity, that visibility, so they've withdrawn that 2026 guidance, and that appears to be the factor that investors are latching onto. Yeah, absolutely. And then he was also talking quite resiliently about the tariff environment. Of course, that doesn't affect the flying of the planes necessarily, but the sourcing of the engines. He was talking about how there were a lot of ways that they could manage the registration and the location of these various aircraft to enable them to get around tariffs, but that doesn't seem to be enough. Having that UK entity may be helpful, but for now, the focus is on the drop in the share price. Let's get more details on this and bring in Joe Easton from our equities team with an eye on the stocks to watch, and of course Wizz is front and centre as well. Joe.
So yeah, that's really the big stock to watch at the open of trading. Down 23% now for Wizz. Now, a lot of that due to the guidance being removed, as Tom was mentioning there, and also the costs looking worse than expected. As I said earlier, Jefferies were putting a note out earlier saying they're potentially going to see some big downgrades to earnings. So the costs per seat coming up is what Jefferies said, and that is already one of the big underperformers in terms of the airlines over the past year or so. So we're really adding to that, but that's a huge move and a lot of volatility in that stock at the moment. Then we go over to Eutelsat, one of their Asian investors, one of their big Korean investors, offloading a lot of stock at a discount. That had a big rally, of course, linked to the war in Ukraine and potentially exposure there with some of their satellites being used. So potentially just cashing in, booking a little bit of a cheeky profit on that one and selling that stock down. So down 13% on that one. Then we've got Bezi, BE Semi, a bit of talk around some of the big US tech firms like Broadcom and AMD potentially doing a little bit more business for BE Semi's materials that they sell into the semiconductor machinery space. That seems to be the take on why that one is up. There is a story on the Bloomberg terminal from BI, worth checking that one out on the terminal. Then we have got Wise in focus, of course, listed in 2021. So did Doc Martens. Doc Martens has a trading update. People buying lots of new boots, apparently. So Doc Martens getting a boost from their sales, looking pretty strong in a trading update. But that stock down very sharply since they listed in 2021. So not really touching the sides in terms of a rebound on that one yet. Then finally, on your analyst ratings, Bayer, we did mention that one, Goldman upgrading it, saying that the risks around Roundup litigation is overdone and they think this could come up, this stock could rise if the Supreme Court rules in favour of Bayer. So that one getting a boost. And then finally, back in aviation, ending where we started, Airbus, that one is downgraded at Citi, which says that the weaker dollar is a risk for the company because they get sales in dollars and also costs in euros. So the FX impact is negative, and Airbus declining 0.9% in Paris this morning.
Joe, thank you. Joe Easton from our equities team. Now, as Joe was mentioning there, the British fintech Wise plans to transfer its primary listing from the LSE to New York. A real blow to London then, perhaps. Wise will maintain a secondary listing on the LSE. Let's bring in Bloomberg Europe ECM editor, European Capital Markets editor, Charles Capel, with us this morning. Charles, good to speak to you. So talk us through the rationale here. They are not the first company to come to this conclusion.
No, they're definitely not the first, and sadly fear that they may not be the last. It's the usual reasons. They're looking for more liquidity, they're looking for a different type of investor, and specifically they may be thinking about this idea, whether it's right or wrong, but this idea that investors in the US are more suited to tech stocks and high growth stocks, whereas investors in London, they like a nice dividend and they like some good return on their investment, whereas they are moving to the US perhaps to access that new pool of investors.
How damaging is this, do you think, Charles, to the LSE?
Look, it isn't a knockout blow, but the thing with the LSE is that to some extent it is death by 1,000 cuts. And it is the third negative thing to happen to the LSE this week, right?
This week?
So last night we had Cobalt Holdings pulling their IPO. They were due to raise $230 million, about $230 million. They pulled their IPO late last night. They were due to start trading this morning. On Monday or Tuesday we had Endivia. They were cancelling their secondary listing. About a year and a half ago, they moved their primary listing over to the US for the same reasons or similar reasons that Wise has moved their primary listing. Liquidity, different type of investor, more trading in their stock.
Now, the more this has happened, the more we have a sense of how these businesses then do when they go over to the US. I mean, it's not plain sailing, is it? Because to try and get in front of all of those analysts and investors that you think will value your business better, you might want to be in one of the indexes. Well, that's not guaranteed, is it? It's competitive if you go to the US.
It is really competitive, and that's one of the reasons, or one of the things that the LSE has going for it. You can be a darling in the LSE at a $15 billion market cap. You can be one of the exciting growth companies, but in the US, you're just another company. You need to really do something special in order to stand out, and that is quite difficult. So getting into those indexes, again, that's going to be competitive. That's one of the things that Wise wants to do. But Wise has also struggled getting index inclusion in the UK because of certain aspects of their share structure. They've got this dual-class share structure, which has meant it has been difficult to get into FTSE indexes.
Which is a frustration amongst founders as well in the UK in terms of that particular structure and the constraints on that. So a small fish in a big pond. We'll see if they can prove advantageous in terms of this move. If it works out for them, essentially in the US, which they say is a major growth market as well, which is another factor. Bloomberg's Charles Capel, thank you very much indeed, breaking down the Wise story for us and what it tells us about the LSE and listing in the UK. Coming up, the Sell America trade spurs renewed interest in Europe. We are live from Super Return in Berlin, speaking to even more influential voices from the world of private capital. That is next. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets.
Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Let us take you live then to Berlin. The Super Return event is still taking place. Capital markets and private markets very much in focus. Bloomberg's Kriti Gupta is there. Kriti.
Anna, thank you so much. We are here, as you say, in Berlin at Super Return, trying to cover these private markets, trying to navigate what the volatility that we're seeing in the public markets maybe helps or hinders the case for the private markets. I've got the perfect guest for you for this program. I'm joined here by Michael Brune, a partner over at Goldman Sachs Asset Management. Michael, pleasure to have you on the program, as always. Good to see you. Talk to us a little bit about the volatility that we're seeing in these markets. We keep talking about this from a public market standpoint. How does that affect? Talk to us about the trip roll down into the private markets.
That's a very good question. So first of all, I mean, the economy is slowing down right now, and we believe that the tariffs will have a slowdown effect on economic growth and also continue to leave us with elevated levels of inflation. And it's also driving a meaningful amount of volatility. And so what we're seeing right now is that volatility is something that our portfolio companies need to navigate. It's something that all our CEOs need to get their head around. And so they're turning to us. They're turning to somebody with Goldman Sachs, large asset manager, both with a public and a large-scale private markets business. And they're turning to us to say, what are the insights that you have? How can we use your network? And how can we use all your value acceleration capabilities in order to navigate this? The good news is that we have a lot of lessons from COVID recently. And so one of those lessons is like all the decisions that you took during COVID, you have to revisit again now, and you need to get on with your value creation plans, and you may have to move a lot faster. So it's an environment that allows some of our CEOs to excel because they're moving faster on all their operational plans than they would have done in a less volatile environment. The volatility also means that founders of companies are turning to us to say, hey, I need a trusted partner to help navigate this. So on the new deal formation front, the volatility actually really helps us. It could be a founder, it could be a family. They really want that value-add partner. And then the corporates, they're trying to deal with the volatility by reducing complexity. So what they're doing is they're saying, let's look at all our non-core businesses and let's really get on with all those non-core asset dispositions. So the carve-out deal is really back on the table, and that's another way of dealing with volatility. The good news for us as private equity investors is that in the carve-out deals, there's usually a real opportunity to provide a lot of value add, a lot of operational improvements, because the big corporate has maybe a couple of core businesses that they're put most of their attention to, had less attention on the non-core businesses, and then we can come in and really drive value creation there.
Well, talk to us, though, about this capital market story. You and I were here a year ago, and we were talking about, well, you know, private markets are warming up. In about a year's time, 2025 is going to be the year where we see IPOs, we see deal-making hit a new record. What happened to that in the face of this kind of instability, largely emanating from policy? But what happened to that? What does that timeline look like now for the capital markets to open up in true fashion?
So we did see in Q1 a tick up in activity. We actually had reasonably good conditions for that, also because credit markets have been incredibly strong, right? Credit spreads have been coming in, and if you think about the return equation for private equity. Obviously, the cost of leverage, the amount of leverage you can get plays a role. And actually, that has all been moving in the right direction versus when you and I spoke last time. If I think about what happened then in the beginning of April and into May, is that we got a lot of volatility, and that volatility has slowed down some of the deal formation. But if you ask investment teams all over the world, they will tell you that they're super busy working on their pipelines, and they are getting stuff done as well at this moment in time. One of the things that we have seen, that we have gotten done, also during April, also during the times of the most volatility, was in-market consolidation, where our platform deals were able to bolt on smaller assets that, again, are struggling to navigate this volatility, and said, with this level of uncertainty, we need a much stronger partner. We need many more insights. Let us come in, and when we can act as a synergistic partner, we can use our capabilities and then consolidate. So I think that deal activity will continue, but it would be nice to see somewhat lower volatility to really see a continuation of the trend in Q1.
Do you feel like you're getting lower volatility when it comes to Europe? There's an argument here that the instability, the volatility emanating out of the United States right now, the answer to that in the private and the public markets is just invest in Europe. How long does that last?
So first of all, we're a global manager, and I think you need to be balanced in your approach. So what we do is we can often look at the same interesting investment thematic in multiple geographies. So the concept of Europe, so like over the United States or United States over Europe, doesn't really exist. What we think a lot about is at the individual asset level, where is this the best opportunity? And so, for example, already in 2024, we saw a few opportunities where actually the price point at which we could get a certain sector exposure, maybe a services business in Europe, was at a real discount to where the similar asset was trading in the United States. And so we're leaning into that opportunity. It only gets better when you then take that asset and say, hey, the world's biggest end market is the United States. Let's turn around and then let's drive more growth in the United States, and maybe one day sell the asset in the United States. Because I think one thing that we as private equity investors always need to remember is at the day you enter an asset, you also need to start thinking about the exit.
Yeah.
And one thing we all know is that the depth and the liquidity of the U.S. markets are so much greater than any other market in the world. And so you have to, at your investment committees, to have an eye on that. I do like the idea of taking assets and moving them across geographies and picking up maybe a valuation discount in one geography, but an exit opportunity in another geography. So we're working on that in services-led asset-like businesses.
I'm going to put you on the spot, 30 seconds. Talk to us a little bit about how that excellence in the States translates to the AI theme. Rich valuations in the public markets that show up in the private space?
So for us, we haven't invested a lot into like LMMs, like the epicenter of AI. We are doing the picks and shovels. We're doing all of the AI thematics related to enablement. So we invest into, for example, IT services companies that are proliferating AI into smaller companies. So we love that services asset-like thematic.
All right, Michael Brune, covering a little bit of everything for us. We thank you so much. I'm going to throw it back to you in the studio there. That was Michael Brune, a partner over at Goldman Sachs, talking to us a little bit about perhaps the optimism in the United States, not quite just over just yet. Of course, as a lot of folks do actually look to Europe in terms of expanding some of their portfolio. Anna and Tom.
Kriti, thank you very much. Bloomberg's Kriti Gupta, of course, at that Super Return Conference in Berlin. There'll be more from Kriti later this hour, later this morning. Plenty more conversations on private markets. Coming up, though, we will also focus on the ECB, widely expected to cut interest rates again today. But what will the central bank say about the path ahead? We're live in Frankfurt. That's next. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. we're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
This is the opening trade. We're 30 minutes into today's session, 8:30 here in the UK. And sentiment has turned a little bit more positive now across European equities. US futures also on the front foot right now. The Stoxx 600 is up 0.2%. Top of the list is tech as a sector, up 0.7%. And S&P E-mini stateside up almost 0.2%. Now, investors are awaiting a potential decision from the European Central Bank. This could be a catalyst for the markets, and the language from Christine Lagarde as well, to lower interest rates for an 8th time as President Donald Trump's moves, of course, jolt global trade, land lower the growth outlook globally, of course. Inflation has come down to 1.9% now on a headline basis for the EU. For more, let's cross over to Lizzie Burden, who's standing by in Frankfurt with a preview of the ECB decision. Are they kind of, is this a cut from the ECB, Lizzie, and then they're done? What is the expectation in terms of the guidance going forward from the ECB today?
Well, the expectation, Tom, is this is the last easy cut from the ECB, because as you say, inflation's back below target, but beyond this meeting is when things get really cloudy in terms of the outlook. First, in the short term, on the tariff front, we just don't know whether the US is going to raise tariffs on the EU from 10 to 50% after that July 9th deadline, or how the EU is going to retaliate. And then in the longer term, we just don't know what the economic impact will be of all of this increased spending on infrastructure and defence. We're waiting for concrete details on that fiscal stimulus, which is why, in addition to the inflation and growth forecasts, which will be updated, we're expecting a range of scenarios to be published to account for all of that uncertainty. But the question, as you suggest, becomes, do they cut again in July, or do they wait until September? And economists expect September, but there are arguments against that, chiefly that it could create confusion in the market as to whether the pause is actually the end of rate cuts. And the last thing that the ECB wants to do is add surprises to an already volatile market. They say they want to be a beacon of stability. So I really do expect that President Lagarde is going to keep her cards very close to her chest at this press conference.
Lizzie, thank you very much. Bloomberg's Lizzie Burden in Frankfurt with a preview then of what to expect from that Eurozone ECB rate decision. Sticking with German themes, the German Chancellor Friedrich Merz will meet President Trump in the White House later today. Merz has veered between boasting about common ground with Donald Trump to bemoaning the US president's volatility and even mocking his bravado. Now they meet for the first time face to face. We're joined now by Bloomberg's Marilyn Martin, who's been thinking a lot about what this meeting could look like. What kind of meeting then do we expect today, Marilyn?
Yeah,
Yeah, so this will for sure not be an easy meeting for Merz, just because the stakes are very high. So, of course, we have the military and the defense dimension of the whole issue. So there's the war in Ukraine still raging, Trump not being able to cut a deal yet, and also Trump repeatedly calling on Europe and on Germany to increase the defense spending, to do more for their own defense. So that's an issue that Merz needs to address in this meeting, just because it's a very existential issue for the continent. But there's also the economic issue, of course. So Germany is particularly vulnerable to Trump's trade policies, just because the whole post-war growth model of the German economy really relied on exports. And the biggest export market for Germany is the United States. So any tariff will be really painful for German firms, for German companies going forward. So this will, of course, not only spell trouble for the companies themselves, but also for Merz, who ran on a platform of reinvigorating economic growth for Germany.
Okay, so the vulnerability is there on the tariff front when it comes to the German economy. Is there resilience, though, longer term, should those relations between Brussels and Washington deteriorate further from where they are now?
Well, actually, that's the critical point. Germany is in a very weak spot right now. There are a lot of structural issues compounding. So the German economy is not looking good right now. The industry is declining. Industrial production has been declining since 2017, late 2017. And the issue is that the pandemic was a big hit, of course, but also the energy crisis due to the war in Ukraine. Since then, the German economy has not been growing anymore. And a main issue is also that there are more and more job cuts coming in. So one economist we talked to said that there are 10,000 jobs being lost in German industry each month. So there's a lot of pessimism about the structural issues facing German economy. And the German government recognized that, Merz recognized that, by passing an infrastructure fund for 500 billion euros, so roughly $570 billion. But the key question will be whether this will actually be spent in a smart way so that the German economy will be on a sustainable footing again.
Okay, 10,000 jobs a month just in that sector. Marilyn Martin, thank you very much indeed, with a look ahead to what could be a crucial, pretty consequential meeting between the German Chancellor and President Trump in the White House later today. Talking of President Trump, he has announced a travel ban affecting a dozen countries around the world, reinstating then one of the most controversial and defining measures from his first term.
Very simply, we cannot have open migration from any country where we cannot safely and reliably vet and screen those who seek to enter the United States. That is why today I am signing a new executive order placing travel restrictions on countries including Yemen, Somalia, Haiti, Libya, and numerous others.
For more, let's bring in Bloomberg's Charlie Wells. What details do we have about this reheated travel ban?
Tom, so this is taking a lot of people by surprise this morning, and this really is being billed as a response to the attacks that we saw over the weekend on an event in Boulder, Colorado, about Israeli hostages. And what we know is that this is an expansion, really, of this idea of that travel ban from the first Trump administration. So some countries included there. There's about a dozen directly affected: Afghanistan, Iran, Libya there. There are some partial bans as well for individuals from countries from the likes of, say, Cuba, from Venezuela, from Laos. And if we're going to use history as a guide, we are expected to see litigation on this. We're expected to see this work its way through the courts, just like it did, that first Trump travel ban worked its way through the courts. It was ultimately pared back. Trump was forced to make a lot of specifications on what this ban would mean, but in 2018 it was upheld in a 5-4 decision by the Supreme Court. So that expanded the ability that Trump has to enforce immigration, and in a lot of ways this move is playing to his base. There are so many concerns from Trump voters about immigration, about safety. We've seen an expansion of deportations, a continuation of building that wall on the Mexican border. And so this plays into that base who want to see quick wins here.
Charlie, he's had a busy 24 hours, President Trump, hasn't he? Because as well as signing this executive order, he's also been talking to the Russian leader, Vladimir Putin, and divulging a little bit of what the content of that conversation was, in particular around Ukraine.
Anna, this really is the clearest signal yet that Trump's strategy to quickly resolve the conflict in Ukraine is hitting hurdles. Because he had this phone call with Putin. There's not a lot to show for it. Actually, what he has to show for it is a repetition of a Putin talking point that he will need to respond to the Ukrainian attacks deep within Russian territory from over the weekend, when Ukrainian drones managed to hit as far as Siberia within Russian territory. And so this is a sign, again, of some of these promises that Trump made on the campaign trail on immigration, on the conflict in Ukraine, that he could resolve them quickly with engagement. Those are not working right now.
Charlie, there are divisions domestically as well within the Republican Party. Increasingly, it seems fueled by Elon Musk and his pretty determined approach right now to take down this big, beautiful bill, as it's described by President Trump, that is now in the process of being looked at by the Senate. Elon Musk wants to, quote, kill this bill.
Striking words from someone who was at least temporary member of, or at least an advisor to the Trump administration just a few days ago, and who was the largest political donor in the 2024 campaign, who helped Republicans win across the board. Musk is now really taking issue with this $2.4 trillion price tag and encouraging Americans to engage with their lawmakers to try to, end this legislation. And it's looking shaky, right? Because this bill is still working its way through the legislature in the United States. It barely passed the House. We know that there is going to be a lot of debate. There's something of an uphill battle in the Senate because you have, on one hand, these deficit hawks who Musk really is speaking to, who do not like that price tag. You have people more in the center, like a kind of Lisa Murkowski from Alaska, whose state requires a lot of federal funding. And then you have the Trump hardliners. Now, these Trump hardliners have been given something of a gift from the Congressional Budget Office, which is nonpartisan, finding that at least as of mid-May, those Trump tariffs, if projected outward, those would bring in $2.8 trillion. So that would offset the cost of this tax bill, but that's based on a lot of estimates. So basically what we're seeing is a fraying of that Republican coalition that helped bring Trump into power, and signs that this legislation, the signature legislation that needs to be passed, could be facing trouble.
Charlie, thank you very much. Bloomberg's Charlie Wells covering off a few of the items on President Trump's agenda. A busy 24 hours it has been for the president. Coming up, enthusiasm around the Europe story, dominating discussions at one of the world's biggest private market conferences. We've heard a lot about that theme already at Super Return in Berlin. Kriti Gupta is there for us. More from there shortly. This is Bloomberg.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board. I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership.
We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Sentiment has changed. The whole tariff events have impacted mostly, I would say, the growth in the U.S.
Market forces, the so-called bond vigilantes, have woken up those to the concern about the growing deficit in the United States.
They are starting to pause or slow down, at least, their allocations to the U.S. Bomb that people are watching is tax policies and potentially a tax war.
Right now, the big focus is on rates and the deficit, obviously, as the current administration is focusing on their big, beautiful bill.
And this is mainly the result of the global trade war, the risk, the tariffs, although not knowing exactly what the impact will be. But Europe certainly appears more attractive now. And people are seeing Europe as a safe haven at the moment.
Some of the private capital investors that Kriti has been speaking to at the Super Return event taking place in Berlin, discussing the opportunities in Europe. Let's head back to Kriti Gupta. She is at that event and joins us once again. Kriti.
Anna, thank you. As you said, yes, in Super Return in Berlin, where the conversation of the moment is just how long this moment in the sun for Europe actually lasts. My next guest is not only a Europe bull at the moment, but has been for some time. I'm thrilled to say he's flying in from Boston just to see us, I think, is a fair way to say it. John Maldonado joins me right here from Advent. Pleasure to have you. Walk me through the bull case of Europe right now.
So maybe giving the macro bull case, I'll just give the micro bull case. This is how we're experiencing it. I've been surprised at the talk at the conference about the renaissance in Europe. I'm excited about it. It's not really a renaissance for us. We've been here for 35 years. It's our biggest region from a talent investment team perspective. And when we look at the tail of the tape for us, in the last 6 weeks, we've signed 2 deals in Europe. And it happens to be the case that right now we've got 4 deals under exclusivity, all in Europe, and a 5th that's a bilateral discussion heading toward exclusivity. So the level of activity that we're experiencing is not just a future renaissance. It feels like it is an incredibly active time and moment for us in Europe.
It's fascinating because we talked to some of your peers as well who've said actually the pipeline in Europe predates some of this volatility. The timing is just coincidental. But I am curious, there is also this added momentum that you're seeing from funds around the world that are suddenly saying, if you don't want to allocate new money to the U.S., you allocate it to Europe. I'm curious, though, what that does to things like valuations in Europe, what that does to deal absorption in Europe. Is that a concern?
Well, it could be over the longer term, but in the near term, people feel like on the back of a relatively slow deal-making environment in Europe over the last few years, that there's a lot of potential. There's a lot of latent assets. There's a lot of inventory sitting on the shelf in the private equity community writ large. And as you pointed out, there's going to be fiscal stimulus in Europe. There's going to be a rotation away, potentially, from U.S. from a deal-making perspective. It all stands to benefit Europe in the deal-making here.
What gets in the way of that?
What gets in the way of that? Well, if we have heightened volatility from whatever source that affects some of what's happening in Europe, that's going to create a valuation gap. Uncertainty and volatility is the enemy of deal making. If whoever decides to throw some uncertainty in the mix, that could press pause. But on a relative capital market basis, people are more enthusiastic about the capital markets here and the prospects for both taking companies public. And the financing markets have been relatively stable across both sides of the pond.
So talk to us a little bit about that volatility and the effect on capital markets here. 2025 was supposed to be the year for capital markets. All that deal glut that we were seeing, I think for the past couple of years, post-COVID, it was all supposed to problem solved in 2025. Right. We're not there yet. How far do you think that can has been kicked down the road?
How far can it what?
How far has it been kicked down the road?
Well, hopefully not too far, because we're now sitting here today in the 4th year of muted deal making. And as I'm sure people know, you've got $3.6 trillion of just private equity assets that are sitting on the shelf, not to mention non-private equity assets. You got 29,000 companies, and we really do need that inventory to become unstuck. We need the wheels of M&A to begin churning. Other than the volatility and what had been a bid-ask spread, which had been keeping some deal makers on the fence, there's really nothing that should prevent that M&A from becoming unglued.
Talk to us a little bit, though, about that financing that's coming. When you're speaking to your LPs, when you're speaking to other investors, where is the interest coming from geographically?
In terms of where they like to invest, it really depends on the LP, on the customer. So different parts of the world have different focus areas in terms of where they want to go risk on and risk off. There are some U.S. investors that have questions about China. There's some China investors that have questions about U.S.
Yeah.
There are European investors that are trying to figure out who they want to align with. So I really think it depends on which part of the country we're talking about.
So let's bring it back to the capital markets point that you brought up just a moment ago, which is this idea that ultimately, if you don't, say, IPO, if you don't have some sort of deal exit at the end of the day, what are the ways around that in the interim when there is that volatility? Or do you adjust to the volatility and just accept that this is the new norm?
I think you need to adjust. I think you need to be creative. It's one of the calling cards that we put out to our organization, which is you can't really wait and blame the capital markets and say, we just need somebody else or some other market to improve.
Yeah.
We had an incredibly productive year last year from an exit and entry perspective. We had our second best exit year ever, divesting $9.5 billion. Year to date through end of May, we've already divested $4 billion. And we've done that in very creative ways. We've done dividend recaps. We've done regular way recaps. We've done some controlled deals. So the message to the team is you have to think as much about the exits as you do about the entry. If you're not being really dialed in a harder exit environment, you're not going to get the outcome that we need for our investors.
So those workarounds that you kind of just outlined there or alluded to, is that enough to kind of quench some of the pressure perhaps coming from LPs around those deal exits?
It's going to have to be, right? Because we don't know, to your point, 25 is going to be the year. It, to date, is not the year. Everyone's hoping 26 is the year. We'll see if it is the year. But you can't, I famously made the prediction that 25 was going to be our year, and it wasn't. So we can only wait so long. We have to deliver liquidity for our investors. Otherwise, this glut in the system is going to become too immeasurable for us to solve. So it's going to have to be a solution.
Well, talk to us about from a sectoral perspective as well. We've talked all morning about the momentum in the AI space. We've talked certainly in Europe about momentum in more manufacturing or industrial-driven industries as well. We know your healthcare is kind of your baby in terms of your sector expertise. Walk us through those dynamics. Are you seeing bigger valuation changes between the sectors?
So it also depends on the country that you're talking about. So you've got some very idiosyncratic things happening in healthcare in the United States.
Yeah.
You've got some executive orders that could create substantive change in Medicaid, in big pharma, and that is creating, potentially not even a bid-ask spread in terms of valuation, but a question around how do you think about the future of industry? That type of ambiguity does make deal-making incredibly hard. But in Europe, in Asia, and Latin America, you're not dealing with the same type of ambiguity. So deal-making in pockets of healthcare can be as robust in those other regions as they ever have been.
So then very quickly, talk to us a little bit about what that reaction function is in the private markets that are famously illiquid, that operate a little bit slower than the public markets when you're dealing with those kind of changes in the healthcare space. But I feel like you can extrapolate that to an AI theme as well in terms of changes in the environment that you're navigating.
Well, I think it's going to create some pockets of, in the case of healthcare, an even more stuck perception, right? Because if you have an investment in and around, call it the pharma space, the biotech space, some of these executive orders are fundamentally game-changing for big pharma and for the profit pool of everything that sits downstream. And while you don't know whether big pharma is going to have the benefit of the same American profit pool, and the profit pool in America was in no small part the profit pool for big pharma, you think that what big pharma feeds below it in terms of all the service providers and data providers, until you have greater visibility into what they can downstream, you really are going to struggle to find homes for some assets.
A fascinating conversation from a sector perspective, the volatility on a more macro geographic perspective. Well, John Maldonado there. We thank you so much for joining us. We really appreciate it as well. Anna, Tom, that was John Maldonado over at Advent. He's joining us, of course, from Boston here in Berlin, talking to us about the fact that this European renaissance that you're hearing about at Super Return, it's already been in the works for some time, but really coincidentally, the timing is showing up at a time when perhaps you're seeing more of the optimism bleed into the public markets.
Yeah, and the liquidity question as well, really fascinating. 2025, not the year, it turns out. Maybe next year. It has to be, he said, on liquidity. More from Kriti Gupta, of course, from the Super Return Conference in Berlin throughout the day. Just briefly on what else to be thinking about today, what else is on the docket. It's the NATO defence ministers meeting. We've seen Pete Hegseth of the US arriving earlier this morning. That's happening in Brussels. 1:15 p.m. UK time. It is, of course, the ECB rate decision. We're reporting live. Expected, of course, to cut by 25 basis points. And at 1:30 p.m. as we move ahead to non-farm payrolls on Friday, we're going to get US initial jobless claims, so further building out the picture of the labour market in the US. And at 4:45 p.m. UK time, one to watch certainly in terms of the potential optics of this. Germany's Merz, the Chancellor, at the White House. How much tension will there be in the room, or maybe bonhomie? We'll see. Let's bring in Bloomberg's Valerie Teitel for more on the markets right now. And leading up to the session today, there was some anxiety around the Japanese bond auction of the 30-year. And indeed, that anxiety on some measures was justified because the bid-to-cover ratio was a lot weaker. It came in below the estimates. There wasn't as much demand, essentially, for the 30. And yet the market reaction has been relatively benign. Why?
It seems like the market was braced for a worse outcome on this auction. Yes, it was weak. It had the lowest demand ratio since 2023, but it does seem like people were braced for worse news. Actually, we saw some reports of a short covering going on in JGBs, and the yields rallied in the long end. We were watching this because it was only 2 weeks or so ago that a really bad long end JGB auction kind of sparked a global fixed income sell-off. But this time, this morning at least, it did very little to impact Treasury yields. They held on to most of their rally from yesterday.
So two things that long-end bond markets have been worried about, Val. One has been the Japanese auctions, and the other has been fiscal sustainability in the United States. Now, the CBO, we were hearing from Charlie Wells earlier on, they've given some comfort, I suppose, to those who are concerned about fiscal sustainability. Talk us through what the CBO has said and what that means for bonds.
Yeah, I found it very interesting that the CBO even gave an estimate for tariff revenue over the next 10 years, coming in at $2.8 trillion. That's the number that they think that tariff income will be over the next 10 years. There was a lot of assumptions going into that, though, which might, maybe or maybe not, might put these bond vigilantes' worries to bed. They do assume that these tariffs that are currently in place are in place for 10 years, which might be a stretch to anyone's mind.
The current tariffs.
The current tariffs. So 30% on China, the steel and aluminum tariffs, not the higher ones that went in yesterday, but the 25%. Then the 25% car tariffs are also involved. So all the current tariffs are on.
But I suppose they are showing us a way that the maths can indicate that you don't lose money in this bill, that you don't create a worse fiscal situation by cutting taxes.
Exactly. And this might be something that the Republicans might really lean on in order to put the bond market worries to bed. In some ways, look, we had a phenomenal rally yesterday on the back of weak data. Those 10-year yields hit a 1-month low at 435. So in some ways, some of those worries have been put to bed at the moment.
Yeah, Elon Musk not convinced at this point, it seems, on the other side of that argument. When it comes to the data in the US, there's been a lot that's come out this week. We had non-farms on Friday. What is your kind of takeaway right now in terms of the health of the US economy and how much softness we're seeing?
Look, I do think the ADP did cause a lot of jitters in the market yesterday about payrolls tomorrow. We did see the whisper number come down by 15K. So I do think there is some worries that we could get a soft print in tomorrow's NFP.
Okay, so a lot of focus on that. I mean, I've had so many conversations over the years, many years, about ADP and the links into non-farm payrolls and whether there is one, but we'll see tomorrow whether that weakness is replicated.
I think the market is really bracing for the moment we get a negative payroll print.
Yeah,
and,
when will the cracks really show? When will the hard data catch up with the soft data? All these questions continue to be asked. Valerie Teitel, thank you very much for that. Coming up in programming, Bloomberg's Francine Lacroix will be speaking to Fortescue's Andrew Forrest. So that conversation coming to you at 9:45 London time. That is it for the opening trade. From Kriti in Berlin, from Tom and I around the desk here in London. The Pulse is up next. This is Bloomberg.
from our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Treasury yields hit a one-month low as a gauge of U.S. services enters contraction, fueling bets that the Fed will reduce rates at least twice this year. The ECB expected to lower rates today. Traders will be looking for clues on future cuts and the impact of trade turmoil on growth. Plus, Trump's travel ban is back. He also warns that Putin has indicated that Russia will retaliate for Ukraine's recent drone strikes. Now, let's get straight to the markets. A big day for ECB. We also had some movements when it comes to global bond yields because of a lack of appetite in some of the auctions over in Japan. Now, this is a picture overall. S&P futures gained some 0.2%. Look, the 10-year yield definitely in focus. Now, one of my favorite stories on the Bloomberg terminal today is basically looking at the global bond auctions and the fact that they're showing weaker trend as these fiscal pressures grow. You don't exactly know where it ends, but look at for a 10-year yield, the Japan 30-year yield, also a little bit of movement, and then euro-dollar on the back of ECB. Look, 1.1414. If it's not the FX part of things, it's definitely German bunds that I would watch out for. The European markets map, again, we look at some of the equities, but a lot of the movements, if we have, for example, a more hawkish ECB would turn into bunds, but also BTPs. The CAC 40 gains some 0.3%, the DAX similar gains. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London. Now, President Trump's jolts to global trade have dimmed the prospects for European inflation and the economy. We'll discuss what that means for the ECB with Soren Rada. He's head of European economic research at Point72, also a former ECB economist. We'll take you live to Frankfurt, where the European Central Bank is set to lower interest rates for an 8th time with Lizzie Burden. We'll also discuss the backlash against President Trump's tax bill, Vladimir Putin's latest warning with Ross Matheson our EMEA News Director. So thank you all for joining us. There's a lot to discuss, and of course there's ties between everything. Roz, I mean, I find it incredible. Day two, Elon Musk is still really pushing against the tax bill that Donald Trump has put in place. I mean, he says it's killing Trump, or he's pushing Americans to, quote, kill Trump's bill. Another big escalation.
Well, that's right. He's obviously overtly campaigning against this bill at this point, particularly against Republicans. And the question is, does this end in some kind of showdown with Donald Trump? Because the US president is devoting a lot of his time to get this bill through. He's hours on the phone in his office, lobbying to get this through the upper house in the US and to do so quickly. And so they are going on a bit of a collision course with each other, even though they're still overtly maintaining that language of not criticizing each other directly and personally. There's no way that this doesn't come to a head in some fashion at some point, because this is something that Donald Trump has staked everything on, is getting this bill through, getting his tax cuts done and so on. And, Elon Musk just is out there actively trying to stop it. It shows again how complicated this bill is. It's going to be very difficult to get it all through the Senate properly without a bunch of changes that go back to the House. This bill is getting mired very quickly. We've seen clashes between Musk and Trump before. We've seen them disagree before, but they've still maintained the lack of personal criticism of each other, because in a way they need each other. It's sort of like mutually assured destruction in a way, on a business and financial side. But, does it come to a head, and who's the first one to do it?
Yeah, and Zoran, this points to actually a lot of fiscal pressures worldwide. You can see them in certain European countries, but certainly the U.S., where we're seeing that more and more.
That's right, absolutely. I do think, as you say, it's a pressure point in the U.S. It's a focus point for markets. Less so in the euro area, and I think that has a lot to do with the way that the fiscal impulse that we're expecting is distributed, with Germany taking the lion's share of the fiscal burden here, and Germany has, by all accounts and standards, the fiscal space to do that.
In politics, Roz, when you look at what President Trump has been doing, there's another executive order, and this time announcing a travel ban from at least a dozen countries. It feels like Trump the first time around, because I think he's done something very similar. What do we actually know?
Well, that's right. It is reminiscent of his first term, but as you say, about a dozen countries are on this list: Somalia, Sudan, Libya, Iran. Afghanistan is also a notable one, and that's where he might come in for some criticism, but it's off the back of that attack in Colorado, where there was an Egyptian man who overstayed his visa, and so he's saying it's a response to that. But it's also bound up in this whole environment of him, being very tough on migration in general, the crackdown on student visas on universities, and trying to manage who's coming into the US, and also trying to send people, frankly, back out of the US. This is a list of countries that probably wouldn't surprise anybody. Is it going to be a massive influx in or out? Probably not. But there are some very talented people emerging from these countries, even if they're, countries that have been fragile and underdeveloped, who could be assets to the US from an R&D or a science perspective or so on, or come to universities there and really contribute to the US economy. And those people may not be able to come anymore. But it's more about the overarching message from the US under Trump, which is very tight control of who's coming into the country and who's coming out.
Yeah, and Soren, we'll talk about ECB in a second, but actually to some of these, small points, but important points, it goes to the heart of actually what Donald Trump is trying to do in terms of trade. And it's create a kind of new world order. We don't really know where it ends up, and maybe a lot of things will be broken in between. What does it mean for the world economy, for the U.S. economy and Europe?
I mean, you're right, it goes well beyond trade. Trade is one big aspect of it, but I think, there are shifts in institutional orders. There are shifts in alliances, global alliances. To be seen what it means for the US. We are projecting that growth is going to slow down strongly in the second half of this year on the back of real incomes decline as tariffs affect inflation. In the euro area, there will be a drag, but on the other hand, the political developments have catalyzed, as already alluded to, a fiscal response. And so if you, on a forward basis, I think there's more optimism. And also speaking to what you were just alluding to, Europe if you will, is an island of stability in a sea of political uncertainty.
Depends on which country in Europe.
That depends on the country. But, you know, by and large, if you look at institutional stability, I think that's the pitch that Europe has to make.
Yeah, and we, we've talked about this quite a lot to see whether this is a moment that Europe can seize. I don't know whether you'll see, Roz, also Europe trying to play a bigger role in this Russia-Ukraine story, because it does seem like it's Trump dominating headlines, and whether they'll succeed.
Well, they've always been trying to stay in the room on it, and the struggle has been to be in the conversation and to be in Donald Trump's ear. I mean, obviously, the German Chancellor, Friedrich Merz, by the way, is in D.C. today, meeting with Donald Trump this evening, so we'll see how that goes. But as Donald Trump, increasingly seemingly walks away a bit from being an active player in trying to resolve the Ukraine-Russia conflict. I mean, he did speak with Vladimir Putin yesterday, but the call was quite inconclusive. And he said himself, this is not a call that was going to lead to peace. Is he leaving others to get on with it? His idea has been Russia and Ukraine should talk directly and continue to talk directly. Leaders should talk directly. This might be an opportunity for Europe to get back into the conversation, certainly continue to support Ukraine militarily and to find ways to buffer Ukraine to hang on, frankly, in the conflict if it's not going to resolve itself quickly.
Okay, so Soren, let's talk about the ECB. Let's go to Frankfurt, where the European Central Bank is set to lower interest rates. Lizzie Burden joins us now. So, Lizzie, the last easy cut, or certainly one that's priced in, walk us through the debate around what comes next.
Well, as you say, Francine, it could be the last easy cut. Easy because it's now 1.9% where inflation is across the euro area. It fell in the May data at the core headline and services levels. But it could be the last easy cut because from here on out, the outlook gets really murky. First, in the short term on the tariff front, because, as you say, we just don't know whether the US is going to raise tariffs on the EU from 10 to 50% at that July 9th deadline. We just don't know how the EU is going to retaliate. And as Ros reminds us, we've got the German Chancellor Friedrich Merz at the White House today trying to calm those tensions. But then there's also the longer-term impact of the fiscal boost on defence and infrastructure spending. We just don't have concrete details yet of what that's going to look like. Maybe we'll get some more at the NATO summit later this month. But because of all of this uncertainty, not only is the ECB today going to publish its updated growth and inflation forecast, they're also going to publish scenarios to try and account for all that could happen. But this is why the question then turns to, do they cut in July again, or do they wait the summer and go again in September? The argument for waiting would be that, inflation could go up again. Consumer inflation expectations for the year ahead are at 3.1%, the highest since last February. But the argument against going now is that, it could create so much uncertainty in the market if traders think that actually the pause is an end to the rate cuts. And that's the last thing Christine Lagarde wants to do. She does not want to create more surprises in an already volatile market. And so I'm sure she'll keep her cards very close to her chest in the press conference today. And we'll hopefully hear more about her future at the ECB, Francine, because there's been a lot of speculation that she's going to lead the World Economic Forum. She hasn't denied it yet, so I'm sure it's another one that will come up at the press conference.
Oh, I'm sure she'll be asked many times. Lizzie, thank you so much. Lizzie Burden there in Frankfurt. So when you look at the ECB, there's a number of questions on actually, is there a worry that inflation consistently undershoots for quite some time? And how many cuts are you expecting from the ECB?
Yeah, so obviously the cut today, that's really, if we're honest, a sideshow. I think the main event is the forecast.
It's forward, yeah.
Exactly. Where we are, as Lizzie alluded to, expecting a notable undershoot, so 1.7% in 26, 1.9% headline in 27, and below 2% core inflation forecast as well for both those years. That, in our mind, together with downside risks due to trade and benign inflation prints in May and June, should catalyze another cut. So we're looking for another
September?
cut in July.
July.
And then,
that's bold.
Well, they're coming from a cutting sequence where they've gone every meeting. They're probably not going to tell us today that they're cutting in July. They're probably not going to think that they will be cutting in July. But Our view is the data will push them there, and just the global environment and the trade uncertainty, which we think will persist beyond July 9th.
Søren, overall, I mean, there does seem to be, the surveys are ugly, but actually it hasn't really translated into bad data in Eurozone or actually elsewhere. Does it take time actually to translate into the real economy, or could the economy hold up?
Certainly. I think there are two things. One, you've got the tariff front-loading effect, and that is very clearly visible in the Q1 numbers. We'll get the breakdown tomorrow, actually, the expenditure breakdown of the Q1 GDP numbers. I expect there was a significant boost from net exports on the back of tariff front-running. Today's German orders print for April already suggests that front-running effect may be fading, and there was some strength in underlying orders, but we haven't seen the tariff effect. That should really still come in the data from May onwards in the hard data.
Ross, what do we know about? I mean, it was interesting to hear Søren say that actually Europe is relatively stable, which is true in terms of institutions. I mean, question marks in terms of politics. But what do we know about that visit of Chancellor Merz? He got off to a really bumpy start. He seems to be in better hand. But anything they do on defense spending won't actually filter through the numbers in 26 or 27 even.
Well, that's right. But, I mean, Germany has done a lot. I mean, it's a fundamental shift to have lifted the debt brake and to open the ability to spend a lot more. I mean, the challenge for Germany is less having the money. It's how to spend it and how to get through. There's a lot of regulatory issues and things that slow things down in Germany. In a way, it's about freeing that up to allow that money to flow and to flow where it's needed. For Friedrich Merz, this meeting with Donald Trump will be an interesting one because, of course, he's probably looking at some other leaders who've traipsed through the White House and had, you'd say, problematic experiences in the minute, because Donald Trump likes to hold court when they're having the start of their meeting. And I'm sure Friedrich Merz has been preparing for all sorts of possibilities to come up in that minute. And again, what is his goals to get out of this conversation with Donald Trump? And what does he want to put on the table with Donald Trump? Probably getting away with the meeting without any issues might be a goal in itself, you'd say, at this point in time. But it's also about showcasing again that Europe is stepping up, and that's coming into the idea of NATO soon. Europe is very keen to show Donald Trump, we've heard you, we're listening, we're spending more, we're pushing a lot of money into our own defence to be more self-reliant, and we're taking the burden off you as a result.
So, if you look at, at all of that, these complex issues, and you're, of course, the expert on the European economy, is this Europe's moment? What can they do, fiscally from a also policy point of view to actually, I guess, counter the US but come up trumps?
Yeah. So, like you were saying, the German fiscal package is big, it's bold, it's very un-German in a way. 1.2 trillion over 12 years. That is going to boost German GDP quite considerably. We, think, or we estimated that it boosts GDP by about 1.5% over the term of this government, and that's probably understating the effect. The plans, the spending targets they're putting forward are more ambitious than what we thought they would be, especially on defense. So there could be some upside surprises there. The issue is a little bit, Germany's not the only game in town in Europe, but is the main game in town by a very large margin. So at the euro area level, we have a boost of about half of that in Germany, which shows you that, that is not matched elsewhere. And I think this is where the question marks are. That speaks to the, NATO summit, the potential 5% commitment to defense spending, and how to deliver on that. And my expectation would be, we're not going to see short-term fireworks in Europe unless there is an external threat, but it's going to be the long game. But that long game will come.
So interesting. Thank you both for joining us. Søren Rudde, they're the head of European Economic Research at Point72, and Rosalind Matheson, our EMEA News Director. Now, coming up, we discuss M&A in the European media industry. That's next, and this is Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Now for a topic close to home for us, the media industry. Czech holding company PPF Group recently announced its offer to increase its stake in the German media firm ProSieben as it attempts to oust rival bidder Italy's MFE. Well, joining us to discuss the latest is Didier Stoessel, the Chief Investment Officer and incoming Co-Chief Executive of PPF. Mr. Stoessel, thank you so much for joining us. Look, there's a lot going on, of course, in the industry, in the media. What are you expecting to change for you in the next couple of months?
Good morning, and thank you for inviting me. Yeah, it's always a pleasure to be on your show. For your viewers, probably a lot of them don't know PPF, so I will give you 2 minutes to tell you who we are. We are an industrial and investment company. We are family-owned, which means we have a very, very long-term vision of all our investments and very patient capital. We have 5 verticals. Telecom, media, which we will be talking with you for, banking, banking and financial services. We also are very strong in logistics. In the UK and France, InPost, our out-of-home company, delivers over 700 million parcels.
Mr. Stoessel, do you think your partial tender offer can be successful, given ProSieben's shares have been trading at or above, actually, €7 in recent weeks?
I mean, when we launched the offer, as you know, the premium was around 20% to the then price on the market. And I think that people also compare offers. If you look at the cash component of our offer, €7 versus the 4.4 euros approximately of MFE, clearly that's again more than 20% premium. So yes, we do believe, we are quite confident. We do believe we also offer an alternative which might suit many investors, because this restructuring or this change or digital changes for the group are not easy to do, which means that it will take time, so people can either cash now or cash partly, or wait with us and benefit from the restructuring that we hope we will be able to launch.
Do you think you'll have to go above €7, or actually do you see a chance to team up with the rival bidder, MFE, at a later stage?
I mean, as you know, our offer is €7, and that's what it is. It's already 20% premium to what the share price was before. And as you know, it's a non-controlling offer. So 20% premium for a non-controlling offer in the German market is absolutely the right one to be. I mean, we always said from the beginning, MFE is there, they have 30%. So by definition, we will have to work with all stakeholders, including them, to make sure that this company goes in the right direction. But they should be welcoming this, because if the company gets better, by definition, they should be happy as well.
But so is it possible that, let's say in a year, you actually team up with MFE and do something jointly? Or is it too soon to think about it?
I mean, it is too soon, for sure. But, you know, as I said, after this offer, we would be, both of us, at 30%. So by definition, you know, we need to try to work in the interest of the company, in the interest of all shareholders, including, obviously, PPF, MFE, and the remaining float. So it is clear that we will need on the board to have the right discussion. That's what we said. That's why we said, let's have a bit more enhanced presence on the board, so that we can push harder this digital transformation.
What do you think the future of linear TV is, Mr. Stossel? And given your incoming co-CEO, will you also push for a lot more of a presence in the U.S., or is there another strategy that you'll pursue?
I mean, we're a European media group, and that's where we will stay. Yeah. If you look outside of the 6 countries where we are in CE, we are also together with Canal Plus in Viaplay. Yeah. And that's a good example. You know, you were asking about MFE and us in ProSieben. In Viaplay, Canal Plus and us are working very closely together and in great harmony. And I think the progress that has been made in Viaplay, which is, you know, the sort of Netflix of Europe, if you want to call it like this, have been quite tremendous in the last 1 year. So no, we're a European group. You asked about linear TV. You know, I've never been somebody saying that linear TV is dead. You know, I'm sure you're interested, as we are. You know, we are all working in this industry. You know, I strongly believe that the way the industry is going is the content you are right now producing, or we're producing together, has to be distributed on every medium. One of the medium will be linear TV. One of the medium will be computer screens. One of the medium will be over-the-top platforms. One of the medium will be subscription-based VOD. One of the medium might be your websites or your terminals. So all of this is what media is becoming, which is we are content producers, and we're using all the medium possible in order to get the best distribution and reach. So no, I'm optimistic.
Thank you. Yeah, and we're cross-platform, so this will, of course, also be distributed cross-platform. Didier Stossel, thank you so much for joining us today. That was the Chief Investment Officer and incoming Co-Chief Executive of PPF. Now, the German Chancellor, Friedrich Merz, will meet President Trump in the White House later today. Merz has veered between boasting about common ground with Donald Trump to bemoaning the U.S. president's volatility and even mocking his bravado. Now they meet for the first time face-to-face. We're joined by Chad Thomas, our Europe Executive Editor. Chad, I'm nervous for him. What can we expect?
Francine, you know, usually when you have these first meetings, they're very ceremonial, and we as journalists are kind of like, yeah, there probably won't be that much that happens, but people will be watching very closely today to see exactly what happens when Friedrich Merz is in the White House with Donald Trump. Will there be one of these things where he turns down the lights and shows a video and asks Merz to respond, as we saw with Ramaphosa, something that happens with that happened with the Ukrainian president, or will it be a more sort of usual kind of discussion? We're told by Merz's people that he is prepared for all eventualities, and that he has said to his people that he will do everything possible to not get into any sort of an argument with the president. So, you know, we'll all be watching closely to see exactly what happens. I think for Merz, if he comes out of it with there out being some sort of a blow-up, that in a way is already a win.
What are the topics, Chad, likely to be discussed?
I think that you'll certainly have a discussion around trade and tariffs. The German automotive industry, of course, is hugely important to this country. More than 800,000 people work in the automotive industry, and the U.S. market is an absolute key market for German automakers. And of course, President Trump, that is something that he often goes on about, is the German car sales in the U.S. So that will certainly be a topic. I think you also will want to watch to see, does he bring up the far-right populist party here in Germany, the Alternative for Germany party, and whether he says anything about freedom of speech, like Vice President Vance did at the Munich Security Conference. So those are some of the key topics that we'll be watching when they speak.
Chad, thank you so much. Chad Thomas, our Europe executive editor. Coming up, U.S. Defense Secretary Pete Hegseth in Brussels urging NATO allies to ramp up defense spending. We'll get the latest next, and this is Bloomberg.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running it like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Treasury yields hit a one-month low as a gauge of U.S. services enters contraction, fueling bets that the Fed will reduce rates at least twice this year. The ECB expected to lower rates today, but traders will be looking for clues on future cuts and the impact of trade turmoil on growth. Plus, Trump's travel ban is back. He also warns that Putin has indicated Russia will retaliate for Ukraine's recent drone strikes. Now, U.S. Defense Secretary Pete Hegseth is urging NATO allies to commit to a defense spending target of 5%. Well, let's get straight to Bloomberg's Andrea Palasciano in Brussels. Andrea, thank you for joining us. You're at NATO headquarters, so tell us more about this crucial summit.
So this is the last meeting of defense ministers before the summit in The Hague in just a couple of weeks. And this has been a chance for Pete Hegseth to hammer it home once again. Trump wants allies to commit to 5% spending on defense, which just a few months ago seemed a totally unrealistic demand. But it actually sounds like they are getting there. And today they are signing off on extremely ambitious new weapons targets. And that's going to be the last milestone before they actually make it to the summit. And political consensus has emerged. They have accepted this demand, and they want to keep Trump happy, basically.
So why is it so important for allies to keep Trump happy? Do they worry about retaliation, or do they need the U.S. for something?
The allies absolutely need the U.S. to be committed to NATO, to leave no trace of doubt that the U.S. is fully committed to NATO, simply because the U.S. is NATO's most important member. They bring more than half the military capacity to the military alliance, and most of the enablers, the nuclear shield, most of the things that make NATO the most powerful military alliance in the world actually comes from the U.S. And so if the U.S. isn't fully committed, then the whole construction crumbles, basically.
So, Andrea, of course the alliance should not directly discuss peace negotiations because NATO is not formally involved, but they will discuss the threat of Russia and the threat that Russia poses to them. What impact will the peace negotiations have on NATO?
It is correct that NATO has zeroed in on Russia as its main threat. Just a few years ago, there were still other threat factors identified, but at this point, NATO is really, really laser focused on Russia. And so whatever happens between Russia and Ukraine will be of the utmost importance to NATO, because this war is the biggest land war since World War II, is literally happening at NATO's borders. And the situation on the border, on the eastern flank, is not that straightforward. There have been incursions, there is increased cyber and hybrid threats reported, and so NATO is really aware of the fact that its border with Russia and with a major conflict zone is actually quite fragile.
Andrea, thanks so much, as always. Andrea Palasciano there in Brussels. Now, money managers showing renewed interest in Europe as a destination for investment, with many seeing the region as an area of relative economic stability compared to the U.S. Let's take you live to Berlin, and join Bloomberg's Kriti Gupta for day 2 of the Super Return Conference. Kriti, over to you.
Francine, thank you so much. As you said, we are here in Berlin at the Super Return Conference, where Europe is a question mark a little bit. There's so many folks here who are really bullish on Europe. They're saying that this is the moment for Europe to finally shine. Others are saying, well, maybe this is just a tactical turn when it comes to allocations. And you still have to be thinking about where the capital markets actually are in the big scheme of things. I have the perfect guest to talk about both of those topics. Gabe Caio over at General Atlantic. He's the co-president, head of EMEA there. Joins me right here in Berlin. Thank you so much for joining us.
Thanks for having me.
Of course. Let's talk about these capital markets here. We had this conversation a little less than a year ago that 2025 was supposed to kind of be a reawakening for private markets. They were finally going to pick up in terms of deal making and see these exits. What happened?
Oh, listen, I think there's a bunch of different trends that are happening, and I got to tell, I'll start by saying we're mostly optimistic. I think in your question, there's kind of 2 aspects, is what's happening to the public markets, and that's a topic I know you and I have debated over and over again, and in a way, it's kind of failing mid-market tech companies. Because if you look across the different European markets, there's almost no representation of tomorrow's industries and technology, right? Whether it's 0.3% at the FTSE or 5% at the DAX, it's really underrepresented. And the bad side of that is it creates a lot of tension and access to capital for great companies. The good side of that, with an optimistic hat on, is for the private markets, it means our opportunity set is much bigger than it's been in the past. One of our biggest competitors has always been the IPO market. And as it's failing this segment of the market, we're jumping into that and finding unbelievable deal opportunities.
But is there pressure on that? I mean, isn't the go-to phrase in private markets that when you're looking at the deal, you got to look at the deal exit as well. But how much visibility is there on that side of things?
It's definitely been a disruption. If you take a long enough period of time, we've kind of always equally exited companies out of strategic sales, sale to a later stage investor, or the IPO. And the truth is, since the 22 correction, the IPO markets have been completely unpredictable, right? And I can't remember a time in my career where IPO markets were shut over this long period of time. And so it does make it harder to think about liquidity, in particular for, I would say, very large cap companies or companies that need big access to capital. The flip side of that is we're a very creative industry. I think we're going to find other ways to get liquidity. That message is very clear from our LPs that after a period of massive investment, it's time for us to return capital. I think we feel let down by the IPO markets, and now it's a chance to build liquidity elsewhere.
So the consensus idea, I think, when it comes to the public markets at least, is that volatility is here to stay for years, perhaps. What do you do in that environment? Is the playbook to just kind of hold on to the assets longer, or is it to lean into the volatility? What do you think?
Listen, the problem with volatility is it's kind of the death of capital formation, right? When volatility spikes, you see public markets shut down, and private markets struggle as well to deal. As I said, that's been our biggest opportunity in the new deal-making front, because we've taken advantage of volatility, honestly, to price deals in a way I hadn't seen in almost 20 years. So it's been a really appealing market. I think when it comes to public capital formation and creating liquidity, I think we're going to have to resort to either new forms of liquidity, whether that's the secondaries market, or, to your point, holding on to great assets. If you think about that opportunity for investors, why not hold on to your best assets? I'm a huge believer that private capital is a better product for our investors. We've delivered alpha, but it's a better product also for entrepreneurs. The type of companies we invest in are growing 30, 40%. We help them with that. Public markets penalize them for not doing things. And so I think there's a natural and healthy aspect to longer duration in privates. Of course, LPs need to sign up to that.
Let's talk about how that all applies to Europe specifically. Yeah. Europe's having this incredible moment. It's attracting so many fund flows in the public and the private markets as well. Walk us through how long that lasts.
This is an interesting question because I don't think it's this big of a massive I see this more as a rebalancing than a huge shift. And in our markets, which are really driven by innovation, it's hard to ignore the amount of innovation coming out of the U.S. But I do think what you're seeing a lot of investors realize, and it's something that's been present for years, is after this perception of U.S. supremacy, right? What they've realized is actually European markets are cheap compared to the U.S. Whether it's the public markets where Europe is at a 30, 40% discount, you see the same thing happening in private markets, even though the fundamental trends behind them are just as strong. Now, we don't have strong GDP growth, we don't have the same rhythm of innovation, but we're still the second largest consumption bloc in the world, and we're somehow in a lot of trends behind what you've seen in the U.S. and in China, and people are playing catch up on that theme. So I haven't seen yet, at least in our private markets, this complete shift of exposure from U.S. to Europe. What I do see is people realizing that actually Europe is a nice risk return compared to other markets.
But even in that rebalancing, there is still trillions, frankly, in terms of going to Europe as well. And I'm curious what that does in terms of absorption when it comes to Europe. There's only so many deals, one would argue, in terms of being able to catch up with that kind of demand. And I'm curious if there is a question here of either higher valuations or simply the idea that maybe there's a potential liquidation of kind of longer duration assets in the long term. How does that show up? Could there be a scenario, not too distant future, where there's too much supply and not enough demand?
We haven't seen that yet, and I always try to remind people that as big as the private equity industry's become, we're still tiny compared to public markets, right? We're an 8 to 10 trillion industry if you're generous. Public markets are 130 to 140 trillion. And so we're very small. And as I said earlier, I think we're a superior product for companies. I don't know why we shouldn't be gaining market share against publics as entrepreneurs choose their capital source. So I'm a big believer that private markets are going to continue to grow. I think your question is, there's also a tactical aspect to this, which is if there's a huge influx of capital around European deals, how does that supply-demand balance continue to move? I think the appealing part of the market right now, and if I was an LP committing capital, I would look at why are deals being won by private equity investors? And the subtle change that's happened from 21 to today is companies are not selling themselves to private equity more. They're looking for partners. Like the discussion we have with entrepreneurs and CEOs is how do we convince them we're the best partner for their company? And that debate allows us to differentiate ourselves a lot more and kind of protect ourselves against this risk of overcapitalizing a certain market. I think in other markets, that's not the case, right? I think the intermediated market has become highly competitive again, which is a little bit surprising given the volatility you're seeing in publics.
A little bit of cautious optimism over at General Atlantic is what I'm hearing.
Maybe.
Gabe Caillot joining me right here in Berlin at Super Return. Talk to us a little bit about what that allocation looks like. Is it that moment in the sun for Europe? Does it last? He says it might be a little bit of both. Francine.
Kriti, thanks so much. Great job out there. Kriti Gupta with the very latest, of course, from Super Return. Now, it was no ordinary Wednesday for gaming fans in New York. They spent the day, some of them spent the day waiting for the Nintendo Switch 2 to go on sale at midnight. Now, the console is the first major release by the company in over 8 years. With most of Nintendo's revenue tied to the console's success, the pressure is on to ensure another blockbuster. Well, Bloomberg Originals takes a closer look.
It's hard to overstate how important the Switch is for Nintendo. Almost all of its revenue comes from this one product, or the exclusive games the company develops for it. Its popularity since 2017 has driven Nintendo's share price to an all-time high. And everything's riding on the Switch 2, keeping that trend going.
The stakes were very high. Nintendo is at the most successful point in its history.
And here's why. The Nintendo DS, 154 million sold. The follow-up 3DS, 76 million. The Wii, 102 million sold. The follow-up Wii U, oh dear. And the Nintendo Switch, almost the best-selling console of all time, 152 million sold. No pressure then.
Switch 1 created a very high hurdle for the future consoles to surpass.
So Nintendo's breaking new ground with some very subtle shovels.
It's the first console in Nintendo's history that is kind of the same thing, but just a little bit bigger and a little bit better.
That strategy belies decades of corporate lessons learned sometimes the hardest way. But this time, the stakes are just too high for history to repeat itself.
Let's go!
Well, subscribers can watch that documentary on the terminal and Bloomberg.com and, of course, on the Bloomberg Originals YouTube channel tomorrow. Now, for more on Nintendo, let's bring my fellow gamer, Charlie Wells. Charlie, so first of all, I mean, this feels very significant. I know it'll probably be on Christmas lists and, birthday lists, but how significant is it?
I mean, Francine, literally as you and I are sitting here speaking, there are consumers across the world who are lining up to buy the Switch 2. They have been waiting for hours. They've been looking forward to this for months. And a lot of the excitement that we're seeing today outside these brick and mortar stores, we've been seeing in the share price of Nintendo over the past few months. So this year, Nintendo's share price hit the highest point ever. And recently, in recent days, it's been kind of flirting with that high point as well. And this is a huge moment for Nintendo because their revenue growth has been slowing over the past few quarters. And so they really need this to be a blockbuster. We're in early hours right now for this launch, but so far it's looking pretty good for Nintendo.
Okay, I know you and I will try it shortly, but in what ways is the Switch 2 launch showing us how firms are navigating the trade war?
This is what is interesting beyond gaming, right? Because literally, Nintendo's fortunes have been so linked to free trade, to globalization, to global trade. If you think about the day that Nintendo announced the prices for the Switch 2, that date was April 2nd. I think we all remember April 2nd was also the day that Donald Trump announced global trade tariffs. And so, Nintendo shows us kind of how firms have been kind of trying to navigate potential price pressures here. One strategy early on that they deployed that they have said that they could maybe change is keeping that core Switch 2 price the same, $450 in the United States, but rising the prices of accessories around it. So that is one strategy we're seeing some firms deploy as they navigate these tariffs.
Okay, I think last time I played anything was like a Nintendo Game Boy.
At an arcade, yeah.
Charlie, thank you so much. I know it's a really big deal in terms of business and money. Charlie Wells there with the very latest on the Switch 2. Now, coming up, we're in conversation with Fortescue's Andrew Forrest as the mining executive turns his attention to saving the oceans. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Now, mining and shipping amongst the biggest contributors to global emissions, but one mining leader is really trying to clean up the industry. Australian miner Fortescue is aiming to eliminate all emissions, both in mining operations and in the shipping of minerals around the world. We're joined by Andrew Forrest, the executive chairman of Fortescue and founder of the Minderoo Foundation. Now, he made his wealth on land, but has really turned his attention to saving the seas and even has a PhD in marine ecology. Andrew, thank you so much for joining us. I love our conversations because you're always so passionate about what we should be doing and always so frustrated by what we're not doing. So you've been a long-time opponent to deep-sea mining. If you look at a lot of the things that, is getting serious, is that one of your main worries? I mean, it feels like, again, it's back.
Yeah, look, probably not a priority. It's switching off the heavy polluting part of shipping to completely environmentally friendly fuel. It's protection of all the marine life in the water column. And then, of course, deep-sea mining. It's a complete farce. Thinking you can mine the land bed with atmosphere above it with different rules to make sure you're ecologically responsible. You can put it back the way you found it. Could be different, but it won't be worse. Or the seabed with the water environment. The land bed and the seabed should be treated exactly the same. If you can't do the ecological, longitudinal studies like over several years like we have to do in mining, don't complain. Don't say, well, it's not economic. That's your fault, mate. Don't think you can just go and rape and pillage and leave the destruction to everyone else just because you whinged about not being environmentally responsible like we have to be on land.
Yeah, and Andrew, I know you've also funded this pretty incredible movie by David Attenborough, showing, how basically the oceans are being destroyed. But do you think it's getting worse? There was, I guess, a humanity, level of consciousness. Is that getting worse because of the Trump administration and some of the things that they're pushing through?
Yeah, I mean, there's just a monumental short-sightedness. I mean, if you're acting for your people, if you're acting for every American, you want to turn the oceans from scarcity, where they are now. They're going over a cliff with ocean biomass, with fish populations. It's literally going over a cliff, Francine. So if you want to arrest that scarcity, which is coming at you like a freight train to every single American, every single European, every single person, if you want to arrest that scarcity and turn it to abundance, then you have to do the simple economic, commercial steps to protect it and to make sure those oceans become flourishing. And if you protect the big secret, which is revealed by David Attenborough in our film, is the big secret of the miracle of the oceans. If you preserve 30% of your oceans, you can literally fish the other 70% forever. I mean, it's like a bank account which never runs out, or an ore body. You keep 30% of your ore body, you can mine the other 70% forever.
Is there the will to do that? Because there's also trade tariffs, and I'm going to ask you about, copper, iron ore. It just feels like there's a lot that people are anxious about. So where do you think the leaders' priorities on some of these things are?
All I can say, Francine, if you're a leader without a business brain, peril for your people. Okay, absolute peril, because business drives everything. Now, responsible business is regulated by responsible leaders. So if you don't protect 30% of your oceans ecologically, and you're willing to let the 100% just disappear because you didn't realize there's a proper commercial business reason to protect the 30%, then you're betraying your investors' faith in why they elected you.
How's the UK doing? I mean, I know you have big investments here.
Yeah, we have very large investments here. Look, I'm saying to the UK, I'm saying to the EU, I'm saying to North America, saying to Australia, the science is now resolute, it's inarguable. Protect 30% of your oceans, you'll have flourishing oceans for the rest of humanity. Don't do it, we're going to exhaust them and extinct them.
I know you also always have great thoughts on, the world economy, rare earth and things like that. Where are we right now? Early June, do you worry that it's all going to go wrong, given the uncertainty, the fact that chief executives don't really want to spend, and actually the fact that trade is now because of allies, not, economic sense?
Okay, so that's a very broad question, Francine. Look, I'm completely convinced that you can fool some of the people all the time, or all the people some of the time, but you're not going to get away with all the people all the time. And so people know tariffs are not a tax cut. People know it's an imposition, it's inflationary, it will cause economic distress. Fine. If you want to do that for your people, that's fine. But that truth is going to come out in the next year or two, because you've already got escalating prices in North America. Yeah. You've already got goods and services becoming scarcer. It's not working. So go back to free enterprise, go back to free trade, protect human rights, absolutely, and protect your environment. They're great investments. I mean, if these are great investments, any business person with half a clue are going to know this is a good investment.
I mean, when you look at the energy transition, but also AI, we need more copper, we probably need more lithium, and some of the materials that are used in this transition. What does it mean for Fortescue?
Look, I've been approached by two countries, which I shouldn't mention, who have enormous copper deposits and other deposits, enormous lithium. I don't think lithium's so sexy these days, because we're watching other technology, just using salty water, looking really sexy. But let's just keep to it. The countries which have big deposits of this, and they've approached me to say, could you lead us into a responsible mining industry which is fully green, and at the end of mining, we won't really be able to tell it's been mined? And I said, yes, I can. So I have no doubt that the world has abundant copper, abundant anything on land without having to go and destroy the oceans.
Yeah. So are you diversifying into copper? I mean, look, iron ore has definitely fallen from the highs. I know you put a big bet on green hydrogen, and that's being a little bit delayed compared to your ambitions.
Well, look, I put a big bet on going green. And so green hydrogen, all that happened is that people decided, because, that we had massive, like hundreds of millions of bots just blasting through Europe and North America saying, hey, now's not the time to be considering anything uncertain. Look at your cost of living. Let's worry about this. Let's stick with what we know, oil and gas. That was just one big fraud on the people. If you want to lower your cost of living and increase your standard of living, you go green. And so, but people like us, people like me, are the people responsible. It's not you or everyone watching this show. You should be able to consume, travel, do what you want, but you've got to hold people like me to account. I want green steel, Forrest. Don't give me your dirty iron ore anymore. I want to be able to ship my goods knowing that I'm not harming the environment. The cargo pays for the ships, nothing else, not the fossil fuel. The cargo. People who want to travel, they should be demanding, listen, we want to know when we fly there's no harm.
But it's at a cost, right, to you? So how many people have a conscience?
Is it R&D is normal. I hear this number that it's going to cost $2 trillion to convert. Well, wow, okay. What do you think you're spending, planet, on fossil fuel a year? Oh, a couple of $1 trillion. So what we're talking about is like a year payback. I mean, it's just ridiculous. The reason why we're not is an expense. It's that the fossil fuel sector and weak politicians are just saying, let's just do nothing. Isn't that great? And no, it's not great. Actually, you're there to lead. If you say you can't do it, get off the stage and let in someone who can, because you'll be right, you can't.
Who do you think is the best leader in this?
Oh, look, I'm not going to
choose a favorite.
I'm not going to choose a favorite. Thank you, Francine, for the question.
Talk to me about LNG, because you're planning to import gas into Australia, but it's one of the top LNG exporters. So how will that work?
Okay, so that is a very large facility which sits in the middle of Australia's industrial area, basically saying there is no need for future 50-year life oil and gas projects, which are going to cost 20, 30, 40, 50 billion, end up being a big cost to the taxpayer, huge environmental consequence. This is sitting there saying, you want to do that? I'm going to switch this on. I'm going to bring in cheap gas from overseas. Your project's going to be unviable. And so it sits there, literally as a conductor, saying, okay, as soon as Australia needs extra energy, we're going to switch it on. As soon as we possibly can after that, we're going to be using it for hydrogen. So it's a facility which is already paying dividends.
So interesting. Andrew, I could talk to you for another 5 hours, but you have a job to do. And we have to go to break. Andrew Forrest, Executive Chairman of Fortescue and founder of the Bindaroo Foundation. Coming up, the U.S. House Speaker Mike Johnson will appear on Surveillance a little bit later. That conversation is at 12:30 p.m. London time. Up next, we look at Japan, the U.S., and of course Europe. Bloomberg Brief. That's next, and this is Bloomberg.
In New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Are you worried about your borders because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia, but now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person not managing that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to governments. And so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected,
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's 5 a.m. in New York. Good morning. I'm Vonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. SALT talks. Senate Majority Leader John Thune says GOP senators and President Donald Trump had a positive discussion on the tax and spend bill. Countdown to the ECB, the central bank expected to cut rates for an 8th time as global trade uncertainties persist. And day 2 of Super Return. Don't miss out on our live interview from Berlin with 6th Street co-CIO Julian Salisbury. That's later this hour. So let's get to the markets now. We have had 3 positive days this week. Barely positive on the S&P 500 yesterday. It held on to a very fractional gain. We have futures pointed higher once again today. Of course, it's all going to be about non-farm payrolls tomorrow and everything that happens in Washington, D.C. But so far, futures pointing to another 0.1% of a gain in this very, very early going, it should be noted. Nasdaq 100 futures too in the green, and we have Russell 2000 futures also up 0.2%. Lots of economic data later this morning that may have an impact on yields. Of course, we've seen yields move for all sorts of reasons. A big move, particularly for the 30-year yesterday. If you'll remember, we started yesterday with a yield of 4.98%. It was about to test that 5% mark. And then throughout the day, after the weak ADP data, and of course everything that's going on globally, we saw a move into treasuries, and that yield down to E593 now. We also didn't see the same move quite so much on the 2-year yield, but obviously that's going to be impacted more by the Fed. This is the picture I'm talking about. Look at that Japan 30-year yield. The auction that we saw out of Japan, not as bad as feared, if that's good news. Well, that yield at 289.20 right now. Remember, the high was at 318, so it looks like things might be improving in Japan. No more long-end yields, at least until the Bank of Japan meeting in 2 weeks, and also the Ministry of Finance is going to be meeting with traders, so that should calm things just a little bit. Now let's get to some macro movers, micro movers even, with Joe Easton in London. Joe.
Hey, Vonnie. So one of these big movers today is PVH Corp. This, of course, is the owner of Calvin Klein and also Tommy Hilfiger. Weak results out of them last night. Doing a lot of discounting is what analysts are saying, and that is really not actually helping the sales that much. That's really extending or going to extend a big loss over the past year for that stock. We're down by around 30%, I believe, on a one-year basis for that one. Then we move over to Five Below. This is more a value retailer, kind of in your stationery and toys and phone cases, anything you might want to pick up on the cheap. But that one is looking a bit better than expected, in fact, and the shares are rising around 5%. The results were towards the top end of the EPS guidance. It's the main takeaway on that one. And then finally, in the tech and telecom space, we've got Verint. This is kind of in your communications, automated communications, going into call centres, that kind of thing. But we can see a really strong reaction to that quarterly beat on the earnings of Verint, up more than 20% today. And as usual, on the Bloomberg terminal, the before the bell opening wrap will summarise all of these moves and more ahead of the open in New York. Vonnie.
Joe Easton, thank you so much. And coming up, we're going to be speaking with Julian Salisbury of 6th Street. And we're going to be hearing from James Clark of Blue Owl. That's all from the Super Return Conference in Berlin, so you won't want to miss those interviews. President Trump and Republican senators have discussed ways to scale back the $40,000 SALT cap. Majority Leader John Thune spoke to reporters after the meeting.
We had a very positive discussion about the path forward on the big, beautiful bill, on the reconciliation bill. And I think it was a reminder that we are all in this together. This is a team effort, and everybody is going to be rowing in the same direction to get this across the finish line. Failure is not an option.
Meanwhile, Elon Musk is back at it again, posting on X, "Call your senator, call your congressman. Bankrupting America is not okay. Kill the bill." Joining us now is Bloomberg's Kevin Whitelaw. So, Kevin, it doesn't seem like we're getting anywhere faster on the negotiation, any kind of reconciliation between the parties. What kind of a time limit do we have on this?
Well, you know, the ultimate sort of forcing mechanism right now is the debt limit, and the exact time for where that debt limit is going to kick in is between sort of August, September, October, depending on the various estimates you're looking at. Now, the debt limit could be handled separately. They could try to do it separately, but that's a challenge to get the votes through as well. So they're really pushing, and a lot of the pressure is obviously coming from the president himself. He really wants this bill. He wants the things that it's going to bring. But it was always going to be a tough road. They barely got it through the House. They're going to have a lot of trouble getting it through the Senate. There's a lot of senators that want changes that are simply not compatible with each other. And so figuring out how they're going to get to a place that delivers on all the various promises, it's just not clear yet how and when that's going to happen.
Yeah, Kevin, it will be interesting to see how this progresses, particularly given that Elon Musk seems to be very much having a bee in his bonnet at this point and keeps on posting. But President Trump has also reinstated one of the most controversial measures from his first term. Have a listen.
Very simply, we cannot have open migration from any country where we cannot safely and reliably vet and screen those who seek to enter the United States. That is why today I am signing a new executive order placing travel restrictions on countries including Yemen, Somalia, Haiti, Libya, and numerous others.
The audience for this is likely his base. Who else, Kevin? And will there be repercussions in the courts?
Well, you know, this was a version of the travel ban that he did institute last time, and the president does have some broad authority to do this, particularly when they're able to articulate a basis for some things rather than have it be sort of a blanket, sort of a total blanket ban. So he does have some precedent for being able to do this. There were 9 countries that he targeted in his first administration. This time it's 12, adding in a couple like Afghanistan and the Republic of Congo to the list. And so what this does is target essentially new arrivals. If you know, it doesn't target people who already have visas or an authorization to be in the United States, but it does make it very, very difficult, nearly impossible for people to get new visas from those countries. He's also doing sort of partial restrictions and bans on several other countries. So this very much follows the track we saw the first time. This does play to the base. They, you know, the explanation that Trump gave and that his team gives is that this is for security, this is for safety, and this is for, for what the United States needs to do to keep itself safe. Strange thing, of course, is he was citing this incident in Boulder, Colorado, this attack on these marchers that was carried out by someone who'd overstayed their visa. That was an Egyptian citizen, and Egypt is not on the list of countries that he targeted today.
Yeah, exactly. Hadn't gone unnoticed. Kevin, thank you so much. That is Bloomberg's Kevin Whitelaw. Let's switch focus now to Europe. The European Central Bank set to lower interest rates for an 8th time. Bloomberg's Lizzie Burden joins us now for a preview of what to expect from Frankfurt and, of course, ECB President currently, Christine Lagarde. So this could be the last cut, at least for now. What happens next? Walk us through the debate around what comes next and forward guidance, Lizzie.
Thanks, Bonnie. Yeah, it could be the last easy cut from the ECB today. Easy because inflation in the euro area has now dropped below the ECB's 2% target. It's at 1.9%. But from here on out, the outlook gets murkier. First, in the short term on the tariff front, and in the long term on the fiscal front. We just don't know what the economic impact is going to be from all that infrastructure spending, the defence spending as well. Maybe we'll get a closer idea of from the NATO summit later this month. But because of all of this uncertainty, today we're expecting not just the updated forecasts on inflation and growth, but also a range of scenarios. And the question becomes, do they cut again in July, or do they wait the summer and go in September? Economists expect September, but the argument against that is that they could confuse the market. And that is the last thing that President Lagarde wants to do. The ECB says it wants to be a beacon of stability. It doesn't want to add unnecessary surprises in an already volatile market. So I expect at the press conference today she's going to be keeping her cards very close to her chest, but also, as you hint, on this question of her own tenure as president of the ECB. There's speculation that she's looking at becoming leader of the World Economic Forum, speculation that she hasn't yet denied. So we'll see if that pops up at the press conference.
I feel like she's definitely going to get the question, right, Lizzie? Our thanks to you. Lizzie Burden will be following it all for us in real time, and she's there in Frankfurt. Now to other top stories trending on the terminal this morning. China says the new U.S. tariffs on imported steel and aluminum will seriously disrupt the global industry supply chain. A spokesperson for China's Ministry of Commerce also said China's exports curb on rare earths is in accordance with the law and vowed further measures if the U.S. doesn't change course on its trade policy. Citi is cutting about 3,500 tech employees from its workforce in China. According to the bank, the reductions are expected to be completed by the start of the 4th quarter. It's aiming to cut 20,000 jobs by the end of 2026 as it tries to streamline operations and lift profitability. Alphabet CEO Sundar Pichai says the Google parent company won't stop hiring despite advances in artificial intelligence. Speaking at the Bloomberg Tech Conference in San Francisco, Pichai defied the trend in big tech of trimming staff.
Grow from our current engineering base even into next year. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. People will be able to do more, which means maybe we'll create new products, and hence we will need more people, at least in the near term.
And coming up live from Super Return in Berlin, our own Danny Berger is sitting down with 6th Street's co-CIO Julian Salisbury. That's next. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Let's head over now to Berlin, where Danny Berger is at Super Return. Leaders there in private capital are all gathered for the annual summit. Danny.
Bonnie, thank you so much. I'm so pleased to say we have another fantastic conversation for you. It is Julian Salisbury of 6th Street Capital Partners, the co-CIO. Julian, thank you so much for joining this morning. Fantastic to see you in Berlin. Look, it's an interesting time, to say the least. And you overlook so many asset classes, be it at 6th Street, be it at your past at Goldman Sachs Asset Management. For private equity in particular, it's been incredibly challenging to fundraise. Is this an industry having a rethink, a reevaluation of private equity?
Look, if you look at the historic returns for private equity over 20, 30 years, they've obviously been very attractive. That's drawn in a lot of capital as people have looked to replicate the success of the early movers, you know, the ultra-high net worth individuals, the endowments. It's gradually over time drawn in a broader base of institutional investors, insurance investors, and more recently wealth investors, all kind of chasing those higher rates of returns. That's, as that money has come in, it's, you know, and you combine that with the low interest rate period of 2020 and 2021, you got a lot of, frankly, bad vintage assets. I think of it as like a big pig in the python. All these stuck assets that were originated when too much money came in, bought at too high prices, and it's indigestion, essentially. And, you know, this is going to have to work its way through over the next couple of years. It's one of the big themes we're seeing in investing right now, which is resolving these stuck assets. Assets bought in a different rate environment that needs to figure it out. The solution could come in many forms. A lot of them, people have been hoping that some combination of growth and interest rates coming lower was just going to bail them out. You know, that pot of, you know, that light at the end of the tunnel has been moving further away.
How painful does it look if we don't get that, though? Because at the moment, rates are still high.
Yes.
Growth looks challenged. How painful does it become?
Our belief had been that rates would stay higher, you know, coming lower from where they are right now, but staying higher for longer, and we continue to believe that will be the case. A lot of inflationary pressure is still out there. So that exit, as you get further years into this, more and more funds reaching end of fund life, incredible pressure from LPs around DPI and returning capital. So as that pressure is building, it's really forcing people to take more action, and there are many kind of levers they can pull to generate DPI. But I think it is going to take longer, and that's going to force people to actually take some pain. One of the big themes, again, that we're seeing right now when we think about deals is you have to find people who need to transact. Because if people don't need to transact, their preference is wait, because they think there's going to be, it's always going to be better to sell tomorrow. So a big focus, whether it's in private equity, growth, real estate, across our infrastructure, across the different asset classes, do these people want or need to transact? End of fund life, transitional ownership, real pressure from their LPs.
So that's in private equity. There's also been some concern in credit that we're also in a period of extend and pretend. Yeah. Jamie Dimon even recently said in the past month that credit risk is not appropriately priced in. Is he right?
So let's talk about like long-term and short-term. Sure. I think if you think big picture, private credit as an asset class is a very nascent. People didn't even really use the term private credit 7, 8, 9 years ago. The big endowment model approach was private equity, and you want to own bonds, not even IG. You want to own government bonds. That's your kind of barbell portfolio. And as this has emerged as an asset class, I think people have taken real interest in it. First of all, important point, I think 85% plus of companies in the US are private companies, so they need access to capital that they can't get through capital markets. There have been very attractive historic returns, a real spread premium for that has pulled in institutional investors. In particular, as rates went higher again, just the nominal return on private credit was reaching a point where it hit their target rates of return for those funds. Now, what's happened over the last 3 years is, given the relative attractiveness of the asset class, it sucked in a ton of money. We've seen a tripling of the market overall, tripling of private credit, and the vast majority of that growth has been like an 18-fold increase in direct lending over that same period of time. And in particular, in more recent years, a very large preponderance of that money, 70% plus of that money, flowing into evergreen vehicles. The problem with those vehicles is when the money comes in, you have to invest it right away. So it does feel right now we've got this dual kind of pain point of a lot of fast money coming in, combined with a relatively anemic M&A environment, so a relative lack of supply. So I think it's fair to say today spreads in that market are not particularly attractive, but that can change very quickly. I think you're going to see a slowing down of some of those retail flows. You see a slight uptick in M&A environment, and that. So on a long-term secular basis, private credit is still very attractive. Right. It's just right now there seems to be.
For now, does that also mean that managers are taking sacrifices, be it cov-lite deals or spreads?
Absolutely. You're seeing. Again, when money comes in the door and you have to put it out the door, we're designed differently. We design our liability structures such that they're either permanent in nature or truly permanent in nature. People describe evergreen as permanent. It's not permanent. Or they're drawdown in nature, which means in a period of time like first quarter of this year, when the market's incredibly tight, we can just fade and take a step back. And then at other points in time when things get dislocated, we can actually lean in and be far more aggressive. But I think, right now, a lot of pressure, but it exposes itself differently. I would say most acute, large cap, straightforward, plain vanilla end of the direct lending market is what gets squeezed down, and people will push down both pricing and terms. At that point in time, you can pivot towards the smaller and medium end of the market, where you can still get some better pricing and some better structure.
Julian, I also have to ask you about some of your sports investing. A wide range from Celtics to Real Madrid to the San Francisco Giants. Where else are you interested in expanding into?
Look, we've been in the sports ecosystem for many years. You go back 5 years ago, we made an investment, a control investment in Legends, which really operates the concessions and retail units across stadiums around the world. That gave us real great insights and partnerships, starting with the Yankees and the Cowboys in that Legends investment. Off the back of that, we made a number of investments since. We're very excited by the general theme of sports. I think people get confused about this stuff. They don't really appreciate what's going on. The step up in media rights that we've seen and can expect to continue to see in the coming years means that we're going to continue. These are going to continue to be viewed as very valuable assets. You think about live TV; it's basically news and sports these days. The way we've approached it is similar to the way we've approached other things at Sixth Street. It's not one cookie cutter where we do, one tool in the toolkit. Post the Legends deal, we did a partnership deal with Real Madrid, where it's a 20-year partnership where we invested in upgrading the Bernabeu Stadium. In the case of Barcelona, it was purchasing a share of the domestic media rights to provide them capital. In the case of Bay Area Football Club, it was a control investment in a women's soccer team.
Just quickly, I would love to get your thoughts, because the AC Milan owner has been very public in saying sports valuations are in a bubble. Do you think he's right?
Look, I think you have to really look country by country and asset by asset. It's so asset specific. The dynamics, for example, in the US, where you have teams with salary caps and high media rights and drafting systems such that teams are constantly rebalancing. You don't have promotion and relegation. You don't have, am I in the Champions League? Am I not in the Champions League? It's a very different kind of risk profile to being in a European team where like making or breaking Champions League has a huge impact on the bottom line, and really you're competing. You have it's a much more kind of feast and famine kind of approach in European soccer.
Oh wait, your team Wrexham here, they're selling a steak.
Yeah, my whole family's from Wrexham, so that's the team I've been following most closely over the last few years. Three consecutive promotions.
Well, we will follow closely if there are any developments on that front. Julian, thank you so much for joining. Really appreciate your time this morning. Bonnie, with that, I'll throw back to you. That is, of course, Julian Salisbury of 6th Street.
Fascinating interview. Danny Berger, thank you so much. More from Danny in Berlin later on. This is Bloomberg.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China. In 2023, it's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Time now for our front page news. First, on the New York Times, President Trump ordering an investigation of former President Biden and his aides. The order calls for a probe into whether some of Biden's policies were legally invalid because his aides enacted them without his knowledge. In a statement, Biden made it clear he was the one who made the decisions. Next up, the Wall Street Journal reporting on economists raising questions about the quality of U.S. inflation data. Staffing shortages at the BLS mean fewer price checks for its inflation survey. One economist says that's forcing the Bureau to turn to less effective methods. And the FT leading with big investors shifting away from U.S. markets, many questioning whether more than 15 years of inflows and outperformance is headed into reverse after President Trump's tariffs delivered a so-called wake-up call. More next. This is Bloomberg.
a number of games overseas in recent years. And in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. SALT talks. Senate Majority Leader John Thune says GOP senators and President Trump had a positive discussion on the tax and spend bill. Countdown to the ECB. The central bank expected to cut rates for an 8th time as global trade uncertainties persist. And day 2 of Super Return. Don't miss our interview with Blue Owl Global Head of Institutional Capital, James Clark. That's later this hour. Now let's get a look at markets. Very early going, 4 hours till we start cash trading, but we have S&P futures, NASDAQ futures, and Russell futures all pointed higher, at least for now, in the early going. That would make a 4th day of gains this week. Treading water just ever so slightly before the non-farm payrolls report Friday, but it is interesting to see that at least we're not losing ground, having had 3 positive sessions. Now, if you look at yields, very interesting story there. We saw a big drop-off during the session yesterday. The US 30-year yield now at 486.14. We had a Japanese bond auction that wasn't as badly received as perhaps expected. Remember that high for the Japanese 30-year at one point was 318. That's all the way down now on the 30-year to 289, so perhaps not as panicky globally in terms of bond market action as we had been expecting. That it's not continuing, let's say. The US has auctions of 10 and 30-year debt next week. That's going to be the next test of appetite. All right, let's get to some stocks to watch now. We get across to Joe Easton. Joe.
Hey, Vonnie. So PVH really the big underperformer in the pre-market in terms of your kind of mid-caps, large caps. So this, of course, the owner of Calvin Klein and also Tommy Hilfiger missing on its earnings last night. A lot of discounting going on at the company trying to get all of that clothing off the shelves, and that is impacting their profit, their bottom line, according to analysts. That stock, as I say, the owner of Calvin Klein, coming down around 8% in the pre-market this morning. Then in terms of Five Below, so we're down in the value retail, discounting, phone cases, toys, stationery, any kind of cheap goods you're looking to pick up. That one actually better than expected. So the stock today, we're up around 5.4% on Five Below at the moment. That's had a bit of a rough run, that stock as well. So potentially some investors are going to be a bit more happy on that one today. Earnings as well, of course, on that one. Then in terms of Verint, this is in the automation and telecom space, kind of automating the call centers, chatbots, that kind of thing. Really strong numbers out of them as well. So Verint, we're up 22% at the moment on the pre-market, set to be one of the biggest gainers at the open of trading. Vonnie, Verint up 22% this morning.
And of course, we have an IPO in the US later today as well, with Circle going public. Joe, thank you so much. Going to be an interesting day in markets. Well, over in Washington, Republican senators have met with President Trump to discuss ways to fix the SALT cap.
We had a very positive discussion about the path forward on the big, beautiful bill, on the reconciliation bill. And I think it was a reminder that we are all in this together. This is a team effort, and everybody is going to be rowing in the same direction to get this across the finish line. Failure is not an option.
Elon Musk, in the meantime, ramping up his criticism against the bill, writing on X, quote, "Call your senator, call your congressman. Bankrupting America is not okay. Kill the bill." All right, let's bring in Bloomberg's Kevin Whitelaw for more. So, Kevin, John Thune saying positive things, there were good discussions, there is a time limit and so on. What possibly could have gone better in the last few hours than we might have been expecting?
Well, you know, it is interesting to watch Elon Musk sort of unleash his firepower against the bill, you know, now that he's out of sort of his White House role and back sort of at his companies. You know, look, obviously, he's upset that the bill doesn't really reflect sort of the kinds of deeper spending cuts that he was looking at, and actually is forecast to add $2.4 trillion to the deficit over 10 years. That's really quite a lot, sort of going the opposite direction from what he talked about. But we also have some reporting that suggests that another thing he's sore about in the bill is that it phases out tax credits for electric vehicles, which obviously impacts the company Tesla, which he is now sort of trying to focus on after a very rough run for the company, which has been very much hurt by his political association with the Trump administration.
And then again, President Trump has reinstated one of the most controversial measures from his first term, Kevin.
Very simply, we cannot have open migration from any country where we cannot safely and reliably vet and screen those who seek to enter the United States. That is why today I am signing a new executive order placing travel restrictions on countries including Yemen, Somalia, Haiti, Libya, and numerous others.
We've seen this before, of course, or something similar. Will there be as much of a backlash this time?
Yeah, I mean, you know, he did do this in his first administration for 9 countries. This is against 12, and so I think everyone expected that something like this was going to happen, so there may not be quite the same level of backlash as there was before. This is targeted, and he does have some reasonably broad authority to act on this. I think what's actually going to be much more controversial going forward is a separate decision he made that's going to prevent Harvard from enrolling new foreign students in the coming year, and I think I think that's where he's on potentially thinner ground in some ways, but definitely going to trigger a much bigger backlash from across the political spectrum.
Kevin, yesterday we know that President Trump and Vladimir Putin had a 1-hour, 15-minute discussion, one that Trump characterized as not one that was going to lead to peace. Do we know any more about any kind of impact the U.S. can have on Vladimir Putin's next actions, or what they might even be?
Well, I think, you know, there were 2 particularly notable things about the readout of that call, and it seems that, one, Trump didn't seem to talk about the possibility of new economic sanctions on Russia. A lot of even his political allies are pushing very hard for new Russia sanctions. Europe wants new sanctions. They really want to find ways to squeeze Russia, but that was absent from this call. He also did say in his readout that Putin indicated that he plans to retaliate against that massive drone strike on Russia's Air Force over the weekend. He plans to retaliate against that, really not offering the usual kind of warning or caution or you know, sort of any kind of admonition not to do that, which is what would have probably been the case under Biden or another U.S. president. And so I think there's a little bit of concern that he may not be sort of operating with the kind of efforts to restrain Russia, try to put pressure on Russia that I think others had been hoping for. So a concern that maybe he's simply, you know, easing his way out of this peace process that he had tried to start.
Yeah, absolutely. And later today, of course, meeting with the German Chancellor, Friedrich Merz, as well. Our thanks to Bloomberg's Kevin Whitelaw, keeping an eye on everything for us in Brussels. Staying in Europe, the ECB is set to lower interest rates for an 8th time. Bloomberg's Lizzie Burden is at the central bank in Frankfurt for a preview. So, Lizzie, what are you expecting out of the ECB today? I mean, obviously, we're going to get a cut, right?
Well, it would be a huge surprise in markets, Vonnie, if there isn't a cut from the ECB today, because you've got inflation back below the 2% target now in the euro area. But from here on out is where the outlook gets cloudier. First of all, on the tariff front in the short term, because we just don't know whether the US is going to raise tariffs on the EU from 10 to 50% after that July 9th deadline. We just don't know how the EU is going to retaliate, if it will. Of course, you mentioned that you've got Friedrich Merz, the German Chancellor, in the White House later today. But the other uncertainty is around the fiscal boost in the longer term, this infrastructure and defence spending and the economic impact of that. We just don't have the concrete details around that stimulus. So this is why, alongside the updated forecasts on inflation growth, we're expecting a range of scenarios to be published by the ECB. But the question going forward is, after this cut, do they cut again in July, or do they wait until September after the summer break? Economists expect them to wait till September. But, Vonnie, the difficulty is you could confuse the markets in the interim. They could see the pause as an end to rate cuts. And confusing the market is the very last thing that President Christine Lagarde wants to do. So I expect she's going to keep her cards close to her chest at the press conference.
Yes, and try and keep a rein on the narrative as well, because there's a lot of other drama at the ECB that really very, very likely to come up at the press conference too, right, Lizzie?
There is, and it's swirling particularly around Lagarde herself and her future tenure as the president of the ECB. There's speculation that she could go and lead the World Economic Forum, speculation that she hasn't notably denied, because she can say now that she's tamed inflation in the euro area. There's also all of the drama around the Slovak Central Bank Governor Peter Kazimir, who of course was convicted of bribery last week, fined €200,000, and if he fails to pay that fine, could be sent to prison for a year. Now, his term was meant to end on the 1st of June. They haven't found a replacement, but the Slovak Prime Minister, Robert Fico, has said that he does not intend to support his reappointment, Kazimir's, although Kazimir says that he intends to appeal and doesn't intend to resign. So there's all that drama. They're still trying to fill the vacancy at the top of the Slovenian Central Bank. They've been trying for months. And the European Commission has just recommended that Bulgaria joins the euro area. So if the rate drama wasn't enough, there'll be plenty of sideshows, I'm sure, at the press conference.
Well, it all kicks off in about 2.5 hours with the decision, and then we'll be waiting on the press conference, and you'll be there for us. Lizzie, thank you so much. That is Lizzie Burden there. Coming up, we go back to Super Return. Our conversation with Blue Owl Global Head of Institutional Capital, James Clark, is up next. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
These stock assets that were originated when too much money came in, bought at too high prices, and it's indigestion essentially, and this is going to have to work its way through over the next couple of years. It's one of the big themes we're seeing in investing right now, which is resolving these stock assets bought in a different rate environment that needs to figure it out. The solution could come in many forms. A lot of people have been hoping that some combination of growth and interest rates coming lower was just going to bail them out.
Sixth Street co-CIO Julian Salisbury there speaking to Danny Berger at Super Return earlier this hour. Well, Danny also spoke to James Clark, Global Head of Institutional Capital at Blue Owl, on the shift in alternatives. Let's have a listen.
I think there's a lot going on. There's been a massive sea change in the alternative space. In fact, what I hear here is less about capital appreciation, which alternatives typically were in the past, and more about capital preservation and income generation. We are in a different space. There has been a 40 mile an hour tailwind since 2010, since the financial crisis. Also, there has been an opportunity where pension funds have not had full allocations to alternatives. That has shifted, okay? The narrative of coming into a fund and doing a fund and then getting out is no longer there. You need to partner with your clients 24/7. You cannot approach it from a standpoint of, hey, we're in market, we're out of market, we're back in market. That doesn't work anymore. You have to remain front and center and be their partner. And you can only do that if you're a bigger organization. We always say at Blue Owl, we don't sell funds, we position partnership.
What happens to the smaller funds then? Because, James, there have been a lot of funds that started up in the past. What happens to them if you're not one of the big funds?
I'll be honest with you. If we started Owl Rock, which became Blue Owl, we started in 2015. If we started in 2025, much to the chagrin, potentially, of my bosses, I would think that there is absolutely no reason for us to exist. I could not begin to approach the institutional market right now with a smaller organization. Remember, the barriers to entry are very low in institutional market. Pick up the phone, try and get meetings. But they are consolidating their partnerships. They only have limited bandwidth, and they want to do it with bigger managers that can tap into different types of strategies.
So what happens when that consolidation occurs? What form does it take? Is it funds buying out other ones? Is it other ones that just cease to exist and start to slowly unwind? What shape does it actually take?
I think you've seen the fundraising environment very stagnant, if not lower, okay? Now, what I will tell you is in this environment, the bigger institutional managers, or bigger asset managers, should I say, have actually grown, okay? I can speak to that firsthand. And you look at that and you understand why. The smaller funds, I think, are the laggard in terms of why we're not rounding out the same allocations that we saw in 22, 21. Last year, alternatives were down 14%. The year before, it was 24%. These are tough times to raise capital for a couple of reasons. The denominator effect, a lot of institutions are full on capital. The way that you engage the market is key too. You have to understand it begins and ends with the client's objective.
It's kind of ironic because even though fundraising is challenged in some corners, to your point, the big have been able to fundraise. And it's brought about this concern that there's a lot of dry powder. There are less deals going on because M&A is at a freeze, and the banks are really competing in the market too. Is there an issue of too much capital chasing too few assets?
Look, I think there's a couple of things in your question. Number one, the banks and the private markets can coexist. Remember, the private markets are only 18% of deals financed, okay? The other thing is that there is a I think direct lending sometimes gets painted in different shades of beige. It's kind of like curtains in the 1970s, when in fact it's more of a kaleidoscope like the 1960s. So you don't have to source and sit around and wait for a hot LBO market. There are take privates, there are incremental add-ons. Incumbency is key. 50% of the deals we did last year were incumbent positions. The other thing that I would challenge back, and which I say is, things are episodic. I mean, you saw this on Liberation Day. All of a sudden, there was an exit of the banks. Now, they've come back. Equity market was down 5%. You know, I don't think in April, it was up in May. I think capricious is too strong a word, but unreliable is probably more of a narrative. People want certainty. We say this all the time. They want partnership. So there have been these episodic dislocations. 2018 was one. Obviously, the pandemic was one. 21, 22, LBO market shut, or syndicated market shut, should I say. The IPO market shut. Direct lending was the only game in town, and we did a lot of deals then.
Does that mean that even though the banks are back, there are still scars left, which means they won't fully be able to regain market share? Is that what you're saying?
I think that, again, they can coexist. I mean, when you're looking at when you're a private equity sponsor and you're at portfolio companies, you're looking at different ways in which you can grow your business, okay? But it's also like, what is the constellation of your lenders, okay? Now, they underwrite the deal, the banks, then they pass it out to who knows how many lenders. When there is an issue, and let's be honest, we have to be humble in this world. There are always going to be issues. That's why we have diversified portfolios. It's important to understand who your lenders are. How do you work through that situation? And that's where incumbency comes in.
James, I do just want to end on kind of, you teased it there, this idea that it's really just a very disruptive business environment right now. Where is stress showing up because of that? Is stress showing up because of that?
In our portfolios, they're hanging tough, okay, and doing very well. We have very limited issues in them. Now, no one's omniscient, right? We don't know what the future holds. But the most important thing, and I'll take this back to my original comments, is we are not, you can't have your head in the sand, but on the other hand, when you're doing 7-year loans or 15-year contractual leases, or our GP stakes business where we're partnering managers, these are 7-year loans. These are 15 years. This is agnostic to an election cycle, right? We're not in it. We're in it for the long term. Our clients are too, right? Scale meets scale and objective meets objective.
I could push back, though, and say, regardless of the election cycle, though, we're seeing a rewiring of trade, of global business, that's going to have lasting implications. So surely there's some business models for borrowers that just are really challenged.
There are, and you have to understand, like as I said before, no one gets it perfect. And if anyone was to come up here and say they got a portfolio of concentrated positions and they're going to nail them all, run the other way. Okay, we have average position sizes of 1%. Our industry diversification's across 30. So yeah, there may be one's challenged, but the important point, it all comes back to preservation of capital. Back in the day, when it was capital appreciation, you'd want to take a little bit more of those bets.
That was James Clark of Blue Owl speaking to Bloomberg's Danny Berger at Super Return. Coming up, we'll get you set up for your trading day with an ECB decision today and more jobs data. This is Bloomberg.
everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Now a look at what's ahead today. More jobs data coming your way with Challenger's job cuts at 7:30 a.m. Eastern, and then jobless claims, of course, at 8:30 Eastern. And then an ECB rate decision, which comes at 8:15 Eastern, followed a half hour later by President Lagarde's news conference at 8:45. Plus, we get earnings from Broadcom and DocuSign coming after the market. We're just at the very tail end of earnings season. Let's have a look at a couple of micro movers now as we head very, very slowly towards that open. Verint extending double-digit gains after reporting a sales beat as client demand for artificial intelligence grows. Broadcom rising there ahead of earnings after the closing bell today, and Visa, Mizuho upgrading to outperform on that stock, saying the cash-to-card runway in the U.S. still has room to grow. I don't know if that's a good thing for the consumer or something maybe a little more worrying. Let's get a check on the broader markets now. It's just a few hours to go before we get the start of trading in the United States. We have S&P futures pointing ever so fractionally to a positive open. We barely held on to half a point of a gain for the S&P 500 yesterday, so we could be on track for a fourth day of gains for that index. Remember, it's up 1% so far this week. The US dollar index, well, it's pretty much unchanged. We have a weaker yen today. Tiny bit of relief a few minutes ago for the US dollar. And of course, yields-wise, we have the 10-year yield back at 434.73. A little relief after Japan's 30-year auction wasn't quite as bad as feared, and that's sending relief through the global bond markets. The next test of appetite will, of course, be next week for debt sales in the U.S. and obviously non-farm payrolls Friday. That's it for Bloomberg Brief. Surveillance is right ahead. This is Bloomberg.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read.
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an ebook, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
If things stay status quo, then I think you have the opportunity to see the markets move higher.
Since around mid to late April, it's been the mega cap tech companies that have led.
Volatility could remain elevated, but it's not necessarily an environment where you want to sell all equities.
I would not be adding a lot of equity risk to this rally.
The broader market is really driven by growth in technology, and growth in technology is okay right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance with stocks edging higher for a fourth straight day. Hopes of Fed rate cuts are growing alongside pessimism about the state of the U.S. economy and animosity bubbling over between President Donald Trump and former First Buddy Elon Musk, adding pressure to an already fraught budget process. Before we get to that fight, Anne-Marie very much back in the seat, which is a wonderful thing. I do want to start with this idea of an economy in the United States that does seem to be weakening. We got ADP coming in with the softest numbers going back 2 years. We also got a pretty weak ISM services number.
Right, the first contraction in ISM services since June of last year. So the question now everyone is having, is the soft data starting to hit the hard data? And of course, this is all ahead of tomorrow's very important jobs report. And then there's the debate. What does the Fed do with this? Is the Fed ready to potentially cut rates? That debate heating up, and no other than at the White House. It was that ADP report that we saw the president take to Truth Social saying the ADP numbers are out. Too late, Powell must now lower the rate. He's unbelievable. Europe has lowered 9 times, and he's jawboning him to try to do more.
And just to clarify, it has been 7 times that the ECB has cut rates, and it's going to be probably number 8 later today. It is notable, though, that we always talk about who cares about ADP, and then ADP comes out lower. And first of all, markets did care, but so too did the president, as this is sort of key to a lot of the question marks underlying some of the squabbles right now in Washington, D.C.
Right, and the squabbles are front and center because right now we are 29 days until their self-imposed deadline of July 4th to try to get the one big beautiful bill. And the fights are out there in the open. It's not just Elon Musk taking to Twitter saying, kill this bill. There's fights as well when it comes to SALT. What did we hear from Senate Majority Leader outside the White House yesterday after he met with the president? He said, really, there's no Republican senator that cares to keep a high SALT deductible cap. There are a number of fights amongst every single provision, and the math just doesn't make sense to get all the Republican senators on board with all the House Republicans.
There are House Republicans from New York, New Jersey, L.A. There are not necessarily Senate Republicans from New York, New Jersey, and L.A. Just to sort of underscore whether the budget process is really roiling markets or not. Yesterday, we saw the biggest rally in the 30-year yield going back since February, and part of this was on the heels of expectations that maybe growth was slowing. It just underscores this question question about how much what we've seen in the bond markets really is tied to this increase, this expansion of the deficit.
And potentially, the deficit will expand. If you look at what some senators are asking to be added into the bill, things like making business tax cuts permanent, that would expand the deficit. Although I would note, the Democrats, Senator Schumer, wanted the CBO to score the tariff impact. It actually helped the White House's case because it said, yes, this bill adds the deficit, but when you consider what current policy is on tariffs, it actually helps.
Yeah, they talked about keeping tariffs high for a prolonged period of time, bringing in, I believe, $2.8 trillion versus the $2.4 trillion increase in the budget deficit. We'll be talking about that coming up. Right now, equity markets basically in a churn, marginally higher after yesterday eking out some kind of gains at the end of the day after a tumultuous session. This isn't exactly a runaway rally, nonetheless, still in the green. What you can see in the bond space really did end up driving a little bit of this action yesterday, where the data was weak enough to include possibly more Fed rate cuts, but not so weak as to suggest some sort of recession. The 30-year yield yesterday dropped by 10 basis points in the United States, currently 4.86%, heading lower yet again with the 10-year also 4.35%. Coming up this hour, we'll be talking about that with Lori Calvasina of RBC, with the S&P 500 on the brink yet again of a bull market. Bloomberg's Tyler Kendall as Republican senators look to strike a deal on SALT, and Krishna Guha of Evercore as Trump renews his push, as Anne-Marie was just mentioning, for the Fed to cut. We begin this hour with stocks looking for a fourth straight day of gains. Lori Calvasina of RBC is among other strategists raising their S&P 500 year-end targets this week, writing, "Our new price target reflects our belief that the stock market is on a slightly better path than the one it was on in early April. We view the sentiment as the main risk to our call." Lori joins us now. Lori, before we get all bullish, and thank you so much for being here, this isn't exactly a bullish upgrade to your forecast. You still see declines for the full year.
Yeah, look, we came out at 57.30, and clients who know me know that I'm very kind of quantitative and nerdy with these targets, right? And we have 5 different models that we look at right now, and 57.30 is the median. The 2 more bullish ones are our cross-asset model, where bond yields have been on the move, so that one makes me a little queasy right now. But also sentiment, that could also get us more constructive, and we have different ways we're looking at that, but maybe 63, 6400. That would really, in my mind, be the bull case. But the problem is sentiment is melting up so quickly, my model is rapidly exiting attractive territory. So I don't know where it's going to be in a couple of weeks. I don't want to bank too much on that. When I look at my 57.30, that's probably, my analysis that I'm most comfortable with right now, and that's our valuation and earnings modeling, where we're baking in 1.3% on GDP. We're baking in a few cuts from the Fed starting in September. We're baking in 10-year yields moving up, but then going down to 3.8%. And we've got a little bit of margin degradation in the back half of the year. We think that's all a pretty reasonable scenario to look at, and we've got inflation in the high 2s, not the mid 3s. So we think things are better than when we went to 55.50 back in early April. But I'll tell you, Lisa, after we got that China-U.S. de-escalation a few weeks back, I got a lot of questions. Well, why aren't you just putting on your January target? Why aren't you just going back to 6,600? And I just said, look, we're not back to where we were economically or in terms of the broader macro backdrop back then. And I thought that was an important point to emphasize.
And that's something that really underscores your concern about where sentiment is right now.
Yeah.
Let's talk about feelings. I was thinking about yesterday how feelings are so good that even when we get bad news, it is interpreted as good news because it infers some sort of greater degree of Fed rate cuts. Yesterday's ADP report, okay, you can put that aside for 1 second, even though it was the weakest going back 2 years. The ISM services data showed the first contraction, as Anne-Marie was mentioning, in almost a year. The new orders component falling to a 2-year low, and this was stagflationary, with prices increasing to the highest level going back to 2022. Were you surprised the market didn't respond more?
So, look, I think that we're getting into this sort of situation where, a couple weeks ago, people were like, well, look at the tax bill, look at deregulation. Those are things are going to get us excited. And now you're starting to hear, well, maybe we're going to get some cuts for the Fed. And so I think that people are looking for those glimmers of optimism to hang on to. I'll tell you what surprised me about the ISM data, both the manufacturing and the services index. was if you had looked at the consumer confidence indexes, like the Michigan and the Conference Board that came out in recent weeks, we had been seeing some stabilization and inflection there. So the fact that we didn't get that in these, soft data starting to act a little bit better. Even a lot of the regional Fed surveys have been, we watched the employment and CapEx data points pretty closely, and a lot of those had kind of stabilized in recent weeks. And we just didn't get that on these two data points, and these actually do matter a great deal for business sentiment.
Didn't we see those surveys stabilize, though, because of sentiment, the détente between China and the United States? But actually, to your point, we can't go back to where January was, because there was a détente, and now we still have a war of words, and we still don't have a phone call between the two leaders.
Right, and I would argue since we went from that 145 to 30, we haven't had another big step up in improvement, right? I don't know, you would know this better than me, right? But I don't know if this is really, we've taken a few small steps back, or we're just kind of in a holding pattern, but we certainly haven't gotten any better. And the other thing we really wanted to emphasize with our upgrade, maybe it was kind of a bearish upgrade in here. I feel pretty neutral, to be honest. But the reality is we priced in that de-escalation in about 5 minutes on the day after it happened. And if we are going to get another big step up in terms of the expectation for the path we think the stock market is on, we need something else big to give us a jolt in terms of improving the macro outlook and getting that backdrop not just a little bit better, but a lot better. And I just don't see that coming right now. I need a little more proof.
Well, what's big? Like what?
I think, if we think about GDP, right? So our economists took their number after that de-escalation up from about 1% on the year to about 1.3%. And consensus is at like 1.4, and it's been falling. So I would at least want to see the consensus start to turn around on GDP and move pretty sharply towards that 2% number. If we were to suddenly, wave a magic wand and get back to 2% GDP forecasts, that's a very good environment for the stock market. So there we'd probably get more constructive.
What are you watching more today? Just to give a sense of your roadmap and how you rank some of the things that are sort of whipsawing markets. Would it be the initial jobless claims, or more specifically the continuing claims, that gives you a sense of just what the jobs picture really is ahead of tomorrow's payrolls report? Or is it what's going on in Washington, D.C., whether it's Friedrich Merz coming to the White House or the ongoing negotiations over the budget that seem to be increasingly contentious?
Well, look, I think we have to look at all of them. I would say today, I am keeping a close eye on claims. I do feel like a lot of the disruption that we got in D.C. early on in the year, especially from some of the job cuts, we've been hearing clients asking, is that going to end up impacting the hard data? What's the timing around that? That's a really big debate that's out there that's kind of, not so much in the headlines. So I'm sort of interested to see if that story breaks down and if it comes back to the investor, kind of the forefront of the investor psyche. I do think that the tax bill, it was this thing, right, last fall, early this year, even just a few weeks ago, that a lot of people were trying to pin their optimistic hopes on. And, I agree that there's some really good stuff in that bill for the macro. But, we've replaced all that, sort of stimulus discussion with how do the Medicaid cuts end up impacting things? What about Section 899? What does that mean for foreign capital flows into the U.S.? And obviously the deficit, with the Moody's downgrade, that has come back into the forefront. So it's gone from being like this easy check the box, positive things for markets, to just a bit more complicated.
Yeah, and it seems like, Anne-Marie, when you have more than 1,000 pages, it's hard to just check the box when you have questions about what exactly all is in this bill.
Well, yeah, that's right. Some congressmen and women have actually not read the bill, even though they've taken votes on it, which pretty much is standard operating procedure for Washington, D.C. They do a ChatGPT version, I think, with their staff. But it's challenging right now because the numbers are just so thin. And this bill, arguably, is the only bill Speaker Johnson is able, remains to be seen if he's able to get any tweaks, if it were to happen in the Senate, through his caucus. It is going to be very challenging because their senators want to sanitize this bill on every single front, and it was the only way he was able to get it across the finish line.
And I believe that you have the House Speaker coming on the show later this morning, where we'll be talking to him about this bill, and we will bring that to you. Lori Calvasino of RBC is sticking with us for the hour. Don't miss that conversation with House Speaker Mike Johnson coming up at 7:30 a.m. Eastern, where he will talk about the path ahead for this spending and cut bill. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Good morning, Lisa. President Donald Trump signed a travel ban targeting a dozen countries, including Afghanistan, Myanmar, and Chad. The measure also partially restricts entry from a host of other nations, including Cuba and Venezuela. It reinstates one of his most controversial policies from his first term. Trump says the move was necessary for national security. Meanwhile, shares of Wizz Air are plunging in London, trading falling by the most in 5 years. The discount airline reported earnings that missed estimates and didn't provide guidance, citing poor visibility. Wizz is among the airlines that have been forced to temporarily ground Airbus narrow-body jets because of repairs required on their engines. And Citigroup is cutting jobs. The bank says it will trim its technology employee workforce in China by about 3,500 as part of its global streamlining efforts. Citi is trying to simplify operations and lift profitability to compete more closely with its rivals. Its aim, set out last year, is to reduce jobs by 20,000 by the end of 2026. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, failure is not an option.
We are all in this together. This is a team effort, and everybody is going to be rowing in the same direction to get this across the finish line. Failure is not an option.
Bloomberg's Tyler Kendall joining us next. And coming up in the next hour, as we were just saying, Speaker Mike Johnson, the Speaker of the House, talking about the bill that they have currently in the Senate after passing through the House. This is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Trying to eke out a fourth day of gains, just clawing back to that kind of bull market idea, which we were talking about yesterday. We were so close to it, and yet, even with just some real meager gains, unable to reach it today. Trying again, new day, up 0.1% pretty much across the board for the S&P, NASDAQ, and Russell 2000. Under surveillance this morning, failure is not an option.
We are all in this together. This is a team effort, and everybody is going to be rowing in the same direction to get this across the finish line. Failure is not an option. I'm hopeful that at the end we'll have 51 votes in the Senate, and whenever the bill goes back to the House, they'll have the requisite number to put it on the president's desk.
Here's the latest. Republican senators saying they discussed ways to scale back the $40,000 SALT cap with President Trump. Bloomberg's Tyler Kendall joins us now. It sounded like kumbaya with respect to John Thune. It is anything but, based on the reporting that we're hearing, and frankly, some of the rhetoric we're hearing out of senators and even House Republicans as this process grinds on.
Yeah, hey, Lisa, there's definitely some really contentious issues here, and it's one big, beautiful bill, so there's a few different moving parts that we could pay attention to. But since you mentioned SALT, I did actually have the chance to ask Senate Majority Leader John Thune yesterday what a sweet spot for lifting that cap might be, and he said they are still working that out, which indicates to us that there are going to be some changes that end up making its way into this bill. In fact, I spoke to one House Republican aide who told me that the so-called SALT caucus is still waiting for Leader Thune's call, because $40,000 really was the breaking point for them in the House. They actually had wanted more. And now you have some senators like Senator Kevin Cramer, who came on Bloomberg television earlier this week and said that number could drop down to $20,000 or $30,000. And it was interesting to hear Leader Thune at the White House yesterday basically say there's not a single Republican in the Senate who really cares about the SALT issue, but they do understand that this needs to pass the House when they kick the legislation back over to them. Now, of course, Lisa, a lot of other contentious issues here, but I would quickly also point out we're watching closely what happens to spending cuts. I spent a long time on Capitol Hill yesterday with Senator Ron Johnson of Wisconsin, perhaps one of the loudest fiscal hawks at the moment. He told me he's pushing for ending the expansion of Medicaid under the Affordable Care Act. Of course, this is going to raise questions about cuts to benefit programs. And Lisa, at the moment, Republicans are trying to thread the needle here on what's really a politically fraught issue.
There's so many challenges when it comes to this bill, Tyler, and trying to get Senate Republicans and House Republicans on the same page. And then they have this self-imposed July 4th deadline. How challenging is that deadline going to be, even now more so, that one of their own, a former government employee, Elon Musk, is saying, kill the bill?
Right, definitely, Anne-Marie. There is a lot that goes into what really is this ambitious deadline. And of course, we know that the firmer, the harder deadline is going to be that X date, since there is going to be a hike to the debt limit attached to this bill. But that on its own is already proven contention, since we know the likes of Senator Rand Paul, for example, won't vote for any legislation that does hike the debt ceiling. At the end of the day, there's going to be a lot of different issues that are going to have to come to some sort of compromise here. And we should say Republicans have pretty broad agreement about the core tenets of the bill when it comes to the tax cuts, for example. And they do want to get this done quickly. But when you have somebody like Elon Musk, who's really adding fuel to the fire for fiscal hawks at a moment when the CBO releases a new estimate showing that the House plan would add $2.4 trillion to the deficit over the next decade, that definitely complicates matters for the White House, which at the moment is going on the offensive, calling these senators up directly to try to get them on board with this bill.
Tyler, before you go, I just would love you to comment on how unusual it is for this spending package to be used in tandem with some of the trade negotiations as both sweeteners and potential hooks for trade partners, and that there are provisions in here designed for trade negotiations, let alone the actual budget.
Right, and you're talking about also what's been referred to as the so-called revenge tax, where we could see individuals and corporations alike actually face a higher tax rate if they're from countries that the U.S. deems has discriminatory tax practices. Think about the digital services taxes that this country, or this White House rather, likes to take aim at, such as those trading partners that are in the European Union. Another also interesting part of this, of course, is that other CBO analysis that Anne-Marie mentioned at the top of the program that actually would be in favor for some of these Republicans' arguments that there will be a large amount of tariffs used as creating revenue. But at the same time, we have to keep in mind that while the administration likes to talk about tariffs as a revenue raiser, they also talk about tariffs as a negotiating tactic, which means that there's so much uncertainty here, which could ultimately impact those end numbers that they could see coming into the government.
Tyler Kendall, thank you so much. Great work as always. I am curious about how important it is for markets right now to have a sense that these things are going to get wrapped by July 4th when it comes to the bill, and then July 9th when it comes to some of these trade deals. Lori Cavacina of RBC still with us. From your perspective, is that crucial for markets?
I think there's a window of opportunity, and what I mean by that is we're going to kick off with a very important earnings season in mid-July, and that's really going to be the dominant focus from mid-July through early August. So if they want to sort of capture the market's attention, I think that's when they do it. After that, I think, they don't really have an opportunity. People are out late August, frankly, and then you get into the September and the fall time period. But I think if people really want to work this into their 2026 outlooks, and that's where I hear it coming up a lot with clients, is the stimulus that it could add to next year and make people just skip over the messiness of 2025. I do think if you want to really do that, you've got to bring it forward.
How challenging might earnings season be if these deals are not wrapped up, to Lisa's point, July 4th and July 9th.
You know, it's interesting, Anne-Marie, in this last reporting season, companies did a whole lot of talking about tariffs, but not a lot of specifics. And there was a lot of stuff that was all over the place. And if I'm thinking about the industrial sector in particular, that's really at the center of this, it was, don't worry, we got this, we can manage through mitigation, adjust supply footprints, and pass on pricing. I mean, it was and we have a bunch of inventory. So I think what we're gonna see, you know, in this next reporting season, are those mitigation strategies working? The ones that were going to take longer to come on, how long are those going to take? And my guess is nothing has really been resolved enough to kind of unfreeze the business activity, kind of a freeze that had happened. So we'll obviously get a lot of questions on that, but I think it has the potential to, you know, frankly, be a little bit disappointing, just given the confident tone that a lot of those industrial companies had.
We talk about business community needing a lot of clarity when it comes to trade and tariffs. How important is it when it comes to taxes?
You know, I will say on the corporate side, just looking through earnings transcripts, I have found very few comments on tax policy if I think back over the past year. So I think tariffs are probably more important. I do think that, you know, some of these issues are important for investors broadly. I do think, you know, things like expanding the child tax credit, we always see that kind of stuff pop up in earnings calls after the fact. So I think it'll be meaningful, but I don't know if we'll necessarily see a lot of forward-looking commentary on it.
How do you put into perspective things like Procter & Gamble this morning announcing that it would slash about 7,000 jobs, highlighting some of the potential weaker consumer demand and tariffs, or Walmart coming out and saying that they're going to raise prices due to tariffs. And then yesterday, there was reporting saying that Walmart executives said, we don't aim to be a political figure, we are providing facts as they come, and they stood by, continuing to warn and be transparent about how they were really transmitting some of the costs of tariffs.
Look, I will say that companies across the board, particularly in the industrial kind of materials complex, if you go all the way back to last November, and remember, I'm a transcript junkie. I read these things all the time. I read conferences, I read earnings. People make fun of me for it now at this point. But going back to last fall, after the election, companies in multiple sectors were saying they would pass along pricing if it was needed, that they would try to do all these other things to avoid it, but when push came to shove, they would do it. And frankly, the industrial companies were a lot quicker to say they were going to pass along those prices. So I don't think these consumer companies that have been in the spotlight recently for saying this have said anything that wasn't said by other companies.
This does come, though, with what we saw in ISM services yesterday. That was really stagflationary. We really have to keep highlighting that. The prices paid component of this rose to the highest going back to 2022, even with weaker growth. And I just wonder at what point we can lean into that as a consequence, that there are going to be marginal price increases, and then it will be disinflationary on the longer term, but in the near term, really stagflationary.
No, I think that's fair. And look, you know, I didn't answer your question before on the layoffs, but I've been noticing this as well. I mean, I'm looking at another headline, you know, right now that's talking about job cuts in a completely different industry. And, you know, we do know that certain sectors have sounded less confident about their ability to manage this issue. I would say the consumer sector is one of those. And, you know, I sort of think about this pricing discussion. If you don't pass it on through price, you've got to maintain your margin somehow. That is what companies are supposed to do. So there will be cost cuts in other areas to offset.
Lori Calvasina is sticking with us, and I have to say, Anne-Marie, Transcript Junkie would be a great name of a band. I can imagine it being really hardcore in high school.
She's doing God's work over here, but it's better Lori than us. Yeah. We don't have time for that.
I mean, it's actually really important right now because that actually gives you some sort of indication, and that's what the Beige Book essentially is.
Well, I think also it's interesting that Lori's seeing tariffs and trade consistently come up, but not so much the tax and spending bill.
Yeah, in part because of what you've been talking about, which is it's basically a continuation
of current
policies. So it's not as much of an upside as a continuation of the status quo. Coming up, we're going to be speaking with Krishna Guha of Evercore as President Trump renews his push for a Fed rate cut on the heels of the ADP report yesterday. This is Bloomberg Surveillance.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Trying to eke out a fourth straight day of gains in U.S. equities as they are about 3% away from all-time highs, really close to a bull market, which is a 20% gain since the low that was reached just on April 8th. My gosh, it has been such a huge, tumultuous ride. Right now, the Russell 2000 seeing the outperformance up 0.2%, 3 hours away from the cash open. Here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We start with the stock in the tech space, and that is MongoDB, absolutely soaring up 16%, a big move in a high-priced stock. MongoDB, of course, provides software, database software to businesses, and it absolutely crushed its latest earnings. Hear this. It reported a profit of $1 per share, way above the 66 cents that analysts were expecting. It also raised its full-year revenue forecast and boosted its share buyback program. So MongoDB firing on all cylinders. Next up, we have Five Below, which is actually up 5%, funnily enough. The discount chain, of course, beat expectations last quarter and said that sales are running strong. The new CEO says the focus on product value and customer experience are paying off, with same-store sales rising up more than 7%, reeling in those kids with allowances, as you said yesterday, Lisa. Meanwhile, here's what they had to say on tariffs. They are expecting a profit squeeze in the second half, but they are trying to blunt the impact by cutting back on sourcing from China and working with vendors. And last up, we have PVH, and this is the company behind Calvin Klein and Tommy Hilfiger. Shares are down more than 8% here after it cut its full-year profit outlook, citing a $65 million hit from tariffs, because these apparel companies rely heavily on imports, especially from Asia. So that overshadowing what were otherwise strong results for the company. Lisa?
Thank you so much, Yahaira. And I will just say with Five Below, I don't think that some of the clientele are as price sensitive. Maybe their parents are, but not the clientele when it comes to buying gummy bears and the such. On our radar this morning, Tesla CEO Elon Musk is trying to block President Trump's tax bill after failing to convince Republicans to preserve EV tax credits. Musk posting on X, urging Americans to contact their lawmakers to, quote, kill the legislation, warning that, quote, bankrupting America is not okay, in a real war of words, an escalation between Elon Musk and President Trump.
Right, and we'll be speaking to Speaker Johnson in an hour. And he said yesterday that he called Elon Musk. He didn't pick up his call. He was waiting for him to call him back. So we'll find out on whether or not Mr. Musk actually called the speaker back. The question here for Elon Musk is this really about the deficit, or is it the fact that the House bill pretty much sunsets the green tax incentives from the Biden-era Inflation Reduction Act that obviously is helpful to Tesla? And I think that's a real question right now. And you're going to see potentially more animosity between Elon Musk and this White House. And the president, according to the speaker, this was a 180 for him.
Yeah, and this is a reason why a lot of people are looking to a question of how much this actually does matter and how much this does throw a wrench in the works. The EV price war, in the meantime, is heating up both in China and around the world. But in China, sources telling us here at Bloomberg, Beijing told EV makers, including BYD, to, quote, self-regulate and to not offer unreasonable price cuts. And Anne-Marie, this really highlights how there is a concern about cutting too much and about leaving themselves in a place where they don't have that profitability that's kind of key to continue to innovate.
Absolutely. This is unsustainable, it seems like, from the CCP, what they're telling their companies. You cannot just have this complete race to the bottom, and then basically maybe companies in China could then become bankrupt. What I thought was so interesting about our story is that it highlighted these media outlets that are controlled by the Communist Party in recent days, calling automakers to stop discounting and restore order to the industry. Otherwise, this could lead to low price, low quality products that could damage the reputation and brand of, quote, made in China. And something that BYD has been trying to change, that stigma, made in China, is actually great and sexy. And this car looks like a Tesla.
Right. They don't want to end up just being the cheaper toy. And that's one thing that people keep talking about. How do you get the sort of brand superiority at the same time as having value? But it really highlights, Lori, and I'd love your thoughts on this, how much the auto sector has been just front and center when it comes to government intervention around the world, why it has become the national champion, and how much that makes it really difficult to use this as an investable sector when it's used as a pawn in a lot of the international stories that we keep hearing about.
You know, I think that's a fair point. And, you know, it's a fairly tiny, you know, outside of certain names, you know, fairly tiny market cap, you know, in sort of my world. You know, I think that it's interesting. We ran a study a while back looking at different industries and their correlation with political polling data. And this is one of the ones that topped the list, which I think just, you know, sort of highlights the extent to which it's become a political football. And I know whenever I talk to my analyst, he is always on top of every single bit of tariff news, a lot of it being faded, to be honest. But it is, you know, it is just getting to be so tactical at this point.
Yeah, which is a reason why I think a lot of people, unless they want to get in on the in and out, are sitting on the sidelines. Fed Governor Michelle Bowman, has been confirmed by the U.S. Senate to serve as the central bank's vice chair for supervision. Bowman is expected to shift to lighter regulation than her predecessor. And this, to me, Anne-Marie, just quickly here, highlights how much we haven't even talked about the deregulatory push going on in Washington, D.C.
Right, and this is someone that's going to want to see that, a friendly relationship with the bank industry than her predecessor, Michael Barr, things like bank oversight, the stress test. I also think the direction of travel could be seen up close and personal if you walk into her office. We have a great profile of her from our colleagues today. And sitting atop her filing cabinet is a Make Community Banks Great Again hat.
I love it. All right, well, this might also be part of what won her over in the eyes of President Trump, who did not win President Trump over. President Trump slamming Fed Chair Jay Powell once again, saying, quote, too late, Powell must lower interest rates after weak ADP data. Krishna Guha of Evercore writing, it would take a large and rapid increase in unemployment driven by increasing layoffs to cut in July. It is easy for the Fed to justify remaining in a wait-and-see mode. Krishna joins us now. Trishna, thank you so much for being with us. A lot of people agree with you. At the same time, a September rate cut is pretty much baked in. Does that seem appropriate to you based on the economic data that has been weakening over the past couple of days?
Look, I have a base case of a September cut, but I don't think it's anything close to a slam dunk. I think right now the question is, does the labor market weaken enough over the next several months for the Fed to judge that it makes sense to lean against that weakening with a cut in September? I think to get that, you need unemployment moving up to something like 4.5% by September. I think it's a close call, to be honest.
And this is the reason why I think a lot of people are looking at whether it is just going to be one print, whether it's going to be a collection of prints. Something that caught my eye yesterday, we all are so data dependent, and yet this Bureau of Labor Statistics put out an addendum talking about how they collected fewer data points in the April CPI survey because of a lack of staff. And there's been this speculation about the accuracy of some of these surveys as employment has gone down and, frankly, as responses have gone down. How much credence do you give to some of the data that we get? Do you think that it still has the same integrity?
So, in order to make good judgments, you have to have good data. It's as simple as that. Now, I still think that the U.S. government official statistics, BEA, BLS, are still the gold standard, but we have to be careful because, as you say, some response rates have been coming down, and now we're starting to worry about staffing cutbacks and other funding cutbacks. potentially weakening the quality of these data series going forward. So in any moment in time, you want to look at the holistic picture of the data, all the private sector data, including very much unemployment, so challenger layoffs, Indeed, job postings, and so on, as a cross-check against the official data and sometimes getting ahead of the official data. But I'll tell you, having seen, for instance, how problematic it has become in the UK, where some of their core official government labor data just hasn't been reliable for some time, it can be very, very damaging.
And that's a much smaller economy. So if you're not 100% trusting the data, you don't have policy uncertainty in Washington, D.C., what's your North Star these days?
Well, I think, look, I think we know from first principles that tariffs are going to slow growth and push up prices, right? What we're trying to understand is the relative balance of those effects. I think that we're going to learn a fair amount over the next several months on both of these counts. But my hunch is that we'll learn more on the labor side than we will about what really matters on inflation, which is not the first round price impact, but whether it starts to get embedded into underlying inflation dynamics. So I'm going to be looking at everything, official and private sector, company level data and earnings calls and so on. But what I'm really trying to understand at this point is, do those inflation expectations stay anchored, A, because that's the precondition for even considering cuts, and then B, do we get a material enough weakening in the labor market for the Fed to want to cut, to lean against that gathering any momentum? I think it may still be a little while before we really get visibility on this, but my hunch is that we'll have a feel for that, how much the labor market is deteriorating by September, which makes it the logical moment to call the next move on rates.
Hi, Krishna. Lori Calvasina from RBC. I've been getting good to see you. I've been getting a lot of questions on small caps, which are related to rate cuts. And I'm wondering, in your conversations, are you starting to see expectations that the Fed is actually going to do something in September? Are those moving up? Are those moving down? There's been a lot of dispersion. There's been a lot of shifts in kind of the vibe on the ground. What's your read of the tea leaves right now?
So the market has with this most recent sort of patch of weaker data with ADP and with ISM services, markets moved to price in more conviction, high conviction around a September move, and sort of more than 2 cuts discounted through the end of the year. And obviously, if we get more rate cuts, provided that's not in the context of a recession, if that's a moderate weakening that the Fed's leaning against, that can potentially help the small caps and other stocks. But I think we've got to be a little careful interpreting this. I don't think we should interpret market pricing as saying September is anything close to certain. And I say that as somebody who has it as a narrow base case. I think the reality is that there is still very much a pathway here where we end up with no cuts because the labor market doesn't weaken all that much. There's a pathway where we get 2 or 3 cuts, and that's an intermediate case where there's some softening and the Fed's leaning against that as it emerges, but not before it does. And then there's still the recession case. Is that 25, 30%? Is it a bit more, a bit less? And if we do break into recession this year, then the Fed will be cutting very, very aggressively. So remember that the market pricing is essentially the mean average. It's the weighted average of those 3 different parts.
Krishna Guha of Evercore, thank you so much, as always, for joining us today as we parse through the economic data and the ramifications for the U.S. Central Bank. The ECB will be making their rate decision in just about an hour and a half. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. President Trump says Vladimir Putin has warned him that Moscow plans to retaliate against Ukraine following recent drone strikes deep inside Russian territory. Trump and Putin spoke for over an hour on Wednesday as U.S. efforts to broker a peace deal show signs of stalling. The 2 leaders also discussed Putin's potential role in ongoing U.S. nuclear negotiations with Iran. Meanwhile, for the first time in 6 years, the Indian Prime Minister may miss the G7 summit. This is being attributed to frosty ties between India and this year's host, Canada. Sources tell us that Prime Minister Modi has not yet received an invitation from Ottawa, but officials say Modi is unlikely to attend even if he was invited. India is not a member of the G7, but has been invited to every summit since 2019. And Nintendo Switch 2 went on sale at midnight in one of the biggest global gadget debuts in years. The long-awaited console sells for $450 in the U.S., and GameStop and Best Buy expected to sell out today. The console's success hinges on Nintendo's ability to continue to design compelling games of its own while also accommodating titles from outside publishers. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. It also depends on parents being really patient and wanting their kids to use these things, and I hope if my kids are watching, it's actually been delayed for a long time, so you won't be able to get it. Up next, we take you to the Super Return Conference in Berlin. Orlando Bravo of Thoma Bravo sits down with our very own Danny Berger. Do not miss that conversation about the tech landscape and about mergers coming up. And then, of course, we will be speaking in about 45 minutes' time with House Speaker Mike Johnson here on Bloomberg Surveillance.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's initial jobless claims Thursday before payrolls Friday, and we are seeing ongoing strength in equities, if you can call it that, just really grinding a little bit higher. Although as the session goes on, we're seeing the NASDAQ basically flat. Russell 2000 still up 0.1%. We did see a rally in the bond sphere yesterday, which gave some people hopes that maybe it wasn't all hinging on the budget discussion down in Washington, D.C. A lot of people are watching this as it relates to the credit space, as it relates to the investment space, both in the public and private markets. Now we take you to the Super Return Conference in Berlin, where our own Danny Berger is standing by with a special guest. Danny.
Lisa, thank you so much. I am so pleased to say that joining me this morning is Orlando Bravo, the co-founder of Thoma Bravo. Orlando, thank you so much for joining.
Danny, thanks for having me. It's good to see you.
Well, first of all, great to see you, and congratulations. A more than $24 billion fundraise you just announced this week. And in general, you've been extremely active, selling down your NASDAQ stake, one of the biggest buyout deals with Boeing. But this is a time where this industry has felt really icy and not a lot of movement. So why are we seeing a lot of activity from you and not your competitors right now?
Thank you for bringing that up, and that's one of the reasons I'm here at Super Return. I want to talk to all the private equity funds about this. In our business, you always have to be selling and you always have to be buying. It is actually not a buy and hold forever business. That may be a great strategy, but if you want to do that, you go to the public markets, you get some other types of investors, and you tell them a different story about what you're going to do. For us, we have an extremely clear strategy, and that has two parts to it. Number one is we buy the number one software company in many different categories. And there are hundreds and hundreds of great businesses to pick from, regardless what interest rates are, regardless what the macro outlook is, regardless what the world order looks like. And second, a key part of our strategy is we transform those companies operationally and strategically. And the opportunity for operational gain in software is enormous. One last thing I'll tell you about that. The average publicly traded software company does not make any money. Our average company has a 40% EBITDA margin, and that's the kind of opportunity that we look to achieve.
I'm sure a lot of your competitors would want that kind of thing. So, Orlando, is what you're saying, is this an industry that's lost its way?
Private equity has lost its way in the last 3 years, but it'll come back.
How so? How so?
There are a couple of things. I think private equity leaders have been too concerned about the macro. And I just mentioned that before. Let's predict whether there's a recession, stagflation, what's going to happen to interest rates, what is going to happen once again to the world order. Those are factors that as a business owner, business buyer, you cannot predict, and certainly you cannot control. We have to get down to the basics, which is there are many, many great companies to be bought. And as a control owner and change agent, which our industry is, there's so many companies to transform. Think about it this way. Let's say you buy a company today. Let's say you and I buy a business. And next month, the NASDAQ is up 50%, but our earnings are down 50%. Would you be happy? Now, let's say the reverse. Let's say you and I buy a business and its earnings are up 50% next month. Regardless of what the markets say, you're going to be very happy, and people have to focus and refocus on those fundamentals.
I say one of the big macro issues that affects your world, because maybe you're a little less touched by the tariffs just because software is your core, is certainly AI. And we've seen huge disruptions. You're at the forefront of a lot of it. But even as something as simple as Google search or a mainstay has gotten disrupted by ChatGPT. So when you're doing these really, really big deals for software companies, how do you think about and protect against revolutionary changes that might really hurt some of the software business models?
That's why it's key to be a specialist. In software or in whatever you do, the days of being a generalist in everything, it's too competitive and there are too many disruptions. Now, in the corporate world, in selling software and technology to corporations, and I've said this before, technology is evolutionary, not revolutionary. It does take a while for these corporations to consume technologies. Even today, software as a service companies that should be selling to every single enterprise, it takes about 2 years to convince that company, your customer, of the use case of that application. Do they have budget? What's the ROI? What are the competing choices? Should they build it internally or not? Now, your point on AI is excellent. We believe AI will be transformative, especially to the companies that we're buying. But the companies we're buying have a huge advantage. They have thousands of customers in that use case, and many of them own the data that is heavily important, right, for these powerful predictive models.
Well, I would love to know your thoughts then, because you see this on a ground level. The Anthropic CEO gave an interview to Axios where he said that in the next 3 to 5 years, AI will wipe out 50% of white-collar jobs. Does that sound right to you?
It doesn't. It's a very interesting point of view. It's a very futuristic point of view. But I think it'll make white-collar jobs more productive. and people a lot smarter. Think about how we use it personally. I use ChatGPT and all kind of models all the time. I say, hey, write me a paper on this topic, but then I can think a lot more thoughtfully and more deeply about that topic and improve it and spend my time, once again, much better than rudimentary first drafts on something. Look at investment banking analysts. When I started in investment banking in 1992, there was no internet. If we wanted to run comps on a company, we had to call the library department, go get pages and pages of 10Ks and 10Qs, input all of them, and come out maybe 6 hours later with a set of comps. Now, of course, it doesn't work that way, but there's still more investment banking analyst jobs than when I started in the business.
Well, that's good news, I'm sure, for a lot of entry-level people who maybe were concerned that AI was going to take their job. Orlando, I'm afraid that's all we have time for. We could probably do this all day, so I really appreciate you spending the time. Lisa, that is, of course, Orlando Bravo of Thoma Bravo on the changes that this industry needs to do to stay with it. Lisa.
Danny, thank you so much. A wonderful interview, especially that point about artificial intelligence, especially as we parse through the labor market data to try to understand what's behind it, how much of it is technological and how much of it is actually commenting on the macrosphere. Still with us is Lori Calvasino of RBC. I am curious, Lori, how much that underpins some of the difficulty in analyzing the data that we're going to be getting, not only initial jobless claims, but also tomorrow with non-farm payrolls.
In terms of just the AI dynamics underpinning, you know, I'll go back to what I read in transcripts, which
transcript junkie.
I know, which is an old-fashioned process. You know, and look, I've been watching for clues in the labor market from a lot of different angles, right? Not just AI. And we've definitely seen some companies that have laid off, you know, in certain areas because they are hiring on the AI side. I would say that's the most consistent trend I've seen. I haven't necessarily seen a ton of that, but I have seen some kind of role switching, de-emphasizing this part of the business to more emphasize on the AI part of the business. You know, to be honest, Lisa, like when we look through transcripts, we kind of divide companies into two cohorts. They're kind of the companies that are in the center of the AI build, and all that commentary, you know, sounds really good, and you get really bullish, and you think this thing has legs and is going to be really powerful. And then you get to like on the other end of the spectrum, the companies that are, you know, maybe your typical retailer, and, you know, maybe not as data intensive, and they'll give you what we call kind of these small potatoes examples, where you're just like, this isn't going to be transformative anytime soon. And there are a few in the middle that are maybe a little more techy, and they're really making progress and having some synergies. So I'm more in the camp that this is going to take time and make people more efficient down the road, but it's not an instant bullet.
Lori Calvasino, thank you so much for being with us as always. Our local transcript junkie, who we are always pleased to have on air, Lori Calvasino of RBC. Anne-Marie, it's got to be a couple parts that we have today. We have, of course, the initial jobless claims. Before that, we get the Challenger job cuts announcements. Throughout the day, we're going to be having a key meeting in Washington, D.C. between the German leader and U.S. President Donald Trump, and, of course, ongoing negotiations over this bill.
Ongoing negotiations over this massive tax and spending bill, although at the moment, really all this does is keep current policy with some cuts on the sidelines. How they get this done in 29 days, I think the timeline is going to be really challenging for the speaker.
I think a lot of people would agree with that, and the market's watching closely. Coming up next, we'll be speaking with Tom Becker of BlackRock, Lotfi Karui of Goldman Sachs, Dan Greenhouse of Solus Alternative Asset Management, and of course, don't miss this, House Speaker Mike Johnson here in about a half an hour time. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment. Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
From the Fed's perspective, for them to start cutting interest rates, they probably need to see employment growth not just cool, but really substantially slow down.
If we see any type of weakness in the labor market, that's what the Fed is going to be looking at.
You need the Fed to get in motion. You need the Fed to start cutting rates.
For the Fed, it's going to be very tough to cut interest rates this year.
Our economists expect no cuts this year, 7 cuts next year.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Markets looking for direction ahead of initial jobless claims in just about 90 minutes' time, as well as tomorrow's non-farm payrolls report. Ongoing animosity brewing between Elon Musk and President Trump, threatening to complicate the tax and spending bill. Right now, we are looking at a market that is trying to figure out whether Fed rate cuts are a good thing for risk assets or a bad thing because it means weaker growth. Right now, futures just marginally higher after 3 days of gains. But Anne-Marie, it seems like the data yesterday indicated that there was a real softening under the hood, which would allow the Fed to cut, but really raises a question about whether people are being overly rosy about growth outlooks.
Right. Are we back to the bad news is good news because this means there's a path open for the Federal Reserve? The president certainly thinks so. Those ADP numbers came out. Private sector hiring rose the lowest in more than 2 years, and he said now is the time to cut. Jay Powell called him late, should have already been cutting. And I think what the market is trying to digest, we've seen all this survey data and this consternation about tariffs and trade. Is that now starting to hit the hard data, or potentially are we still just muddling along and we might be here for the rest of the year?
Well, we also have really neglected the ECB, and I say this to President Trump, who is an avid ECB watcher, as we learned yesterday when he tweeted about the ECB and all the rate cuts going there. Of course, he said there were 9 rate cuts. There have been 7. Today might be number 8, but there is a real question going forward about how long this divergence can continue, where you do see Europe getting a green light from CPI reports, from flash recent inflation estimates, getting a green light from the overall market to cut rates at a time where a lot of people have a question mark around the stagflationary types of reactions in the U.S. economy to what's going on with tariffs.
And maybe President Trump is just foreshadowing the ECB, saying they cut 9 times. You made the point last hour, they've cut actually 7 times, but in 13 months. And what's interesting about this meeting is everyone thinks they're going to cut. No, they're going to cut. That's going to be 8 times. It's that actual 9th time. Do they take this pause for the European Central Bank in the summer? And for an individual like President Trump, who's so excited to see the ECB cutting and thinks the Fed should just just follow in their footsteps. They're able to cut because of the policies enacted by him and his administration.
Well, and this really is a question going forward about what the policy mix is going to be in the United States. I can't emphasize enough the July 4th and July 9th deadline is really deliberate in order to create these processes that move in tandem with one another, where the bill directly affects some of these negotiations. How likely does it seem right now? I know you've been talking to a lot of people that we can meet those deadlines.
It's incredibly challenging for the tax bill, 29 days to get all of these senators and House Republicans on board, given the fact that Speaker Johnson had to do gymnastics dealing with all the different caucuses to get all their measures into the bill that many of these senators want to strike down or edit. And then it comes to the trade and tariff story. And I just got back from Europe. What I heard from the top trade official in Switzerland was that she was given assurances by Scott Bessent, the Treasury Secretary, by Ambassador Greer, that if they're still in negotiations but there isn't a hard deal by July 9th, there'll be an extension. So then we're still dealing with a summer of policy uncertainty if July 4th and July 9th come and go and we don't have deals done.
The summer of policy discontent right now you're seeing in markets. Just a little bit of a lift. There was a rally into the bond space yesterday on the heels of weaker than expected data, which seemed to support some of the positive reaction that we saw heading into the close yesterday. Today you see also 10-year yields lower, 4.35%. You can also see a little bit more dollar weakness, 114.28, that just grind lower for DXY and for the euro dollar across. Coming up this hour, Tom Becker of BlackRock as stocks look for a fourth day of gains. Lofty Karui of Goldman Sachs as Treasuries rally on Fed cut hopes. And don't miss this, the gymnast himself, House Speaker Mike Johnson, on the fight for President Trump's tax bill. We begin this hour with stocks on hold as investors await fresh economic data. Tom Becker of BlackRock writing this: market attention could shift away from trade slowdown concerns and instead focus on a global economy that could be running quite hot this summer. Tom joins us now as it climbs toward 88 degrees today in New York City. Thank you so much for being here, Tom. I am curious about how hard it is to push against the recent data that's actually, and I say recent in the past couple of days, been inflecting lower with respect to growth. How much can you say this actually doesn't represent the heat that we're going to see later on?
Yeah, I think once you had Liberation Day and kind of all of the uncertainty that unleashed over the subsequent month, we kind of downweighted our view of both the hard and the soft data that was going to be coming out April, May. So market reaction yesterday to that services PMI, I think kind of tells you a little bit more about positioning than it does about the economy. Kind of that 10 BIP rally in yields maybe telling you that people are set up short because services PMI has been revised a lot the last few years, and particularly coming in the wake of kind of all that uncertainty, we don't think that's a great barometer.
And this actually speaks to your broader call, which is that you kind of are moving away from the Buy Europe trade and are going back to Buy America, which is counterintuitive given some of the pessimism that we've seen of late.
So I think it depends on which asset class. We still think the dollar trades lower from here. We think U.S. Treasuries underperform global yields. So we think kind of the rebalancing that's been kicked off by the change in Trump trade policies, we think that has legs, particularly on the dollar, where foreigners are going to reassess kind of their aggregate U.S. exposure. We think the path of least resistance is to put in some currency hedges, kind of hedge bonds, maybe a little bit of equities. It's a little bit expensive. You can think of that as insurance. But if you think about U.S. equities at this point, they've been real big laggards year to date. People may be lumping those companies in with concerns about the U.S. economy or the U.S. policy outlook. Those companies are going to earn globally based on their kind of competitive advantages. Weaker dollar is good for foreign earnings. They get to redenominate those foreign sales back into dollars. And Q1 earnings were really quite strong. The U.S. was the place where you got earnings growth, and you're getting multiple expansion in the rest of the world on expectations. Europe in particular, a lot of hope. They had the tax cuts yesterday on the corporate side, kind of more good news. But in terms of the near-term earnings outlook, we think the U.S. is kind of where it's going to be over the summer.
So you think, like many, that the dollar is going to go lower. How much do you think this is actually U.S. policy without them actually saying we want a weaker dollar? Because they, of course, will never say we have a weak dollar policy.
Right. So totally agree, Emery. I think the policy is we want a weaker dollar to get some competitiveness on manufacturing, some trade competitiveness. There's a couple challenges with that. One is the interest rate differential. Kind of, you mentioned the ECB is going to be cutting. They don't want the euro going to 120. So you're in this situation where foreign central banks are kind of fighting against their currencies appreciating. So that's going to make it hard to kind of go down on fundamentals if the U.S. growth is strong. But we think the aggregate massive accumulation of U.S. assets by foreigners over the last 5 years, where they've kind of taken all the advantages of getting long equities, long bonds, maybe letting their hedge ratios drift and get more long dollar exposure. That correlation shock you saw in April, I think, was a shot across the bow for a lot of them.
Do you think where currencies are trading is part of the trade negotiations?
I mean, the bilateral negotiations, there are certainly, I think, some Asian countries that are looking to kind of throw that in the mix. Some Asian economies for years have kind of had, we call them dirty floating exchange rates, where they manage them pretty closely. The fiscal and the monetary and the government all kind of coordinate to keep the whole economy competitive. So I think that is potentially bilaterally part of the negotiating.
In the meantime, you have this counterintuitive argument, and I love that, about the way that you try to shift in markets where you're pushing against this idea that the U.S. is going to be the most hurt by some of these tariffs. That seemed to be the idea maybe a week ago, 2 weeks ago. Yeah. It has been the theme that's caught wind over the past couple of weeks. Why do you think it's actually emerging markets? It's actually even Europe.
So in terms of who builds the stuff that Americans buy, over time that has shifted abroad. And we think that there's a real reason now to bring some of that production back home. And so some of the uncertainty that's maybe held back investment the last few months, we think there's a good incentive for producers globally that have factories in the U.S. and abroad to run the U.S. factories hot, right? Like there's a mechanical price incentive to do that. So that's one thing. And the other is I think the U.S. consumer, U.S. innovation, those are really the lifeblood of the economy at the end of the day. And so firms want to locate here in order to access U.S. consumers, to access the human capital, to access the huge unified market. You go to Europe, you have to negotiate with 25 different little regulators. I mean, this is a topic that keeps coming up. The U.S. has this enormous, powerful consumer that is kind of bound by the same rules and principles. I think that's a real benefit.
Do you think Trump's policies are helping that reshoring back into the United States?
I think that the first Trump administration started it. So if you look at kind of import share from China, it's been declining since 2017, 2018. A lot of it went to Mexico and to kind of the near-shoring, the friend-shoring. I think this round of tariffs maybe makes people think, oh, maybe we get a little bit closer even still. And so, yeah, I do think that kind of corporate America had a playbook that was working after China WTO ascension. That playbook's probably not the right playbook for the next decade. And so I think corporate executives, when they decide on their sourcing decisions, are just going to shift them closer to home. And so I think it will have effects.
One thing that I find so striking, and just I'd love a final word on this, the idea that Morgan Stanley was raising that you seem to be reiterating, which is you could see U.S. stocks do well. You disagree with them on U.S. rates. You think that U.S. rates won't necessarily do so well and that yields could stay high, but the dollar will be weak. And that's going to be the ongoing theme maybe for the foreseeable future. How much is this out of consensus right now?
The dollar, I think, is getting more into consensus, but the dollar is an asset that tends to trend, and that's because a lot of huge organizations globally make their decisions on these FX hedge ratios and policies not on a daily meeting or a weekly meeting. These are quarterly, annual stakeholder type meetings. And so I think it can trend kind of for that institutional reason. In terms of the U.S. equity outlook, that's going to be about the earnings. And so if U.S. consumers consume, which they did in the first half, they didn't get unsettled by this, I think you can have U.S. companies put up really strong earnings, and a lot of it is beating expectations. And so the expectations have shifted abroad, positioning shifted abroad, and so it's a little bit the underdog, which is an interesting place to be.
Tom Becker, thank you so much for being with us. Really appreciate it. Tom Becker of BlackRock here in our studio. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The U.S. Education Department says Columbia University no longer meets accreditation standards due to its violation of federal anti-discrimination laws. It's the latest effort by the Trump administration to target elite schools over their handling of pro-Palestinian protests. If it fails to come into compliance, students' access to federal student loans and Pell Grants would be impacted. Meanwhile, Elon Musk is ramping up his fight against President Trump's One Big Beautiful Bill, asking Americans in a post on X to call their lawmakers and kill the legislation. Sources telling us here at Bloomberg that Musk personally lobbied House Speaker Mike Johnson to save EV tax credits in the bill, which would have benefited Tesla. Speaker Johnson will be joining our show at 7:30 this morning. And Alphabet CEO Sundar Pichai says the Google parent company won't stop hiring despite advances in artificial intelligence. Pichai spoke at the Bloomberg Tech Conference in San Francisco.
You know, there's no doubt to me that 3 years from now, there'll be a company which will be dominant in this AI age, which we don't even know the name of today.
Pichai also said whoever runs Alphabet in the future will have an extraordinary AI companion. That's your Bloomberg Brief. Lisa?
Thank you so much, Yaira. In the market for an AI chief financial officer. Up next, betting on a slowdown.
From the Fed's perspective, for them to go ahead and I think start cutting interest rates, they probably need to see employment growth not just cool, but really substantially slow down and maybe even become negative.
Lotfi Karui of Goldman Sachs joins us next on what that means for credit, what that means for rates at a time where President Trump is saying to the Fed, too late, Powell needs to cut right now. This is Bloomberg Surveillance.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Maybe trying to get a 4th day of gains. Good morning. Welcome back. Right now in markets, we're seeing a bit of a lift, although it's fading throughout the morning. And now we've turned negative. The NASDAQ now down about 1/10% after being up about 1/10% or more earlier. The Russell 2000 also has fallen about 30 basis points in the past couple of hours. Meanwhile, in the bond space, and this is something that we really are watching after yesterday's rally, we saw the biggest rally in 30-year yields yesterday, going back to February. 10 basis point decline, and that continues this morning, down 3 basis points, 4.85%. You can see this across the curve, but more notably in duration, 10-year yields lower as well, 4.34%. Under surveillance this morning, this is what's behind it, betting on a slowdown.
From the Fed's perspective, for them to go ahead and I think start cutting interest rates, they probably need to see employment growth not just cool, but really substantially slow down and maybe even become negative. It's the labor market that matters most because that's going to drive consumer spending, and that's really the bulk of our economy.
Here's the latest. U.S. Treasuries gaining as traders bet the Fed will cut rates in September. Weaker ADP data raising expectations of a slowdown ahead of U.S. payrolls tomorrow. Lotfi Karui of Goldman Sachs joins us now. Lotfi, I am curious about how much the rally yesterday gives you some sort of confidence in Treasuries, given the fact that it was ADP. Everyone dismisses this data, and then suddenly it has become the rationale for why there was a rally in long bonds.
Yeah, I mean, look, I think it's a great reminder that Treasuries have not lost their edge as a hedge against the state of the world in which growth decelerates. And so I do think that you still want to own duration going into a slowdown. And I also think we need to sort of frame things a bit differently, which is there a floor on the term premium because of the current and the forward outlook for, the fiscal situation? And the answer is yes. If we have a recession tomorrow, it's highly unlikely that 10-year yields will go back below 2%. But with that being said, yields will go lower as sort of growth slows down. And I think from a multi-asset standpoint, you still want to keep a little bit of exposure to duration to protect yourself against that state of the world.
So just to put sort of a floor under what you're saying, because this is really important. A lot of people, and we're going to be speaking with House Speaker Mike Johnson coming up, they're going to argue, look at what happened yesterday. When economic data turns negative, people go into long bonds, and this has nothing to do with the budget down in Washington, D.C. This has to do with a global move. It has to do with more optimism about the U.S. economy. You're saying, it's a bit nuanced. There is a term premium, but it doesn't mean that these assets will not rally in some sort of negativity. Is that what you're saying?
Absolutely. And I think, if I think about corporate credit or mortgages as an example, you look at the base yield and you decompose it into spreads and treasury yields. Spreads are a very tiny portion of the total right now. And so de facto, obviously, when you own treasury bonds, you're long duration, but you're also long duration if you own corporate credit, if you own mortgages, et cetera. And I think what that tells you is that the bar is still very high to derail price returns because of that negative correlation that kicks in whenever you have a negative surprising growth. And I think tomorrow will be very interesting, by the way, because you're right, ADP usually doesn't move markets that much, and it did yesterday. We'll see what happens tomorrow.
What do you make of this, what Lisa's talking about, this idea that what we're seeing in the bond space is a direct correlation to the discussions when it comes to the one big beautiful bill and the expansion of the U.S. deficit?
To some extent, yes. I think that sort of puts a floor on the term premium. You have to think about it, if you owning duration for the next 10 or 30 years and you look at the fiscal outlook, you are supposed to demand a higher risk premium, all else equal. But that doesn't mean that treasuries have sort of completely lost their edge as sort of, yields moving lower and, as growth decelerates. And so I think there's a difference to me between the two. And then also, there's a relative value view that you can make, which is which point of the curve do you own? Is it 10? Is it 30? Is it 5? I sort of like the 5-year point of the curve. I think there are question marks about the 10 and 30-year.
Well, a lot of analysts have been coming on this show saying they'll stay away from the 30-year, and some are even shorting it. Do you think that potentially they're on the wrong side of the boat?
Shorting it outright, I don't like that. I wouldn't be short duration going into a slowdown. Shorting it relative to the front end, 2s or even, shorter than that, I don't disagree with that view. I mean, the steepener view, unfortunately, became a consensus view today, so you have to be mindful of that. But I do think in relative terms, there's room for underperformance.
What do you make of the fact that auctions are becoming great, for lack of a better word, or greatly important to markets? They've become risk events. We saw Japanese auctions suddenly making front-page business news in the United States as people look to weaker demand, but not as weak as expected. And then next week we have 10-year and 30-year U.S. auctions. How important are they, or is this just a fiction that people have created to try to give them some drama over the summer?
It's interesting because you usually see that type of behavior in corporate credit markets, not in sovereign debt markets. And so the short answer is it is evidence that there's some kind of a fiscal premium that's building up. The fact that these auctions are getting so much attention, globally, yes, of course, that tells you that there is some kind of a fiscal premium. And again, it goes back to the point I made earlier. That fiscal premium will not die out, even if growth slows down.
What does that fiscal premium do to the corporate premium? And I say this because ultimately corporate credit is pegged as a rate to this government bond yield. It has that. Is there a point at which corporates will seem more responsible than governments? And you could
They have been the last 5 years. Actually, if you look at net issuance in IG or in high yield for that matter, corporations have acted in an incredibly disciplined way from a capital management standpoint. And so we have yet to see evidence of any crowding out where actually corporations are issuing more as, the Treasury and other sort of, jurisdictions are dumping more bonds to private investors. So I would say the takeaway from me is that, governments have been sort of, spending more the last 5 years, but corporations and households, by the way, in aggregate at least, have been acting in a fairly disciplined way.
Speaking of government issuance, Nouriel Roubini in the Financial Times this morning in the opinion piece is talking about activist Treasury issuance, which he said started under the Biden administration under Treasury Secretary Yellen, but said even though he wrote this paper with Stephen Myron, who's now in the administration, he thinks it's going to continue under the Trump administration. Do you agree?
Yeah, I mean, look, we'll see where the bill, eventually gets to. But yeah, I mean, the fiscal outlook does point towards more supply in the Treasury market. And I think there's on the short end, and there's, plenty of ways you can play that view. You can play it, in terms of like synthetic versus cash, the bases, et cetera. But yeah, I mean, based on what we know now, that will likely continue.
Going forward, I am curious, you were talking about issuance on the government side and issuance on the corporate side, and I want to finish there. Yeah. Typically, companies borrow for general funding, but also for expansion, for mergers and acquisitions. And that activity really hasn't been as great as people expected because of the uncertainty that we've seen in policy. And I wonder how much you see that reviving later this year versus remaining on hold as people understand, wait a second, I don't know if we're going to hit these deadlines or if it's really going to mark the end of uncertainty.
Look, to see a boom in M&A, you definitely need to see a resolution on uncertainty. But I would say the year-to-date trend isn't as bad as people want to describe it sometimes. Actually, in dollar terms, we're up relative to last year. And granted, 2024 is a low base. In count, we're also up. I think what matters for bondholders is really the funding structures more than anything else. How much leverage are you going to deploy in these transactions? I would say if you believe that we're in for high for longer cost of capital, that sort of makes the economics of a leveraged transaction a lot more challenging today than it was in 15. And so I am positive that once we clear this sort of uncertainty, we'll see, continued rebound in M&A. I don't think the funding structures will be as hurtful to bondholders as they were back in 15, 16, 17.
So basically, you're going to get compensated, and it's not going to be as risky, so it looks good.
I don't think so, because the cost of capital is still too high.
Right. Yeah. Lotfi Karoui, thank you so much for being with us. Really wonderful to see you. Lotfi Karoui of Goldman Sachs there, as we do plan for next week's 10-year and 30-year bond auctions. I hear that, Anne-Marie, you are incredibly excited about that.
Not really. I'm more excited to hear your take on them. I guess it is interesting, though, when you read Nouriel Roubini's piece, which he was expecting a different cadence of issuance, maybe towards the longer end, because you saw individuals in the current Trump administration really go after Treasury Secretary Yellen, saying what she was doing was activism in terms of the yield space. They're actually following the same path.
Well, because at a certain point, if you issue more of what people don't want, you're asking for an accident. And I think that's partly what people are saying. Maybe even reduce the amount of 30-year issuance altogether across the world just because there has been a lack of appetite for them. At the end of the day, how do you deal with long-term funding issues at a time when you have relatively elevated funding costs? And the answer is it's going to be really, really difficult. But we can talk about that coming up with House Speaker Mike Johnson, who will be defending President Trump's One Big Beautiful Bill as it faces opposition in the Senate. Also from Elon Musk, First Buddy, coming out and saying to people, you recommend that he calls people to call on their Congress members to kill the bill. A real question here about what the road is ahead and how important it is to get done by July 4th. This is Bloomberg Surveillance.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Well, early optimism had soured just a touch, at least in equity space. We see futures just marginally lower across the board as we await some key economic indicators. Not only do we get initial jobless claims any second, we also get the challenger job cut announcements. Tomorrow we have non-farm payrolls at a time when we did get ADP data that came in at the lowest in about 2 years. You saw that bid into bonds as a result yesterday. The bid into the long bond in particular, particularly sharp, 10 basis point decline, the most going back to February. Continuing that today, 4.85% in the 30-year space, down about 2 basis points in the 10-year space at 4.34%. You bleed this through currencies. Euro ascendant, 114. North of that, you've got the dollar weakness continuing to persist. The one theme that has been consistent throughout what we have seen. Meanwhile, Elon Musk is ratcheting up his offense against President Trump's signature tax legislation, urging Americans to press lawmakers to kill the bill. House Speaker Mike Johnson saying Musk is dead wrong, and the Tesla CEO vowed to help re-elect the House Republican majority just a day before slamming that bill on X. I am curious, Anne-Marie, how much this really torpedoes some of the momentum that had been underway in the Senate, or whether it kind of is irrelevant based on the ongoing tit for tat on the specific issues.
Well, I think Elon Musk, Ashley, now just gives some credit potentially to those that are saying they're concerned about the deficit, but also potentially those on the Senate side that are saying they want to see these green energy tax incentives continue. And yesterday, Speaker Mike Johnson said that basically this was a 180 from where Elon Musk was, and he said he was going to call Elon Musk. Elon Musk didn't pick up, but he was waiting for him to respond. And we can find out whether or not Elon Musk actually did respond to the speaker. House Speaker Mike Johnson joins us now. Thank you so much for your time this morning. We'd love to begin there. Have you received a call back from Mr. Musk?
Yes, Elon, look, Elon's a good friend. We texted late last night. We're going to talk this morning. I just want to make sure that he understands what I think everybody on Capitol Hill understands. This is not a spending bill, my friends. This is a budget reconciliation bill. And what we're doing here is delivering the America First agenda. This is all of the president's priorities and all the priorities of the Republican Party. Everything we promised the American people, that is what we are delivering with this piece of legislation. And the reason we're using the reconciliation process is because that is the only way to get around the 60-vote threshold in the Senate. Everybody probably recognizes Chuck Schumer and the Democrats are in no mood and not going to be helpful in delivering President Trump's agenda for the people. We have to do it this way. We can do it with 51 votes in the Senate only, and that's the urgency of the hour. And we have to do it quickly for all the reasons we can discuss this morning.
So did you get a sense from Elon Musk in those text exchange that he was going to stop his insistence on this bill that he thinks needs to be killed?
He seems pretty dug in right now, and I can't quite understand the motivation behind it, but I would tell you that what we're delivering in this bill is not only historic tax cuts, but historic savings as well. He seems to miss that. I mean, the projection is that this legislation is going to save us $1.6 trillion with a T. Now, there's never been a piece of legislation ever delivered in the history of government on the face of the earth that saves that much money. So this is truly historic. Now, is it enough? No, because all three of us understand that we have a large federal debt. We've had deficits for some time, and it's a serious concern. In fact, it's the #1 threat to our national security. But this is the biggest step in addressing that problem that Congress has ever delivered, and we must do it. And I will hasten to say this. I've told Elon and tell everyone, this is the first of a series of steps that we will take to bring that debt under control. But you can't turn it on a dime. It took us decades to get into this situation, so we have to do it incrementally, and this is a huge step forward in that endeavor.
What's the driving force behind Elon Musk's problems with this bill? Has he asked you directly to potentially keep the electric vehicle benefits we saw under the Inflation Reduction Act of the Biden era into the bill?
Look, I'll let everybody draw their own conclusions about Elon's motivations. I'll tell you that, I mean, obviously the EV mandate going away is I'm sure a concern for the leader of Tesla and other things as well. But I think there's a lot of confusion out there about what the legislation is. There's certainly a lot of misinformation. I mean, the Democrats have been engaged in this effort, this strategy for many, many weeks and many months. But remember, it took us over a year to develop this piece of legislation. We have 11 different committees in the House, all their areas of jurisdiction, that worked on the reconciliation effort to reconcile the budget. And what we're going to deliver here, again, is historic tax relief and savings at the same time. If we do not get this bill done, the tax cuts of 2017, the Tax Cuts and Jobs Act, will expire at the end of December. Every American will receive the largest tax increase in U.S. history all at once. It would be devastating for the economy. So we've addressed that here. We've made the tax cuts permanent, and we've infused it with a pro-growth series of policies that will get the economy going again. It will be jet fuel to the economy because we're going to reduce wasteful spending, we're going to reduce taxes, and we're going to reduce regulations as well. And that is what will allow job creators in the energy sector and everyone else to get going again.
And your version of the bill, of course, increases the SALT deduction cap, which yesterday Senate Majority Leader John Thune said, quote, there isn't a single Republican senator who cares much about the SALT issue. You and I both know you cannot pass this bill without increasing the SALT deduction cap. How do you envision, though, that deduction changing, given the fact that no senator, Republican senator, wants a vote for this?
Well, I appreciate that they don't. They all come from red states, right? As do I, and we have very different perspective on SALT than our colleagues in the blue states, for example, in California and in New York, in New Jersey. But that is the reality in the House, remembering, and they have to remember, my Senate friends and colleagues have to remember, I have to deliver 217 votes to get that thing across the line if they modify it. So I had lunch with my Senate friends Tuesday last, 2 weeks ago, before we passed the bill in the House on that Thursday. And I encouraged them to modify it as little as possible, right? Because I gave a metaphor. I said, my friends, I am crossing the Grand Canyon on a piece of dental floss, okay? The equilibrium that we reached here took quite a bit of time to get to where we are. And you can't load me up on either side. And if you go and slash the SALT cap that we negotiated carefully for over a year, it's going to make it very difficult for me to deliver the necessary number of votes. Remembering, I can only lose 3 in the House. They can only lose 3 in the Senate to get this done. So we're all working together. It's one team, House and Senate together, united in this effort.
Yeah.
They understand that, and I think they understand, certainly Leader Thune and the leaders over there understand the complexity of what we're having to deal with here.
Speaker Johnson, just to sort of put a bow on it, so 40,000 still likely to remain the cap?
That's what we negotiated here, and I'm certainly trying to hold to that number. And look, we've paid for it. I think we've got it worked out in all the math and the legislation, and I think it's something that I know they're not in love with it, but I certainly hope they'll tolerate it so we can maintain our vote tally over here.
Speaker Johnson, as you walk that piece of dental floss over the Grand Canyon, there is this question of how the bill is currently being used, whether it's for budget negotiations and budget reconciliation over the next decade, or whether it's to negotiate trade agreements. There is $2.8 trillion of revenue that is being penciled in by the Congressional Budget Office from tariffs that might be used as a negotiating tactic, might not be. How do you understand the way that tariffs are looked at as part of this budget balancing act?
Well, it hasn't been included in the calculations, and that's because groups like the CBO, the Congressional Budget Office, as you noted, won't give us any credit for that. But it is very real. I mean, the revenue is real, and it is realized, and it's not included in the calculation that we've made or they've made, but obviously it's a big factor. We believe that we're going to bring about a roaring economy again, and it's not based on conjecture or groundless optimism. I mean, this is based on the history. We did this in 2017. And after the first 2 years of the Trump administration, when we passed the Tax Cuts and Jobs Act, we reduced taxes, we reduced regulations, and the economy was roaring. I mean, you all remember before COVID, we had the greatest economy in the history of the world. I mean, everybody was doing better, every demographic. Wages were up, the job participation numbers were at record highs, inflation was down and manageable, things were going great, and then COVID hit. So we're going to do that same series of policies, implement that same philosophy, but this time, as I say, on steroids, and it's going to make a major difference for in everybody's lives.
Speaker Johnson, a lot of people in markets are concerned about a number of provisions here and actually don't think they will spur growth. One of them being Section 899, which talks about taxing foreign investment in the United States from specific countries that have non-tariff barriers like the VAT tax and other things that have been contentious during negotiations of trade deals. How much do you see that dampening? I mean, is that a concern for you? Because right now, around the world, there are people wondering whether they can still invest in the United States without getting penalized for it.
Yes, look, there's a complexity to the tariff negotiations. I mean, we tip our hat to the White House, and the president's strategy is working. As you know, there's more than 75 countries renegotiating their trade agreements right now, finalizing that even as we speak. That's going to be better for America because it will be more fair. You know, I'm always liken myself to be a Reagan Republican, and free trade is one of our core principles that we've all you know, supported over the years. And every time I would say that over the last several years to President Trump, he would say, yes, free and fair trade. And he's right. I mean, this is a disparity that must have needed to be addressed, and it has been. So we think in total this is going to be good when all the dust settles on the tariff negotiations and the new trade agreements. It's going to be good for America and good for the world. And so we're factoring that in. We're working in tandem with the White House, and it's part of the thought and the calculation in the legislation.
Speaker Johnson, just to be clear, that provision will stay in. That is important to you.
Look, I think it is. I mean, obviously the bill is still a live instrument that's being worked on in the Senate, so we'll see if they modify those provisions. But I think for now, I think that's good policy for us. And I want to say to foreign investors, you're in good stead to invest in America. This is the time to do it because the American economy is about to take off again, and it's going to be good for you and good for the world. We're the largest trading partner for most other nations. They need America, and a strong America is good for the whole world, and that is what we are going to bring about with these sound policies and pro-growth initiatives.
Speaker Johnson, you and your colleagues have a self-imposed July 4th deadline. Partially that is because you have to raise the debt ceiling. Are you considering raising the debt limit if this deal isn't finished by July 4th with a different measure?
Well, it'd be very difficult to do it. I mean, it would require a bipartisan measure in that regard, and I would like to believe that Chuck Schumer and the Democrats in the Senate would do the right thing, but I wouldn't count on that. That debt cliff, as we're regarding it, is coming soon, and that's why Secretary Besson has said we've got to get this done by Independence Day, and I think it'll be a great celebration for all of us. But it's not just because of the debt ceiling. It's also because we need to get tax relief and in this new roaring economy to the American people as quickly as possible. They're owed that, and this is going to be a great thing for everyone. And you know, I have to also think about the politics of it, right? We have a midterm election coming up in 2026. If we get this done soon and quickly this summer, then everyone will feel those effects before they have to go vote again in that midterm election. We want to keep the House majority and keep this going for 4 years for President Trump and not 2. And if we lost the majority, there's no doubt that the House Democrats would try to impeach the president, and everything would be truly chaotic for investors and job creators and consumers. So we have to keep this going, keep the momentum going. The timeline's very important, and that's why I put this on a very aggressive schedule. I said back in the early part of this year that we would pass the big, beautiful bill out of the House before Memorial Day. And people laughed. They mocked me when I said that, but we beat it by 4 days. We're going to stay on track, and we're going to deliver for the American people.
Well, you have exactly 29 days to hit that deadline. Are you saying there's no plan B for raising the debt ceiling if this bill is not done between House Republicans and House Senators?
Look, Republicans in the House and Senate will deliver, and we'll take care of our business one way or the other. But I'm just telling you, the smartest and most efficacious way to do this is to stay on this schedule and deliver for the people, and that's what we're doggedly determined to do. We're laser focused on it, and if we take our focus off of that, then the strategy doesn't work. So I'm telling you that we are working on that regard. Leader Thune and I are in constant communication. He understands that deadline as well. The Secretary of the Treasury and the NEC and all the leaders in the White House and the administration understand that. So we're going to get it done.
Speaker Johnson, how closely are you watching the bond markets right now, given the fact that we've seen a real sense of concern, particularly in longer duration U.S. Treasuries?
We watch it closely. Look, I really do believe that delivering this historic legislation is going to be critically important for a lot of reasons, not the least of which is that Congress can send a very important signal to the bond markets, to the stock market, to investors everywhere, that we're very serious about this, not only in getting the U.S. economy roaring again, but also in addressing the long-term debt. And I think that's an important thing for everyone to understand. We have a strategy that's a multiple steps, as I said, multiple step strategy to address this over the next year, 2 years, 3 years. And we're going to get the U.S. economy back on sound footing. We're the party of fiscal responsibility, and you'll see that demonstrated day after day here.
House Speaker Mike Johnson, thank you so much for being with us. It was really great to hear how this is going on your no-sleep schedule as you careen toward July 4th. There is this question about all of the machinations that have to go into walking that piece of dental floss over the Grand Canyon.
It's incredibly challenging when you have a SALT caucus, you have individuals that don't want to see cuts to Medicaid, when you have deficit hawks, and he's laid out the math right there. The math is incredibly challenging, even more so for him than Senate Majority Leader Thune.
Up next, we'll continue the conversation with Dan Greenhouse of Solis Alternative Asset Management, as bonds do get a bid, and it doesn't necessarily have to do with what's going on in Washington, D.C., but rather economic data pointing to a bit of a slowdown. This is Bloomberg Surveillance.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Some of the optimism fading as we fail to at least get an early 4 days of gains. Right now, futures lower after being higher earlier, at least in the Russell 2000. They've been flipping and flopping, basically steady, a churn under the hood here as we are so close to a bull market, 3% away from all-time highs on U.S. equities. In the bond space, a rally as people look toward non-farm payrolls after the ADP print and after a less than terrible auction in Japan. 30-year yields, the lowest or the biggest rally yesterday going back to February, down an additional 3 basis points this morning. Under surveillance this morning, delivering the American First agenda.
This is not a spending bill, my friends. This is a budget reconciliation bill. And what we're doing here is delivering the America First agenda. This is all of the president's priorities and all the priorities of the Republican Party. Everything we promised the American people, that is what we are delivering with this piece of legislation.
Here's the latest. House Speaker Mike Johnson reaffirming his commitment to passing President Trump's big, beautiful bill. Bloomberg's Tyler Kendall joins us now. Tyler, what's on deck today, and what are some of the big takeaways as we understand how likely it is for them to get a deal?
Yeah, hey, Lisa. Well, we're going to have to see if Elon Musk and House Speaker Mike Johnson end up having that call that he alluded to, as he says that Elon Musk is, quote, pretty dug in here when it comes to his criticism. But Mike Johnson also said that he thinks that he can convince Musk that this is the first in a series of steps to address the deficit, and that could get him on board, even as the CBO released a new analysis yesterday that shows that the House bill, as it currently stands, would add about $2.4 trillion to the deficit over the next decade. Now, a person familiar did tell us that Musk appealed to Mike Johnson directly to save some of those clean energy tax credits. We know that that actually has some Republican momentum, so that's one thread that we're going to be following here. But one of the big takeaways I had from that interview, Lisa, was when you asked him if he's watching the bond market, and he said he was, his answer actually tracked similarly to the answer I got when I posed this question to Senate Majority Leader John Thune yesterday, which is essentially that Republicans are trying to say that ultimately this will stabilize that debt to GDP ratio, and that will be more important if they are able to implement those policies they say will grow the economy. But there's already starting to be questions about how some of these tax provisions in particular will incentivize growth, and you asked him about one of them, Section 899, the so-called revenge tax. And it was interesting to hear him say that that could end up making its way into the final version.
Tyler Kendall of Bloomberg, thank you so much for that. Joining us now is Dan Greenhouse of Solis Alternative Asset Management. And Dan, following that discussion that we just had with House Speaker Mike Johnson, there's a question about how much the bond market has been sending a signal to Washington, D.C. versus pricing in more positive growth. What did we learn yesterday from the rally that we saw, and what actually spurred it?
I actually don't think we learned anything.
Right.
Very easy. But I've had a differentiated view on this. I'm not sure that the bond market is in any way signifying a problem with spending. And we've made this point on the show before. This is a story that we've heard for decades and decades and decades. And I, again, went back and I like to look through old newspaper articles of people talking about the unsustainability of the debt in the 60s and the 70s and so on. 434 on the 10-year right now, let's call it 450, doesn't seem to me to have a problem with the level of spending in the government, nor does it signify to me really that there's any either growth or inflation concerns. It's just like a perfectly benign number in the Treasury market. That's not to say that we don't have a spending problem, because we clearly do. And it's not to say that we don't really need sustainable, meaningful adjustments in spending levels going out in years 5 through 10, which we currently do not have. But it does tell me that there isn't much of a problem now. And when I hear people tell me the bond market is telling, I don't see it.
So do you think there's any problem at all in the bond market? But it's just not coming from policy?
Again, 430, 450 on the 10-year just doesn't seem to me to be problematic. Obviously, as Lisa just mentioned, the equity market is basically back to a high, so that doesn't seem to be having a problem. Listen, I think at the end of the day, the U.S. government spends too much money. We know that, but we also know that we have tremendous taxing capability. We have tremendous assets that we could sell. We have tremendous ways of servicing the debt. Now, don't get me wrong. I don't want to, if viewers are out there thinking I'm sanguine about the level of the debt, it's gross. I don't like it. I wish we did something about it. My point is just I don't see evidence that financial markets have a problem with it.
So there are two ways to think of this. On one hand, you could say, okay, okay, well then the move that we've seen in bonds is no problem whatsoever because it reflects positivity in the underlying economy.
Oh, yep.
Okay. On the flip side, we could say that it's a distortion and it's people being overly optimistic at a time where the economic data is starting to turn lower. And frankly, there is going to have to be some sort of response. So if you don't think it has to do with the deficit, do you think that this bond market has been correct in pricing in faster growth and faster inflation, or do you take the other side of that and really say, actually, there is something else underfoot that we're starting to pick out in the data?
Well, I think, listen, there's three things, and it's usually a little from column A, a little from column B, and I'll introduce column C. Column A is, listen, is there no deficit concern? I mean, I'm probably being a little hyperbolic. Surely there are some corners of the market that think, call it $55 trillion in debt over the next 10 years in total is a little too much. Is there some of this that's growth? Undoubtedly, the data continues. I've been fighting with people on TV about the strength of the U.S. consumer for 2 years now, and we continuously use the word surprisingly. It's not surprising. The economy's doing fine. The consumer's doing fine. The third part, which I think is reasonable and doesn't really get very much attention at all, is the shift in ownership of the bond market, which is partly by design, away from what I call price-insensitive buyers, let's say central banks and pension funds, insurance companies, and towards more price-sensitive investors, hedge funds or more trading-oriented individuals and organizations. That's probably going to put upward pressure on the term premium, as we've seen already happening, which over time is going to put upward pressure on yields. And I think that's a story that's going to play out over many quarters, if not many years, as the inflation and the tariff and the spending story unfolds. But I don't think that story, which may be every bit as important, if not more important than the growth and the deficit side of the conversation, I don't think that really gets enough attention and may, if I'm right, over the next couple of quarters.
But isn't policy in Washington, D.C. exacerbating that exact problem? The fact that we're in a number of trade negotiations and with China, an absolute trade war?
Yeah, that's fair. I think the bigger issue, as articulated most prominently by Stephen Miran, is just the dollar is too high. Part of this larger story about the appeal of the United States, the reserve currency, et cetera, which attracts capital inflows. This is Section 899, which you mentioned in the previous segment. All of this feeds into the desire to hold risk assets. And if, as I mentioned earlier, there's a shift going on here where the U.S. is on the margin less desirable, and I'm not sure that that's happened just yet, that's going to put upward pressure on yield, downward pressure on valuations, which is a larger story. But I think that larger argument about the desirability of the U.S. as a destination for global capital flows, the appeal of the dollar, the appeal of the treasury market, which dwarfs every other market in size, by the way, so there's not exactly a clear substitute in the short term.
Yeah.
That's, I think, is a story that we need to spend more time on.
Dan Greenhouse, we'll spend more time on it with you when you come back next time. Thank you so much for being with us. Dan Greenhouse of Solus Alternative Asset Management. Coming up in the next hour, Neela Richardson of ADP, Joanne Feeney of Advisors Capital Management, Jordan Rochester of Mizuho, and Krishna Mamani of Lafayette College from New York. This is Bloomberg Surveillance.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I never doing that again.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
If things stay status quo, then I think you have the opportunity to see the markets move higher.
Since around mid to late April, it's been the mega cap tech companies that have led.
Volatility could remain elevated, but it's not necessarily an environment where you want to sell all equities.
I would not be adding a lot of equity risk to this rally.
The broader market is really driven by growth in technology, and growth in technology is okay right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks turning as traders try to figure out what the jobs data really means for the forward trajectory of the U.S. economy. Is it the data or is it the policy? D.C. still hashing out the taxation and spending bill as Elon Musk expresses his discontent with the legislation. Anne-Marie Hordern alongside me as always, and I am curious about how much what we heard from House Speaker Mike Johnson really underscored the fact that he was sleeplessly trying to get through something that a lot of people have a lot of problems with.
A lot of people have a lot of problems with, one of them being Elon Musk, and the speaker just said there to us, Musk is digging in, is how he views the situation right now. He did say that the two of them were texting last night, and it feels like Elon Musk is not going to stop on this crusade and trying to kill the one big beautiful bill. And then you pushed him, you're like, where is this coming from? Is it really the deficit, or is it the fact that maybe the House version of the bill is sunsetting those green incentives from the Biden-era Inflation Reduction Act? And he says, I think you should all draw your own conclusions. We do know that he's at the helm of one of the biggest EV makers in the world. So I think you were able to read between the lines there on potentially what the Speaker's office think the problem is right now with Elon Musk.
And we are so lucky this hour because we have alongside us Neela Richardson of ADP after that report yesterday spurred a response from President Trump talking about how maybe it was time for the Fed to cut. We did see a number that was much lower than expected on ADP yesterday, which signaled that maybe there is a significant cooling in the labor market. Neela, you are the perfect person to give perspective into this. How much is that a valid reading of those numbers?
It is clear that hiring momentum has slowed. First of all, good morning. It's great to be with you. It's clear that the hiring momentum has slowed from the beginning of the year. 37,000 is the lowest we've seen at ADP since March of 2023. What's also clear is that there is enough resilience in this labor market to spring back. If you look at wages, and we calculate a lot of wages at ADP, you'll see that there is still strength in pay gains. That means there's still efficiency, productivity, and companies are keeping their workers in this labor market. So it's a tale of two. Slower hiring, but still a lot of resilience.
Well, this really speaks to the churn under the hood, and that is what we're seeing right now in markets with equities just trying to figure out which direction to go in after 3 straight days of gains. Still, we do have to remind you that we're about 3% away from all-time highs, and we potentially are on the cusp of a bull market. So people not necessarily taking extra heat there. In the bond space, you do see a bit of a rally at the long end, which is completely different than what we had seen for the bulk of this year, particularly at the 30-year yield, the risk asset that yesterday saw its biggest one-day move going back to February, down an additional 3 basis points, 4.85% today. Coming up this hour, we've got Joanne Feeney of Advisors Capital Management with the S&P 500 on the brink of a bull market, Jordan Rochester of Mizuho with an ECB rate decision around the corner, and Krishna Mamani of Lafayette College reacting to the latest economic data. But we begin this hour with stock steady following 3 days of gains. Joanne Feeney of Advisors Capital Management writing, trade policy risks have worsened and uncertainty is here to stay for a while. Joanne joins us now for more. Joanne, thank you so much for being with us. I'm curious what your takeaway is from trade policy versus economic data. Is it true that the market can only focus on one at a time, or is there a sense that the economic data will ultimately trump a lot of the policy uncertainty?
You know, Lisa, I think it's the earnings data that could trump policy concerns. Clearly the tariff risks have not gone away. We've got that doubling of the steel tariff, which is a significant input to a lot of industries. That's a problem. So we have the tariffs that are outstanding. We have potential new tariffs coming, or maybe not. Maybe they get negotiated away. But if we do see prolonged elevation in costs for both firms and consumers, that's a kind of like a negative supply shock for the country. And at the same time, we're seeing evidence of a negative demand shock that is being created by all of the chaos and uncertainty. We're seeing firms delay orders. We're seeing hiring slow down. In fact, labor turnover, hiring that is, and quits and firing are pretty low right now. And that's actually a pro-cyclical indicator that suggests economic activity may be slower than we're currently measuring it.
Well, this raises a question about what we're hearing from anecdotal companies. And I say this both with respect to the Beige Book as well as Procter & Gamble that said it was going to cut 7,000 jobs because of some of the tariffs and other issues that are going to crimp costs. We heard Walmart is going to communicate more directly how much they're going to have to increase some of their costs. That's the inflation side, but also potentially curb employment in certain places for specific reasons. I'm just curious, are those, or at some point, do those matter to you from an overall kind of sentiment read?
Yeah, I think those examples are specific to the types of business models these companies have, right? We know that the tariffs are going to be more impactful for companies with thinner margins. Walmart has an awful lot of pricing power from their suppliers, so they can try to buffer it. But even they are saying basically that they can't stop all of this from passing through to their profit margins. I mean, their consumer base is not the wealthiest in the world, and there's only so much they can pay in higher prices. So I think these examples are useful to pay attention to. Obviously, they're not data, and so far, right, the hard data is holding up pretty well. But some of the indicators out of the ISM, show us that things are potentially slowing down in a way that we need to keep an eye on. But ultimately, it comes back to earnings. What are these companies going to tell us over the next 6 months?
Right. Joanne, I hear what you're saying, that the proof is in the profits, so to speak, and if the earnings can hold up, then we might get a different reaction in the capital markets. I'd like to concentrate on the tech sector since it's such a big driver of whether or not we reach this bull market and how long it's maintained. Is the worries that you're seeing on the labor side or on the policy side, does it extend to those frontier firms that are really driving the bull market higher?
Yeah, that's the one area, that's a very bright part of the market and of the U.S. economy and the global economy. I mean, I've written a couple of notes recently about the power of generative artificial intelligence to, keep innovation growing. And that's, I think, the new growth engine for, at least a decade. And so, no, those are real improvements in materials, in products, in services, and it's spreading across the economy. It's creating demand for energy, for utilities, for industrials. So that's real, and they obviously have much bigger profit margins. And also, their products in many ways help other companies improve their cost structure. And so, in a situation where economic conditions are becoming more difficult, perhaps we could expect that those AI providers, application providers, are going to see more demand. So that's an area where we think it will continue to grow. We do have significant exposure there for our clients. We'll have Broadcom reporting tonight, and they've been in a center position here. We've held that company for our clients for a very long time. And we do think they're going to provide further evidence that the growth engine continues to hum along.
When it comes to more policy in Washington, D.C., we touched upon what's going on with trade and tariffs, but I'd love to get your thoughts on this idea, which Dan Greenhouse in the last hour just put some cold water on, as well did Speaker Johnson, this idea that it's the House bill that is continuing to, because it's going to increase the deficit, that's continuing this nervousness in the bond market. Do you buy that, or do you think that it's other issues?
Well, the bond market kind of captures everything. But I do believe that the difficulty of shrinking the deficit and therefore the debt longer term is one that every fixed income investor should be paying attention to. I mean, right now, it's debt is pretty high. 100% of GDP. That's not off the charts. We have other developed countries that are higher than us, like Japan. But we can't sustain the continued increase in the debt forever. And as long as interest rates remain high, that becomes more and more costly. So I think there's legitimate concerns about this bill because it doesn't do a lot to improve that situation. And I think what everybody is recognizing is awfully hard to get the deficit under control without raising taxes somewhere, because we have so much of the government budget that is non-discretionary. And so it really does put legislators between a rock and a hard place, and therefore the bond market says, okay, this is going to continue for a while. It's going to keep longer-term interest rates higher for longer.
Joanne Feeney of Advisors Capital Management, thank you so much for that perspective. And Neela, this is something that people keep talking about, the idea that that is one of the aspects behind the bond market. I just wonder if this bond market really is a problem. To Dan Greenhouse's point, is it crimping investment by businesses, or is it something that's totally normal and actually appropriate given the growth levels that we're seeing?
I think bond markets are used as a tool, right? They're supposed to have this special relationship with equities. So the correlation should hold if it's supposed to work in terms of any portfolio. If those correlations are breaking down, it's not just the volatility in the bond market that's a concern. It's the fact that they're not doing their job in managing that risk on the equity side.
And in the meantime, we have, of course, the ECB poised to have a decision in less than 5 minutes' time. President Trump is probably standing by watching to see what they do to understand what the Fed's response function should be in terms of responding to inflation that seems to be coming down.
That's right. He's probably waiting to tweet, as he did yesterday, off the ADP numbers. Neil, I'm sure you saw the ADP numbers, world famous now in the Oval Office. But what's so interesting is Europe is able to lower because of the policies coming out of Washington and what that has meant for the European Union, for the euro, and for the EU's landscape when it comes to the fact that they're dealing with all this trade uncertainty in Washington and people are looking for other places to invest.
Well said. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Trump signed a travel ban targeting a dozen countries, including Afghanistan, Myanmar, and Chad. The measure also partially restricts entry from a host of other nations, including Cuba and Venezuela. It reinstates one of Trump's most controversial policies in his first term. He claims the move was necessary for national security. Meanwhile, in sports, the Edmonton Oilers are up 1-0 in the Stanley Cup final after a thrilling Game 1 victory over the Florida Panthers. The Oilers came back in the third period to force overtime, where Leon Draisaitl scored the game winner in the final minute of that overtime. Game 2 is set for tomorrow night in Edmonton. And Elon Musk is ratcheting up his criticism of President Trump's One Big Beautiful Bill, telling Americans to press their lawmakers to kill the bill. House Speaker Mike Johnson just earlier telling Lisa and Anne Marie he's working with the Tesla CEO.
Elon's a good friend. We texted late last night. We're going to talk this morning. He seems pretty dug in right now, and I can't quite understand the motivation behind it. But I would tell you that what we're delivering in this bill is not only historic tax cuts, but historic savings as well. He seems to miss that.
Johnson also saying the tax bill is a step to bring U.S. debt under control. Of course, others disagree. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Coming up next, Jordan Rochester of Mizuho with an ECB rate decision right around the corner. That's coming up next, and this is Bloomberg Surveillance.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
We do have a rate cut. Welcome back. The ECB cutting rates as expected by 25 basis points to 2% for the deposit facility rate. This was what was expected. Also seeing 2026 inflation at 1.6%, a prior forecast of 1.9%. This idea of possibly lower inflation, allowing them to cut more than people previously thought. Inflation is currently around the 2% medium target. This, according to the ECB, raising questions yet again. Just one more rate cut? Could they potentially cut more? Right now, Bloomberg's Lizzie Burden joining us with some more details. Lizzie.
Well, of course, the focus isn't necessarily on the cut itself today. That was widely expected by markets, given the euro area inflation has dropped below the 2% target to 1.9%, given you've had the lower energy prices and the rise in the euro against the dollar in the aftermath of Donald Trump's Liberation Day, of course. So the focus really, as you say, on the path ahead and clues as to when they're going to cut again. Is it going to be in July or in September, as economists expect? And if we look at that inflation forecast, as you say, they have downgraded, as expected, the inflation forecast for 2025 to 2% now from 2.3%, for 2026 to 1.6% from 1.9%. And there is, among some on the Governing Council, a concern about the persistent undershooting of inflation, but others, like Christine Lagarde herself, say they need to look through that, given all of the risks in the medium term to the upside to inflation, not just from tariffs. If Donald Trump, for example, raises tariffs from 10 to 50% after that July 9th deadline and the EU retaliates, but also from the expansionary fiscal policy as well. Now, in terms of the market reaction, and I know you'll talk to Jordan Rochester about this, because the traditional link between FX and rates has been a bit severed in recent weeks, we weren't expecting a huge amount of euro volatility off the back of this. The focus really, frankly, is more on the non-farm payroll payrolls report tomorrow. So now we look ahead to the press conference. I am sure Christine Lagarde is going to keep her cards very close to her chest when she's inevitably asked if a follow-up cut is coming in July. And I'm sure she'll also be asked about her own future here at the ECB, because there's a lot of speculation that she wants to go and lead the World Economic Forum, and she hasn't denied that she's considering it so far, and it would make sense given that inflation's back below that 2% target.
Lizzie Burden, wonderful reporting. Thank you so much for being with us. Right now in markets, as you're saying, the euro trying to figure out what to do with this, but you are seeing a clear move in German bond markets, yields lower on the heels of what seems to be indicating that there is more room to cut from an ECB that now sees inflation well within that 2% range and downgrading expectations, which you can see across the board is a rally, particularly into the long end. German 30-year bonds now below 3%, 2.95%. What you see in the U.S. is that actually adding to the United States rally that you have seen in bonds. The idea that maybe if the ECB can cut, so too can the United States. Right now, 10-year yields 4.34% in the U.S. Joining us now, Jordan Rochester of Mizuho. Jordan, your first take on this.
Well, it's a dovish outcome in terms of the inflation forecast, the 0.3 revision for the next two years in terms of the numbers for 25 and 26. However, the elephant in the room is what's not in this statement, which is what their view on the impact of trade tariffs. We'll get that at 2:45, that release. That for us will be the scenario analysis. Do they double the impact that they expect from tariffs? What about the 50% from Donald Trump? So a lot of this will have to come out in the press conference. So far, the moves are quite small, though. FX, Euro slightly higher. And in the front end of the rates, you've only had a two basis point rally. So nothing too big. We wait to see what Lagarde says later on and those forecasts and those scenarios that come out later this afternoon.
Well, some notice we have when it comes to trade that the ECB statement says trade escalation would lead to lower growth and inflation. Jordan, how do you start thinking about if the European Union doesn't get a deal with the U.S. by July 9th?
Anne-Marie, I think the EU is probably at the bottom of the list in terms of the major partners. If you think about it, Japan, India, Vietnam, there's much more focus on those negotiations. When it comes to the EU, there's a lot of lobbying to go hard on the EU to reform some of the non-tariff barriers they have, such as the digital services tax with the US and various other sort of non-tariff measures. That's something that's very difficult to agree to by July the 9th. So what might happen is a stopgap, another delay, essentially. That's the best the EU could hope for. We saw that when Trump ramped up the tariff to 50%. We saw an immediate delay, really. It happened within a day or two after one phone call with Ursula von der Leyen. So I expect that the worst case scenario is the tariffs come in at the reciprocal levels, which are around the 20 to 25% level. And the EU will be facing a summer of weaker data as a result and a more dovish ECB. So we're looking for more rate cuts from the ECB than the market's pricing. We like receiving the front end for September, for example. We expect rates to get down to 1.5. This market's pricing around 1.7. Now, if there is a deal done, it's still going to be a 10% minimum. So we're picking between bad and worse scenarios for the ECB.
Is there a scenario, though, where you do think the ECB goes on pause and misses a meeting?
There is, if you see PMIs continuously surprises, if you have an upside surprise in the PMIs on the next release. The difficult thing about that is the PMI comes the morning of the ECB meeting, so it's going to be really difficult to trade around that event. It could be if you have strong CPI, but if you look at the CPI data, we just had a big downside surprise in services CPI, and the curve, in terms of what the link market is pricing, has inflation below 2% for the rest of the year. So it's really hard to get a hawkish meeting, but Anne-Marie, I've got to be honest, some of the ECB hawks really have surprised me with their comments suggesting we should have a slower pace. They are the hawks, so hawks have to be hawkish. I think the core unit of the ECB and overall will still vote for a rate cut in July, and not enough surprised. But we need to see how this press conference goes.
Hi, Jordan. I understood that there's a lot of attention to the upside risk of inflation coming from tariff policy, but I want to ask a question in the opposite direction. If inflation in the EU continues to undershoot the ECB's 2% target, is there a risk that real interest rates actually turn closer to that zero bound or even negative in the next 2 or 3 years?
I don't think the risk of that is too high, actually, because what we're seeing is inflation is coming down. The ECB's forecasts today have it below 2% for the next 2 years, really. When it comes to the real yield, you've got to think about the nominal side as well. So we're dovish on the ECB in the short term, but actually kind of linking to the question Anne-Marie mentioned, the German fiscal stimulus will make it difficult for real yields to be materially weak, because what we're going to see in Q4 is the budget is passed in Germany and we'll have much larger amounts of issuance in 2026. The hawks of the ECB might be able to hang on to that, but that is over 6 months away and quite difficult for this market to trade every single day. But for long term, I find it very difficult to see real yields underperforming in Europe because of higher nominal yields I expect to see, with the German 10-year bund getting to 3.3%.
How much of a sea change, a game changer, is German issuance for the ECB?
It's a massive game change. We've had many years where the weak growth in Europe was underpinned by the lack of, or the fiscal austerity we saw in Germany for the past 2 decades, roughly speaking, compared to what others should have done. The Germans have a lot of fiscal firepower, debt to GDP in the 60% level sort of range, and the infrastructure alone, that package, it's 500 billion euros over 10 years. So that's at least 1% to 1.25% of GDP from next year onwards. We don't yet know what the numbers will be on defense. We don't yet know the numbers. We've got a sense of what it will be on tax cuts. We had the 42 billion to 47 billion from the headlines this week for corporation tax cuts. So the numbers will be large. Germany starts from a very strong position, and that's why you're going to see the fiscal firepower matter quite a lot next year.
It's a great question, Jordan, that Neil is raising at a time when potentially the ECB is looking at subpar inflation below that 2% level. How inflationary are some of these fiscal packages that Germany has floated?
Well, it depends on if you're going with tax cuts, that's immediately more inflationary than when it comes to infrastructure spending. So we have to know the sizes of these numbers. So if the tax cuts, we take, let's say it's 50 billion, that's a pretty sizable number for that. Well, that's something that will have to be reflected in their forecast. But it is just a German number, and you've also got the problem with the rest of the Eurozone is you don't have the same fiscal firepower. So the ECB can't get too optimistic from Germany alone. You have France, which is fiscally constrained. You've got Italy and Spain not really able to move the needle on things either. But then when it comes to the infrastructure spending from Germany, that is a big positive that markets like. It improves productivity and expected growth, but it won't translate to high inflation on day one, because building bridges and so forth, it'll boost commodity prices and it'll raise the price of building services, but it won't affect everything else in the main.
Jordan Rochester of Mizuho, thank you so much, as always, for the insights. Neil, you raised a really great question, which is this idea of the lower bound. And people said we would never see negative rates again. We've already seen them kind of in Switzerland, but I digress. I am curious about what this says if they see inflation falling below that 2% target as soon as next year.
Right. So remember their past, that 20 years of lackluster growth tied to that zero bound and dipping underneath it. I'm sure it's a past that the ECB doesn't want to return to, and they're looking forward into a different future where the risk of inflations are going up, not down. But I wonder just how material that downside risk is and how it could affect all kinds of things, including the issuance of German bonds.
Yeah, especially if China, say, is going to become a stronger trading partner with Germany, with Europe, and necessarily lower prices to get some of those goods in there. Coming up, we're going to be talking about U.S. economic data breaking trade balances as well as jobless claims. Krishna Mamani of Lafayette College here to react, of course, with Neela Richardson as well. Right now, we are seeing bond markets get a bid after that dovish ECB decision. This is Bloomberg.
flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
25 seconds away from initial jobless claims as these crucial indicators give people a final look ahead of non-farm payrolls tomorrow. Equity markets churning as they try to digest economic data that was weaker than expected yesterday, plus an ECB rate cut that's moving bond markets. 10-year yields both in Germany and the U.S. lower on the day. A pretty sharp rally in German 10-year yields, not figuring out what to do with it as the euro versus the dollar right now. With the economic data right now, let's get to Michael McKee, Bloomberg Economics and Policy Correspondent. Mike.
Good morning, Lisa. We don't have jobless claims over the wire yet, but we do have the trade balance at $61.6 billion. That is less than half of what we saw last month, 140.5. And of course, that's in part because we see a big drop in imports. We'll get a number on that for you in a second. Initial jobless claims come in at 247,000, so a slight rise from 239 the week before. This is a rise, and it is in a higher area, it sort of goes above the bar that we've been trading under for a while, but it isn't a huge rise, so it does suggest a little bit of additional weakness in the labor market, but not something particularly to worry about. The continuing claims number, 1,904,000, is actually a drop from 1,907 the week before. And then finally, we have updated non-farm productivity, negative 1.5%. That's worse than the negative 0.8%. This, of course, is for the first quarter. And unit labor costs up 6%, up from a 5.7% in the second revision last time. So at this point, we got a little more inflation, a little more weakness in the labor market, and we've got some strength in the growth figures for the second quarter because the trade balance is cut significantly in half.
Michael McKee, thank you so much for that. Right now, we're seeing markets respond to that in the front end of the U.S. yield curve in particular, sharply lower on the heels of that non-farm, of what we saw with initial jobless claims. So lower than expected, but not necessarily something particularly exceptional. Still, it is the highest level going back to October of 2024 with 247,000 initial jobless claims. Neela, what's your take on this?
The take is, to me, that they're still not at a worry point, but the second week in a row of an increase is something to keep a watch on. I don't think people will get really excited until we get well above the levels that we are now. To me, the most interesting part of that, all of that data, was the productivity numbers, because that is the future. And to see that negativity, in fact, productivity is what made U.S. growth exceptional the past year, 2 years. When we talked about U.S. exceptionalism, it was about, in large measure, productivity. So to see those numbers get revised in the wrong direction is actually the biggest concern of everything I heard just now.
Yeah, and it kind of flies in the face of what we heard with respect to artificial intelligence and some of the productivity gains that have come from there. Just before we move on, how much is this tied to immigration and potentially some of the loss of the employment force?
You know, I think you can't, immigration is such a big part of the labor market. I don't know if this slight uptick in the layoffs, are you talking about the productivity numbers?
The productivity numbers.
It's hard to tell at this point. I think there might be quite a few drivers there, but remember that before the pandemic, we were looking at levels like this, and it was really the pandemic that triggered an increase in productivity. So on the other side, are we going back to where we were before the pandemic? That's the question I'd like to ask on that.
Tomorrow becomes really interesting now because we are seeing this tick higher. Neil Dutta just publishing saying we're getting close to some soft employment numbers. And you wonder, are we going to get that tomorrow? And then what would this mean for this Fed? Does this give them this pathway to potentially cut interest rates?
Maybe a pathway. It doesn't seem like they're necessarily going to cut right away. Neela Richardson is sticking with us, and Mike McKee is also going to stand by and parse through there. But in the meantime, joining us now, Krishna Mamani of Lafayette College. Krishna, thank you so much for being here. Great to see you. How do you use data like this that isn't bad enough to cause the Fed to make a move, isn't good enough to give you confidence? It just is maybe a trend that we maybe can ignore, maybe need to pay attention to?
Well, so if we ignore it at our peril. That is, I think the economy, as Waller, I think, rightly articulated, the economy is slowing. It's not slowing at a precipitous pace, but it is definitely slowing. And you can see that it used to be in the soft data. Now the soft data improved, but the hard data is softening. So I think there is a substantial trend for slowing in the economy. It's, again, not precipitous, but gives the Fed the path to cut rates, not today, but in the later half of the year.
In your opinion, what would it take to see that cut? What would it take in terms of whether it's jobless claims or continuing claims or the unemployment rate, the mix of it all? How dire does the labor market data have to be to challenge the fact that the economy is fine and can continue to grow?
I think the Fed on that count has kind of been very clear. That is, at the end of the day, what they're focused on for cutting rates is really the employment picture. If the employment picture deteriorates meaningfully, not 1 month, but on a couple of months in sequence, I think that's what gets them there. Again, I think even if we get a soft employment report tomorrow, that is just not enough. However, if we see that in the third quarter and on a consistent basis, I think they have the pathway to cut rates.
Even a data-dependent Fed that keeps saying that they need certainty, and they're very unclear at the moment where trade policy might mean for inflation?
Well, so I think from the Fed's perspective, tariff is really a wild card because they don't know. They don't have enough of an empirical framework to kind of figure that out. And for that, they will wait. On the other hand, if simultaneously, if the markets, if the employment markets are deteriorating quite substantially, I think they have the headroom in terms of where policy rates are today relative to where inflation is for them to be able to cut on a proactive basis as opposed to just on a reactive basis.
Following up on Neela's point, quite substantially, what is that, 4.5% unemployment rate? What's the line in the sand?
I don't think it's the unemployment number itself. It's really the trend in employment growth that on a consistent basis, several months, comes in significantly lower than what the trend rate has been.
Like last year when they cut.
Yeah, exactly.
But it raises a question about how much it would matter, right? How much we're kind of talking about the wrong issue. Is the issue really how much will take the Fed to cut? Or is the issue, are we slowing or are we stalling out? And I think that that's the bigger question maybe for both bond markets and for the Fed. It's not just, do you have to adjust things on the margins? It's longer term, how much heat is left in an economy that has a lot of question marks around it?
Well, so that's a really good observation in the sense that even if the Fed cuts, let's say, in the end of third quarter or early part of fourth quarter this year, the likely impact of that on the markets, at least equity markets, is probably not going to be as positive as people are expecting it to be. Because I think in the throes of a tariff situation, if they are cutting rates, then they are really, really worried. That's bad news that will end up being bad news for the equity market. So that's why I think equity markets at this point, the only upside is really going to come from productivity growth, earnings growth, things like that. And that is not looking very likely at the moment.
Right. I want to follow up on that statement and Lisa's question. And I realize we're asking you to ping pong between the real economy and the markets right now. But What are the growth drivers that you see in the second half of the year that really catapults the economy forward, that raises those productivity numbers? Is there something that we're waiting for to happen that could really trigger that growth?
I don't think there's really anything substantial in the pipeline that can get you there. I think the fiscal impetus that is, or the fiscal impulse that has been in the place because of deficit financing is really what is carrying us through. In that mix, tariffs are basically a contractionary policy. So I think we are trying to balance. There's really no significant stimulus coming into the economy until the tax package passes, and then we see the implications of that in terms of further deficit increase.
Michael McKee is still with us, and he's been parsing through the data. Mike, in addition to jobless claims, some really interesting trade data as you parse through it. What are you seeing?
Well, basically what we saw, Lisa, was a pull forward in imports. Imports dropped by 16.3%, and that pushed the overall trade deficit down by 55.5%, and the Census Bureau says those are the two largest declines in those categories ever. Now, it's all statistical noise in the sense that we didn't make a big deal out of the rise in the trade balance in January, February, because we knew it was the pull forward of imports, but it does have an effect on the overall data. We'll see a bigger rise in second quarter growth than we saw. We saw the big fall, of course, in first quarter growth. And the one thing to point out about jobless claims is this is the biggest jump, or the highest level, rather, in 8 months. And it's the highest 2-week in a row level in more than a year. So we do see some weakness here. Neil Dutta writing in that that you have about a 260,000 level would be the break even for jobless claims. And if we get above that, we're going to see weak payroll numbers. So we'll see what we get tomorrow. But of course, we're starting to see the numbers come in. Procter & Gamble today saying it's going to lay off 7,000 people. So it's starting to weaken out there.
Mike, before you go, just a quick note. How much are you getting people questioning the integrity of some of this data? As we got reports yesterday from the Bureau of Labor Statistics that they didn't collect data for CPI in certain regions in April due to budget cuts.
Well, CPI is the one that's being affected most and first, but there are also concerns about the labor data as well. What's happening is the government has cut funding and not kept up funding for years, and then we had the DOGE cuts, so they're behind the 8 ball. They can't really collect all the data that they have. Now, the data that they do collect is going to be used as well as it possibly can be, but just because you have fewer people collecting it and less data, you're going to have a wider margin of error.
Michael McKee, thank you so much. Krishna, what exactly do you do with this? The idea that the granular data shows some degree of weakening, and yet there's a question about just how accurate it is on any given week.
Well, so it's kind of a sad state of affairs that the best statistical data collecting agency in the world is struggling to kind of do the surveys that we desperately need at this time of transition. But it is what it is. However, I think they do enough data collection for it not to be kind of disturbed in a significant way, and you can probably derive the basic trends out of the data that they're collecting. But I think, again, I would reiterate my point. It's a very sad state of affairs.
But does the data even matter when the policy is changing so quickly?
Well, so data does matter, because how would you expect a policymaker whose one mandate is employment to kind of react to it if they don't have accurate data and a really clear picture of what the impact of the various policies are on the economy? Without that, we are blind, and that would be a terrible state of affairs.
I mean more for the markets, not the real economy, just to put it clear.
So I think to some extent markets do react to policy. And for the policy to be commensurate with the state of the economy, we need that data.
Krishna Mamani of Lafayette College. Don't be a stranger. Great to see you. Thank you so much for being here. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The ECB cut interest rates by 25 basis points, expecting trade uncertainty to weigh on business, investment, and exports in the short term. It's the 8th time in a year that the central bank has lowered rates. ECB President Christine Lagarde is speaking momentarily. We'll bring you those remarks live. Meanwhile, President Trump says Vladimir Putin has warned him that Moscow plans to retaliate against Ukraine following recent drone strikes deep inside Russian territory. Trump and Putin spoke for over an hour on Wednesday as U.S. efforts to broker a peace deal show signs of stalling. The two leaders also discussed Putin's potential role in ongoing U.S. nuclear negotiations with Iran. And the NBA Finals tip off tonight between the Indiana Pacers and the Oklahoma City Thunder. For top-ranked Oklahoma City, it's their first trip to the finals since 2012. They're the heavy favorites over the Indiana Pacers, who return for the first time in 25 years. Both teams have gone 12-4 so far in the playoffs. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, setting you up for the day ahead. And, of course, ECB President Christine Lagarde's press conference. Don't miss that. This is Bloomberg Surveillance.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Stocks turning after an ECB rate cut, the 8th of the cycle. Meanwhile, people looking through some of the trade data as well as initial jobless claims slightly weaker, a bit into the bond markets. 2 years, 10 years, 30s in the U.S. lower, particularly at the long end, with down that 30-year bond down 3 basis points. The euro gaining some steam, interestingly, even after what was perceived as a dovish interest rate cut by the ECB. Still euro strength, 114.37. So glad to say that Neela Richardson is here with us. We are awaiting ECB President Christine Lagarde's news conference. But Neela, before we get started, we were having a conversation with Krishna and yourself about the integrity of some of the data. And I'm curious about how much increasingly markets are trading off other indicators that might be viewed as economic in the way that some of the classic metrics have been.
You know, our U.S. statistical system is the gold standard for data. It continues to be, but I do think there is a broader outlook when it comes to data. We're all in some sense data dependent, but I wish we'd move more to trend dependent, and how companies are actually expressing their outlook is an important data point. Corporate America is the boots on the ground for the real economy, and so their narrative is important as we think about what's ahead.
Mila Richardson, thank you so much for being with us. Right now, we turn our attention to ECB President Christine Lagarde, who is at her news conference.
The strength of monetary policy transmission. Inflation is currently at around our 2% medium-term target. In the baseline of the new Eurosystem staff projections, headline inflation is set to average 2% in 2025, 1.6% in 2026, and 2% in 2027. The downward revisions, compared with the March projections by 0.3 percentage point for both 25 and 26, mainly reflect lower assumptions for energy prices and a stronger euro. Staff expect inflation, excluding energy and food, to average 2.4% in 25 and 1.9% in both 26 and 27, broadly unchanged since March. Staff see real GDP growth averaging 0.9% in 25, 1.1% in 26, and 1.3% in 27. The unrevised growth projection for 2025 reflects a stronger than expected first quarter, combined with weaker prospects for the remainder of the year. While the uncertainty surrounding trade policies is expected to weigh on business investment and exports, especially in the short term, rising government investment in defense and infrastructure will increasingly support growth over the medium term. Higher real incomes and a robust labor market will allow households to spend more. Together with more favorable financing conditions, this should make the economy more resilient to global shocks. In the context of high uncertainty, staff also assessed some of the mechanisms by which different trade policies could affect growth and inflation under some alternative illustrative scenarios. These scenarios will be published with the staff projections on our website. Under this scenario analysis, a further escalation of trade tensions over the coming months would result in growth and inflation being below the baseline projections. By contrast, if trade tensions were resolved with a benign outcome, growth and to a lesser extent inflation would be higher in the baseline projections. Most measures of underlying inflation suggest that inflation will settle at around our 2% medium-term target on a sustained basis. Wage growth is still elevated, but continues to moderate visibly, and profits are partially buffering its impact on inflation. The concerns that increased uncertainty and a volatile market response to the trade tension in April would have a tightening impact on financing conditions have eased. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of exceptional uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release that is available on our website. So I will now outline in more details how we see the economy and inflation. The economy grew by 0.3% in the first quarter of 2025, according to Eurostat's flash estimate. Unemployment at 6.2% in April is at its lowest level since the launch of the euro, and employment grew by 0.3% in the first quarter of the year, according to the flash estimate. In line with the staff projections, survey data point overall to some weaker prospects in the near term. While manufacturing has strengthened, partly because trade has been brought forward in anticipation of higher tariff, the more domestically oriented services sector is slowing. Higher tariffs and a stronger euro are expected to make it harder for firms to export. High uncertainty is expected to weigh on investment, but at the same time, several factors are keeping the economy resilient and should support growth over the medium term. A strong labor market, rising real incomes, robust private sector balance sheets, and easier financing conditions, in part because of our past interest rate cuts, should all help consumers and firms withstand the fallout from a volatile global environment. Recently announced measures to step up defense and infrastructure investment should also bolster growth. In the present geopolitical environment, it is even more urgent for fiscal and structural policies to make the euro area economy more productive, more competitive, and more resilient. The European Commission's Competitiveness Compass provides a concrete roadmap for action, and its proposals, including on simplification, should be swiftly adopted. This includes completing the Savings and Investment Union, following a clear and ambitious timetable. It is also important to rapidly establish the legislative framework to prepare the ground for the potential introduction of a digital euro. Governments should ensure sustainable public finances in line with the EU's economic governance framework, while prioritizing essential growth-enhancing structural reforms and strategic investment. Looking at inflation, annual inflation declined to 1.9% in May, from 2.2% in April, according to Eurostat's flash estimates. Energy price inflation remained at minus 3.6%. Food price inflation rose to 3.3%, from 3% the month before. Goods inflation was unchanged at 0.6%, while services inflation dropped to 3.2% from 4% in April. Services inflation had jumped in April mainly because prices for travel services around the Easter holidays went up by more than expected. Most indicators of underlying inflation suggest that inflation will stabilize sustainably at our 2% medium-term target. Labor costs are gradually moderating, as indicated by incoming data on negotiated wages and available country data on compensation per employee. The ECB's wage tracker points to a further easing of negotiated wage growth in 2025, while the staff projections see wage growth falling to below 3% in 2026 and 2027. While lower energy prices and a stronger euro are putting downward pressure on inflation in the near term, inflation is expected to return to target in 2027. Short-term consumer inflation expectations edged up in April, likely reflecting news about trade tensions. But most measures of longer-term inflation expectations continue to stand at around 2%, which supports the stabilization of inflation around our target. Turning now to our risk assessment. Risks to economic growth remain tilted to the downside. A further escalation in global trade tensions and associated uncertainties could lower euro area growth by dampening exports and dragging down investment and consumption. A deterioration in financial market sentiment could lead to tighter financing conditions and greater risk aversion, and make firms and households less willing to invest and consume. Geopolitical tensions, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, remain a major source of uncertainty. By contrast, if trade and geopolitical tensions were resolved swiftly, this could lift sentiment and spur activity. A further increase in defense and infrastructure spending, together with productivity-enhancing reforms, would also add to growth. The outlook for euro area inflation is more uncertain than usual. As a result of the volatile global trade policy environment, falling energy prices and a stronger euro could put further downward pressure on inflation. This could be reinforced if higher tariffs led to lower demand for euro area exports and to countries with overcapacity rerouting their exports to the euro area. Trade tensions could lead to greater volatility and risk aversion in financial markets, which would weigh on domestic demand and would thereby also lower inflation. By contrast, a fragmentation of global supply chains could raise inflation by pushing up import prices and adding to capacity constraints in the domestic economy. A boost in defense and infrastructure spending could also raise inflation over the medium term. Extreme weather events and the unfolding climate crisis more broadly could drive up food prices by more than expected. Let's look at the financial and monetary conditions. Risk-free interest rates have remained broadly unchanged since our last meeting. Equity prices have risen, and corporate bond spreads have narrowed in response to more positive news about global trade policies and the improvement in global risk sentiment. Our past interest rate cuts continue to make corporate borrowing less expensive. The average interest rate on new loans to firms declined to 3.8% from 3.9% in March. The cost of issuing market-based debt was unchanged at 3.7%. Bank lending to firms continued to strengthen gradually, growing by an annual rate of 2.6% in April after 2.4% in March, while corporate bond issuance was subdued. The average interest rate on new mortgages stayed at 3.3% in April, while growth in mortgage lending increased to 1.9%. In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability. While euro area banks remain resilient, broader financial stability risks remain elevated, in particular owing to highly uncertain and volatile global trade policies. Macroprudential policy remains the first line of defense against the buildup of financial vulnerabilities. Enhancing resilience and preserving macroprudential space. So in conclusion, the Governing Council today decided to lower the 3 key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of exceptional uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions.
And the first question goes to Mark Schröers of Bloomberg. Mark, please.
Yes, thanks a lot for taking the questions. The first one is on rates. Has anyone today advocated either pausing rate cuts or cutting by a bigger 50 basis points? And would you say that after today's rate cut to 2%, a pause at the next meeting in July would make sense, also to wait for new projections in September? And the other one is not on the future of rates, but on your own future. WEF founder Klaus Schwab had said that you discussed leaving the ECB before the end of your term to lead the World Economic Forum. I know the ECB stated your determination to stay, but without an outright denial of these talks. So have these talks taken place or not, and have you contemplated leaving the ECB early? Thank you.
Thank you for your 2 questions, and I'll start with the first one, which is really the order of business and the main topic today. So we cut interest rates by 25 basis points. And with today's cut at the current level of interest rates, we believe that we are in a good position to navigate the uncertain conditions that will be coming up. So we are well positioned to navigate those circumstances. I can also tell you that it was an almost unanimous decision. There was one Governing Council member who did not support the decision, but other than that, it was virtually unanimous. So I would call it either very broad consensus or virtually unanimous support for the decision to cut by 25 basis points. And obviously, we analyzed the situation in the light of the 3 criteria that you know well, because they are repeated several times in the monetary policy statement and have not varied for a number of meetings now. But under those 3 criteria, really the situation points towards inflation settling at our 2% targets. We can come back to the path, but this is what we are seeing, and that is what has predicated the cut that we made today. Now, you asked me about my future, which is far less important than the future of the economy and the future of our monetary policy, rest assured. But I can very firmly tell you that I have always been, and I'm fully determined to deliver on my mission, and I'm determined to complete my term. So I regret to tell you that you're not about to see the back of me.
Next question goes to Annette Weisbach of CNBC. Annette, please.
Hi, President Lagarde. I have a question. When I read through the communiqué today, I have the feeling that you're quite confident on the economy despite all the uncertainties. So is that a right assessment? And at the same time, you're also quite confident that inflation is under control. So does that bring me to the right conclusion that we're almost done when it comes to rate cutting? And then a question on your thinking about the boost from the fiscal space, because clearly it will take time until we'll see that materializing on the economy and also probably on inflation. So just to also understand, why are you so confident that this is actually supporting the economy also in the shorter term, despite all the uncertainties? Thank you.
Well, thank you so much for your question. We have hardly revised our growth numbers. So the only year where we have slightly revised is 2026, and by 0.1%. So we have confirmed our projected growth rate as per our projection of last March at 0.9% for 2025. And that was certainly reinforced by the number we had for Q1. So I mentioned the 0.3 Q1 number, which was, as you know, revised from an initial 0.4. I wouldn't expect, I would not exclude that there be further revision of that number on the upside. Now, this is attributable to multiple factors. It's improved consumption, it's improved investment, but more importantly, it's the buildup of inventory or anticipated purchases and therefore sales in fear and anticipation of the tariffs. So that Q1 is, of course, very peculiar, well, very particular, more than peculiar, and is clearly giving momentum to the growth that we are seeing and anticipating for 2025. But again, I would not exclude that that number of 0.3 be revised upward, given the volume that we are seeing being traded out of some countries in particular. But we are not revising 27, and we are very marginally revising 2026 because there is a carryover, number one, and because we believe that the impact of tariff, if and when they materialize, on the export that we have towards the United States, which I remind you is only 17% of our total exports outside from the euro area and European countries, will impact predominantly on 26 and will then be significantly offset by the expected investment in both military equipment and construction, or infrastructure, if you will, particularly out of some countries. So our assessment is that that will have a bearing on 27 predominantly, some in 26, but predominantly in 27. So you have this offset between the two. So are we confident? I think that would be far-fetched, because we are in a good place. As I said, I think we are well positioned as you know, after that 25 basis point rate cut and with the rate path as it is, we are in a good place. We will face uncertainty. We do not know what the outcome of the negotiations will be between the various partners. We don't know the level of retaliation that might be decided, which incidentally is not included in our baseline, as you will see published later on. And as a result, we have to be prepared, and we will be assessing meeting by meeting data as they come in. But, you know, as I said again, we are well positioned at the moment. And the path of inflation that we see certainly returns to 2% in 2027. So we start from a place where we have inflation for 2025 at 2%. It goes below target in 26 for reasons that have predominantly to do with the price of energy and the value of the euro. Because as you know, it's based on our current assumption of those prices now. And that's what explains these numbers.
Next question, Francesco Canepa of Reuters. Francesco, please.
Thank you very much. Good afternoon.
Good afternoon.
So you said that the current level of rates leaves you in a good position.
Mm-hmm.
Are we to understand that as an indication that you're done cutting interest rates? Or if I can rephrase the question in another way, what would you need to see for you to cut rates again?
Again, we are in a good position, and we are in a good position on the basis of the current rate path and with the 25 basis point cuts that we decided, so that we can face the uncertainties that are coming our way. But as you have heard in the monetary policy statement, we will decide meeting by meeting on the basis of data. And we will assess, as and when data come in, whether or not that position is secure in order to deliver on our 2% medium-term target. What I'm saying today is that we are in that good position.
Next question to Aude Kersulek of BFM Business. Aude, please.
Thank you, President Lagarde, for taking my question. First question, would you say the monetary stance has now shifted to neutral, or is it still restrictive, even slightly? And second question, some countries are facing higher debt and may struggle to attract investors. At what point does that become a concern for the ECB in terms of policy transmission and financial stability? Thank you.
Well, thank you for your two questions. We have not discussed this wonderful concept of the neutral rate on the occasion of this meeting. And I think that we all know well that as we are getting closer to that zone, we need to be particularly attentive. We need to be confident in our resolve to deliver with the appropriate monetary policy our medium-term 2% target. But we have not discussed that neutral rate. And I alluded to that at our last press conference. You know, the neutral rate is predicated on the absence of shock. Great equilibrium, no shock. Well, I wish there was no shock. But we have just nearly concluded a cycle of monetary policy that dealt with a series of shocks. Pandemic, war in Ukraine, energy crisis. And I think we have done that decently well. Inflation is at target 2% medium term. We are currently around 2%. Expectations are well anchored around 2%. And those elements that I told you repeatedly over the few last conferences was of concern to us, namely inflation on services, evolution of wages, evolution of profit. Those three elements are coming really in line with what our projections were in order to deliver on our 2% medium-term target. For the moment, we are facing significant uncertainty. You will read in the material, in the monetary policy statement, I think we quote uncertainty 9 or 10 times. It abounds. There is plenty of that. And clearly we are trying to improve our game as much as we can in order to anticipate, measure, caliber, but it's proving obviously quite difficult. And that's the reason you will be not only receiving our projection exercise, but also the scenarios which encapsulate some of the channels of transmission to growth and inflation. Some of them, not all of them. In particular, I would mention one that we discussed quite extensively during the Governing Council, which is the disruption of the supply chain. That is not included in any of our scenarios.
And the next question goes to Svein Iljan of the Bulgarian newswire BTR.
Oh, welcome.
Thank you.
I hope all your colleagues have welcomed you to the circle.
I hope to. A According to the ECB convergence report published Wednesday, Bulgaria is ready to join the Eurozone on January 1st next year. What do you expect to be the effects of Bulgaria's accession to the euro area? And will the currency zone be stronger with the likely new member state?
So first of all, I would like to congratulate Bulgaria, the Bulgarian people, and welcome them. This is not yet a completed decision-making process because, as you know, while the Commission and us have validated under the convergence report that the criteria are met, the European Council still has to approve. So I don't want to prejudge what the European Council will decide, but there is a very strong likelihood that Bulgaria will become our 21st member around the table. And we are delighted that the circle gets larger, and we will be looking forward to the Bulgarian contributions, both in terms of intellectual input, economic analysis, monetary policy determination, and as soon as the decision is final with the European Council, as you probably know, we will welcome for several meetings before January 1st the Bulgarian representative at the table of the Governing Council in order to sort of facilitate and do the onboarding properly, and so that we can also get to know a new colleague. I also hope that the Bulgarian people will value the solidity of the euro area colleague. I also hope that the Bulgarian people will value the solidity of the euro area, the solidity of the currency that we have. Some of you have probably noticed that the supportive judgment of the Europeans has gone up and is now at 83%. So you have 83% of the Europeans, based on a survey that is done on a regular basis, 83% actually value and appreciate the euro as their currency. So I hope we can together do everything we can so that Bulgarians can also appreciate the value and the shield impact that the euro constitutes for new members.
And the next question goes to Stefan Reckius of Handelsblatt. Stefan, please.
Thank you very much for the floor. First question is, some analysts have entertained the idea that you could skip July to make a concession to those governing council members who have already become reluctant to cut rates further. Could you walk us through today's deliberations in this light? And my second question is, you have been reluctant to declare victory over inflation for quite some time. So is this the right time for a victory lap? And if not, why?
Yeah, victory laps are always nice, but there is always another battle. So, as I said, I think that with today's cut and the current level of interest rates, number one, I think we are getting to the end of a monetary policy cycle that was responding to compounded shocks, including COVID, including the war in Ukraine, the illegitimate war in Ukraine, and the energy crisis. But, of course, we are now into a different time with different players, with different partners, with different policies. And we will continue to analyze and assess and measure and make sure that we deliver on our 2% medium-term target. This is in a way the thing that is certain. You should not doubt for a second our determination to deliver with the appropriate monetary policy the 2% medium-term target. What we're seeing currently with this 2% projected inflation for 2025, around 2% for 2027, and 1.6 in 26, caused predominantly with our current assumption on the price of energy and the value of the euro, we have a good path to this target, and we'll make sure that we I don't mean to use the word oscillate or navigate, but it will be, close navigation around our target. That's where we have to be and want to be.
This concept of the direction of travel, which you earlier used in this rate cycle. Your today's remarks suggest to me that the direction of travel now probably is more a sideways movement rather than kind of a downward as it was by the end of the year. Would that be the right takeaway from your today's remarks? And my second question again is on these remarks by Klaus Schwab of the World Economic Forum. Some people suggest that the disclosure that you considered leaving the ECB early could undermine your ability to do your job properly, as you might be seen as a lame duck. What would be your response to those concerns? Thanks.
Thank you for your two questions. On the first one, the reason I used the direction of travel concept was when we were really at a distance from our medium-term 2% target. So to talk about the direction of travel, when we have our medium-term 2% target in sight, sustainably so, when underlying inflation is not budging. So for those in doubt, headline inflation in 2026 is clearly oil and gas and the value of the euro, which we assess at the time when we cut off the period when we do our when staff does its assessment. And underlying inflation, core inflation, this is hardly moving, and it's at around our target. So there's no point talking about the direction of travel. There's no point talking about sideways. What I'm saying is that we will be determined to deliver that 2% medium-term target. We will be looking at all data that come in. We will be deciding meeting by meeting, and we will constantly assess and reassess how we are delivering on this 2% medium-term target. Now, as to your second question, I will repeat what I have said. I have always been driven by my mandate, and I'm determined to complete my term. Period.
And the next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you for the opportunity. I have two questions. One is on APP and PEP, in the sense that the ECB no longer reinvests the principal payments of these portfolios. Would the Governing Council have to put on hold quantitative tightening if it were to decide for a pause in interest rate cuts? Even if these no longer investments have a very small impact, keeping interest rates unchanged during QT is somehow a restrictive stance, as the ECB is draining liquidity. And my second question is on the role of the euro. The governor of the Bank of Italy, Fabio Panetta, warned in his speech on the 30th of May, in his concluding remarks, that the recent US depreciation raised important questions about the future structure of the international monetary system and the dominant role of the US dollar as both a reserve and a trade invoicing currency. I would be very interested to know your opinion, given your vast and very important special experience in the United States. What do you think is happening now with the dollar, and also what could be the implications for us, for the role of the euro, and hopefully also euro-denominated safe assets? Thank you.
That's like 4 questions in 2. So on your first question, while I appreciate that some of you would like to hear me talk about pause, hold, or whatever, I just can repeat myself that we are currently well positioned to navigate the uncertainties of the next months. And I think the risk of inconsistency anyway is not, sorry, the risk of inconsistency of QT associated with interest rate policy, which is our main tool, is probably less critical in the event that I'm not confirming here now of a pause than it is in the event of a cut. So I don't see that, but neither do I say anything about future decisions, which would only be predicated on major shocks that we are not seeing at the moment. Now, on the role of the euro, I highly regard the speech that was given by my colleague and friend, Governor Panetta, Gentile Governatore, right? And I happen to be very much on the same page as he is. I gave a speech in Berlin about 10 days ago now at the Hertie School of the Jacques Delors Institute, in which I tried to identify the key pillars that would need to be consolidated and further developed if the euro was to play a critical role as an international reserve currency. And my conclusion is that there is an opportunity that is opening now in order to strengthen the role of the euro as an international currency, as to take it further towards possibly the international reserve currency of choice. But my conclusion is that it is not going to be granted to us. It should not be taken as a given, and it will require in particular that member states, the Commission, the European Council make very substantive decisions that will have to do with consolidating the economic and geopolitical role of Europe, that will simplify, streamline, and develop the role of the capital market union in particular, the saving and investment union, if you will, but particularly the capital market union. And we'll have to continue to sustain the effort of making Europe a place where the rule of law is respected, where a contract is a contract, so that there is certainty on the part of the investors, of the economic actors, that Europe is actually a reliable place of business. So I think it's not a question that can be responded in yes or no. It's a fairly thorough and deep debate that we have touched on during the Governing Council meeting in the last 2 days, where we strongly feel that we have done our part, will continue to do our part, but we also strongly advocate in the monetary policy statement the role that authorities have to play if we want to develop in that direction, which is a window of opportunity. Now
Andres Stumpf of Expansion. Andres, please.
Good afternoon, Madam President. I've noticed you're wearing the in-charge necklace. If I see it correctly, I suppose it was intentional today. But going to...
Just in case of doubt, you know.
Yeah, but going to my question. So with 1.6% inflation projected by next year under your baseline scenario, won't it warrant more rate cuts for itself, regarding of it coming from the euro and the energy, and regardless of the outcome of the trade war? And second question, and I also wanted to ask about BBVA Sabadell merger, which is now being checked by the Spanish ministers, and even though it has the ECB's green light and the other one of the competition authorities, do you fear that political opposition to mergers could hamper the advances on the banking union? Thank you.
Thank you so much. I hope you don't mind if I ask my colleague, Vice President and friend, Luis de Guindos, to address the latter part, and I would turn the floor over to you, and I'll come back to yours afterwards.
Well, thank you very much, President. Good afternoon to everyone. As you have said, we produced our report and we released our report. I think that it was almost 1 year ago. And now the antitrust authorities in Spain, they have given, their opinion and the remedies that they have imposed for the deal. And now, according to the Spanish law, the government has the possibility to analyze the conditions imposed and, according to the general interest, to modify these conditions. As you can imagine, we can wait. We should wait until we have, a definitive opinion from the Spanish government. Otherwise, what we could be making is a sort of a speculation that I think that it doesn't make much sense in this moment of time.
Thank you, Vice President. And on your first question, I just want to remind you that our forecast is 2% inflation in 25, 1.6 in 26, 2% in 27. And our core inflation is even more stable than that. It's 2.4 in 25, 1.9 26, 1.9 27. Now, of course, you think, oh, 1.6 in 26. That's exactly part of the assessment that has been produced by staff. And if you look at what other institutions have forecasted, it's at the very low end of the range for 2027. And that's also because they take into account most recent data available, not including Q1, because I think Q1 will give us some surprises. But if you compare headline inflation and core inflation, you can see exactly where the difference lies. And that is energy prices and the value of the euro. We also have inflation, both headline and core, returning to 2%, 1.9% for core in 2027. And the cuts of today, the 25 basis points cut, is deliberately taking care of that inflation path. So we are confident of the analysis of our staff on that basis. And as I said, we will do what is necessary in order to make sure that inflation stays at our 2% targets. Monetary policy will be appropriately determined on that basis. But as I said, we are very well positioned.
And the last question goes to Chelsea Delaunay of the Wall Street Journal. Chelsea, please. Yeah.
Thank you. I'm also going to ask about inflation. I mean, the narrative of the past several post-pandemic years is higher for longer, structurally higher inflation for all of these different reasons. And looking both at the core and the headline forecast and your expectation potentially for a structurally stronger euro, is that still the expectation, higher for longer for inflation and for rates? And then my second question is also about the euro. Whenever the euro goes up, people worry about how that's going to impact exporters and some of these export-dependent economies. And I'm curious if you think the Eurozone is strong enough now for a strong euro.
Is the Eurozone strong enough for a strong euro? That's your bottom line question of your second question, right? Well, when I look around and reflect on the work that we have done in the last 6 years, we have a very solid labor market. Labor market where participation has, including most recently, increased, where we have been at rock bottom unemployment rate ever since the euro was created. The fears of recession that abundant only about a year ago have not materialized. We are forecasting 0.9, 1.1, 1.3, with very limited revision to growth. The output gap closes at the end of our projection horizon. Wages have increased over the course of those years, particularly with a view to catching up with the lost purchasing power that citizens had suffered as a result of inflation. But it is now decelerating just in line and in time, I would say, to deliver on our 2% medium-term target. The monetary policy is transmitting quite smoothly to the economy. Credit is up, could be further and higher up, but credit is up. Rates are transmitting, including to corporates and mortgages. So I would say that the economy is responding quite well to our monetary policy and is delivering on that front. I would add, as I did in response to one of your colleagues earlier, that more needs to be done. And what we have seen, the Vice President and I, when participating in the finance ministers' meetings in Brussels, whether it's ECOFIN or Eurogroup, or on the occasion of Pascal Donoghue, the president of the Eurogroup, when he had dinner with us a couple of nights ago, we perceive a serious momentum to improve, to change, to simplify, to streamline, and to encourage and lock in, well, not lock in, but welcome capital into Europe. And we are seeing it. You know, the reverse Yankee bonds, significant increase that we have seen in the last few weeks is a clear indication that there is trust in our system. The capital flow that we are seeing as well, whether it is, you know, European investment returning to Europe or a bit of non-European investment coming to Europe, all that is an indication that at least market forces, investors, those who move real money around, actually see value and have confidence in Europe. So that would be my answer to your second question. I'm not sure what you meant by higher for longer, because I think I have gone out of my way to say that we are in a good place and we are well positioned now, and that we will be assessing meeting by meeting on the basis of data what, if any, needs to be done in terms of appropriate monetary policy to return us to the 2% medium-term target. So I think that really sort of brings together the discussions that we've had over the last 2 days. And with that, I wish you a happy day, happy summer for those of you who live early, and see you soon.
The next press conference is on the 24th of July. So up until then, all the best. Thank you.
All right, that was EC President Christine Lagarde speaking in Frankfurt as the central bank cuts rates for the 8th time this year. It hasn't been 9 times. If you don't remember that it was 9 times, that's because it wasn't 9 times. This is Open Interest. I'm Matt Miller alongside Katie Greifeld. You know why I say that, right?
Because President Trump truthed it the other day.
And Ferris Bueller.
And I actually did not catch that part of the reference, but the ECB cutting rates as predicted. Shall we talk about the U.S. equity market, which has been open for about 10 minutes here?
Yeah, and
giving up our gains, down about 0.1% when it comes to the S&P 500, even though we got some very interesting news when it comes to the trade negotiation stance between the U.S. and China, Matt.
Yeah, I was also going to say relatively close to a bull market. I didn't notice that we turned back down.
Yeah.
If we rise to 59.79, and of course we had hit that level for a while yesterday, we would be at 20% up from the lowest level. So we could still make it today, but we kind of retreated yesterday. So now on a closing basis, we're up 19.8% from the lows in February.
You did see the NASDAQ 100 manage to close in the green yesterday, which was interesting. The overall index faded, but tech held up. And a lot of the future direction could be determined for the tech index. Tonight, we have Broadcom earnings and a few others. But for right now, it sort of feels like a holding pattern.
Right, it does, although I think it's interesting to look at rates. We're pretty low right now at 4.35 on the 10-year. The news you're talking about that hasn't moved markets.
And then it didn't.
President Trump and Chinese leader Xi Jinping reportedly actually had a phone call. The U.S. president has been begging the Chinese president to call him for months. And so now I guess it's actually happened. Let's get the latest from Bloomberg Washington correspondent Tyler.